level up financially. And this masterclass will show you the right way to do it. In today's world, it's hard to determine truth versus fiction. We're constantly being bombarded with data and opinions that can lead you astray. At VectorVest, we provide you with not just data, but with accurate, actionable information that you can use to make smarter, faster, and better investing decisions. For many people, managing wealth and investing can be a very time-consuming and stressful endeavor. Today, we're going to show you how you can simplify everything. We will show you how to find the information you need when you need it. You'll be able to reduce the amount of time you spend investing and reduce stress by building a rules-based, unemotional system. We built this course to strategically walk you through the VectorVest philosophies, our core indicators, and how to apply them in real life. You'll also gain some insight from our founder, Dr. Bart DiLiddo, along the way. For those of you that are seeing VectorVest for your very first time, I welcome you and congratulate you on taking the first step in achieving financial freedom. In a little while, I'll show you how you can try out VectorVest for just 60 days at no cost. During and after the presentations, feel free to chat in the chat box. The instructors will be standing by to answer any questions you may have. And please don't forget to hit the like button and subscribe to the channel to stay abreast on the content we produce daily. So let's take a look at the agenda for the complete stock market masterclass. In just a few minutes, we will hear a message from our founder, Dr. Bart DiLiddo, where he will explain why and how VectorVest was created. Then we will jump into the VectorVest Philosophy, where Mr. Todd Schaefer, Manager of Research, will explain why our approach to making money in the stock market separates us from every other service out there. At 10 a.m., Mr. Glenn Tompkins will cover the VectorVest system on analyzing and ranking stocks. This talk will show you how to separate data from fact-driven, actionable information that will give you the advantage to succeed. At 10:45 a.m., we will have a short break and we will hear from Dr. Bart DiLiddo once again. At 11 a.m., Mr. Steve Chappell, Director of Trading Systems Development, will give a talk on buying low and selling high. This time-tested approach to trend following will ensure that you never miss another major market turn and will keep you on the right side of the market every time. Then at 11:45 a.m., Mr. Jim Penna, Manager of Retirement Services, will show you how to build a winning stock portfolio. You will learn how to limit your risk through money management and find the very best shares to trade. Then at 12:30 p.m., we'll take a lunch break and you'll have a very special presentation of how the market works from Dr. Bart DiLiddo himself. At 1:30 p.m., Mr. Jerry D'Ambrosio, Manager of Educational Content, will demonstrate powerful tools to build a rules-based trading system. He will show you how to remove the emotion from investing so you know exactly when to buy, what to buy, and when to sell. Then at 2:30 p.m., we'll take another break, followed by Mr. Steve Chappell. He will show you how to build, test, and deploy a dynamic trading system. Finally, at 4 p.m., Mr. Todd Schaefer will cover the daily drill. He will give you the cadence on how to manage your trading system day in and day out. Without further ado, let's get things kicked off with a message from our founder, Dr. Bart DiLiddo.
It's great to be with you today. I started investing in 1960. I grew up partly during the Great Depression of the 30s. I was born in 1931. I had to work for everything I got. Finally, I graduated with my doctorate from a very fine engineering school, and I went to work in a research lab. And the folks there were all interested in the stock market. They were investing and thinking about their future and retirement. I thought, gee, that'd be a great thing to do. So I read some books. I joined a stock club. I subscribed to newsletters. I thought I did all the things I needed to do to learn how to make money in the stock market. But after 15 years, I hadn't made very much. Now we have to remember that I started in 1960. And for the next 15 years, the Dow only went up about 150 points. It's cycled between going down and going up. There were 3 bear markets during that period of time, and the Fed was haphazard. There were a lot of difficulties, but the problem was I really didn't understand how to invest, and I wasn't getting the information I needed. So in December of 1974, I sold all the stocks I had, and that was the end of the bear market of 72 and 74. I sold at the very bottom. So after that period of time, I hadn't made any money, but I didn't lose a lot either because I didn't have a lot to lose. I thought it was done for the market forever when in 1978, I was living in Brecksville, Ohio, which is in the northern part of Ohio, and the storm of the century came through. It was a blizzard, and that happened on a Friday night. And so the next morning when I got up, I saw that the garage door was completely covered with snow, and I couldn't even get out of the house, let alone go anywhere. Nevertheless, it was sort of a good thing for me because I had a job that kept me very busy, so I really could relax that day. Well, it turned out that I still had a subscription to Forbes magazine, and I liked to read Forbes because they were the leaders as far as discussing companies and their management style and that sort of stuff. So I started reading it, and that issue of Forbes, they analyzed and ranked 500 companies. It was an annual edition. It was a January edition of Forbes. And so I thought, well, I'm going to go through this magazine and pick the 10 best stocks and hold them for a year and see what happens. Well, as I went through it, I began to realize it didn't have the information I wanted. I wanted to know what stocks were worth, how safe they were, and when to buy, sell, or hold. And they didn't have anything like that. They told you about return on equity and stuff like that. But I can get that information anywhere. So I dug through some old files that I had. I had read Ben Graham's book, The Intelligent Investor, and he said that a prudent investor should buy safe, undervalued stocks rising in price. And that's what I wanted to do. But nobody told you what was safe and what wasn't. They didn't tell you whether it was undervalued or overvalued. They think they do. And of course, they don't tell you when to buy or sell. They tell you to buy. That's their job. Nevertheless, I found an article that I had torn out of Forbes magazine once. And it said the way to value a stock is to compare its earnings yield. And earnings yield is the reciprocal of PE ratio. In other words, if the PE ratio is 20, the earnings yield would be 5%. And you got to compare that to the bond yield of a AAA corporate bond, for example. And if the earnings yield was the same as the bond yield, the stock would be fairly valued. If it was way below the bond, it was overvalued. If it was way above the bond, it would be undervalued. So that was a start. So I spent the rest of the day, about half a day, going over that, and I created a formula that was quite simple. And it's in my book, Stock Strategies and Common Sense. And I started calculating all the value of all these stocks in a Dow. And it was pretty simple. Then I realized I had left a lot of things out. For example, the earnings growth rate I thought was important. The profitability, the return on total capital was important. And those factors had to be included. And in my book, Stock Strategy and Common Sense, which I wrote much later, I have those formulas. So by the end of the day, I had a feeling for what stocks were really worth. Of course, didn't have any feeling on when to buy, sell, or hold. That came later. But that got me started. And I started investing again and using my quick formula, comparing the earnings yield of a stock to the bond yield to start ranking stocks. And I started making money. And I found that when I bought safe, undervalued stocks, the money started coming more and more frequently, and it was easier to make money. So I continued working on what I had started. And Apple came out with their little computer right about that period of time. So I bought an Apple computer. I had done some computer programming when I was in college, but that was on an IBM 650. So I hired a guy as a programmer. So he wrote some programs for me. And then I thought, well, I need to know something about when to buy, what to buy, and when to sell. And I developed a timing system for when to buy stocks. And I like to buy rising stocks in rising markets. Now, I'd like to tell you a little bit about the book I wrote. It's called Stocks, Strategies, and Common Sense. And I was somewhat shocked to learn while I was in the market that what you see and what you hear, what you perceive is the reality. And you go through life deciding what to do and why to do it based on what you can perceive and what you think. And that's why I put the word common sense in the title. Because if you're stupid, you're going to believe everything you see and hear. Does anybody remember the movie about Pinocchio? Do you remember when Geppetto let Pinocchio go and Pinocchio was walking down the sidewalk and these characters engaged him?
My boy, you are allergic.
Allergic?
Yes, and there is only one cure. A vacation on Pleasure Island.
They took advantage of Pinocchio. And I felt almost like I was a Pinocchio in the stock market when I started. And I believe to this day that the book I wrote is the only book that has the term common sense in the title. Common sense gives you the ability to separate the truth from the fiction. What you see and what you hear may not be the truth, and you got to understand that. And it's very important to understand that if you're going to make money in a stock market, because the Wall Street wizards are there to sell you stocks, whether they're bad, good, or indifferent. And so they tell you a lot of things that aren't to your advantage. For example, they tell you that price earnings is a measure of value. It's not a measure of value. It's a measure of cost. And that was the one thing I wanted to separate and learn about in the 15 years I traded. I wanted to know what the value was. But I was dealing with price earnings ratios, and price earnings could be high, low, and they always had a reason why they were high, always a reason why they were low. Now, I did learn that you could take the price earnings ratio and divide it by the earnings growth rate as a metric for value. That was a step in the right direction, but it wasn't completely true. There were a lot of exceptions to that. For example, this past year, there are a lot of stocks that went up 200-300%. They don't make any money even. And they soared. They soared because they had a high sales growth rate, but they hadn't started making money yet. Nevertheless, I went on and wrote this book, and I gave it the title Common Sense. In the title, it's called Stock Strategies and Common Sense. And it's the only book on the market regarding stocks, I think, that has the term common sense in the title. I have an essay entitled Common Sense. The title of the book I wrote is Stocks, Strategies, and Common Sense. You can find it under the Welcome tab of VectorVest. As far as I know, it's the only book on stock investing that refers to common sense. Why was that? It's because the stock mavens on Wall Street want you to buy stocks no matter how bad they are, but that's the thing you have to do. You have to learn the difference between the truth and the fiction. And it's a hard lesson. And my goal in life is to deliver this message to as many investors as I can. So you would find in VectorVest, everything is backed up by mathematics. Everything we do is based on mathematics. And we have in the VectorVest system, we have over 25 years of data that's documented. It's there for anybody to see. You could see the good, the bad, and the ugly, if there is any ugly. I think there's not very much ugly, and there is a lot of good. But nevertheless, this is the background. And I dedicate the book to investors, trying to give them the information they need to make smarter, better decisions.
Hello, everyone. Hopefully, Dr. Bart DiLiddo was able to bring you back in time and shed some light on how and why VectorVest was started. In this presentation, Dr. DiLiddo referenced his little green book, Stocks, Strategies, and Common Sense. If you would like to download a copy, you can simply log into the VectorVest 7 platform. Click on the Welcome tab, and you will see the download link for Stocks, Strategies, and Common Sense at the top of the page. I really encourage you to read it if you haven't already. For those of you that are new to VectorVest, we're going to offer you a 60-day free trial to our software so that you can follow along with the recordings of this masterclass. This free trial will only be available today, and you can take advantage of it by going to www.vectorvest.com/MC-bundle. That's Mary Charlie Bundle. Once you get to that page, you will see that this free trial gives you access to the software we are using today, the Successful Investor Quick Start course that will surely send you down the right path to success. And you're also going to receive access to our Successful Investing coaching group that meets live weekly, where Mr. Todd Schaefer and Brian D'Amico help everyday investors navigate a portfolio and teach you how to make money in the stock market. In this coaching group, you will be able to interact with the instructors and ask questions to ensure you will be successful. With this trial, you will also be able to download Dr. DiLiddo's little green book, Stocks, Strategies, and Common Sense. Okay, next we're going to send you over to Mr. Todd Schaefer, Manager of Research, as he covers the VectorVest philosophy. Take it away, Todd.
Well, thank you, Ray. I appreciate that intro. And my name is Todd Schaefer. I'm the Manager of Research. And listening to Dr. DiLiddo's intro, at first I'm struck what a treasure he is, right? Anytime I can have an opportunity to hear him speak, I'll take it. But it also makes me think about the origins of my investing. I started investing in the 70s, about the time Dr. DiLiddo was starting to think about VectorVest and its methodologies. I was out there as an individual investor trying to figure it out myself. And I did all the things you're supposed to do. I subscribed to Money Magazine and Kiplinger's and read the Wall Street Journal, right? Did all those things and moderate success. So I eventually started turning and investing with mutual funds. And that worked okay until I came to the tech bubble burst, right, in 2000. And all of a sudden I thought, well, wait a minute. The experts didn't necessarily fare very well in this bubble, but I didn't really have anywhere else to go. Well, I've been with VectorVest for 15 years now, and if you do the math, that means I started with VectorVest in 2007. What a divine intervention, right? 2007, I've been in the seat for a couple months now in customer support. Dr. DiLiddo writes his famous essay from November that says, this is the big one. This is not the time to be buying stocks, even though they're going to be telling you to do that, right? And we talked about contra ETFs. So not only did VectorVest save my bacon, but I actually made money in that downdraft, in that correction, investing in contra ETFs. So I was hooked. And so here I am, all these many years later, still a devotee of the VectorVest system. So this talk is a foundational talk expanding on the idea of the VectorVest philosophy. Because a philosophy is a structured way of thinking about the principles and the truth of any given subject matter, and of course, in this case, we're talking about the markets. That structure also forms for us the framework of a filtering system to help us identify or separate truth from fiction. And we all know the industry pumps a lot of fiction. That structure also informs a process that we can use to approach the markets that also isn't just a philosophical approach, but is confirmed by facts and data, right? A very important integral part of the VectorVest approach and the system. So Dr. DiLiddo mentioned his book, so you know how to get it, but I really encourage you to read it, because in that book, not only is he expressing the philosophies, but he also is sharing the mathematical expression of those philosophies. And those, of course, form the basis of the algorithms that are within the program. So he's made it a very approachable book, so I encourage you to read it. I've read it multiple times, as many of us have, because I learn something new every time. Sometimes I relearn things that I forgot that I had learned before. So I encourage you to pick up that book. That being said, let's move forward and then explore more deeply the VectorVest philosophy. VectorVest believes every investor should know what a stock is really worth, how safe it is, and when you should be buying, selling, or holding it. These three questions form the basis of our VST system of analysis, our core system of stock analysis that you'll see in the VectorVest system every day. That first question of what is a stock really worth is a question of valuation. So we look at valuation from two perspectives. First, the intrinsic value of the stock. Every day we publish a dollar and cent valuation for every stock in our database, and it's updated in real time. So that valuation gives you a hard number with which to compare with a price that's currently being traded in the market. So now you have actionable information that you can use to help gauge whether or not that stock is undervalued, fairly valued, or overvalued. If it's undervalued, well, right, that's the preferred status, right? If I can get $1 worth of stock for 70 cents, well, I like that. It's on sale. I'm getting a bargain. It puts another piece of the probability picture in my favor, particularly if the stock has strong fundamentals, if it's a good company. But what if it isn't? There are some stocks out there that are undervalued for a reason. They have no fundamental strength. People just don't want to be in that stock. We call that a value trap. So you can't just look at the valuation itself and say, oh, it's a good investment because it's undervalued. No, you need more information. You need the fundamental analysis that VectorVest, of course, provides. So those are undervalued stocks. You can also have a fully valued stock. Well, a fully valued stock, you're not getting a discount, but you're also not paying a premium either. So you're paying full retail for the stock, which, depending on market conditions and the stock in question, may be fine. The third possibility is that the stock is overvalued. Well, if the stock is overvalued, we don't like paying more for something more than it's worth, particularly if the stock doesn't have good fundamentals. So why would people overpay for a stock that has weak fundamentals? Well, beyond hype, they might be speculating on the future prospects of the company that haven't been demonstrated yet in fundamental performance. So for instance, maybe it's an innovative company that has a new technology or a new process that's a real game changer. Maybe it's a company that is due for an FDA approval or a patent approval, or maybe they're going to win a court case perhaps. But ultimately, investors are speculating on some non-fundamentals based event happening that will greatly change the prospects for that company. Well, what if the company does have good fundamentals? Now I have an overpriced company that has strong fundamentals that maybe warrant paying a premium to be in that stock. We call these stocks glamour stocks, particularly if the stock is a perennial performer, right? Just year in, year out, they knock the cover off the ball. People are happy to pay a premium to hitch their cart to that horse. So those are glamour stocks. There's a third possibility, though, that the market broadly is overvalued. So particularly at the end of long bull runs, money's been flowing into the market chasing the same relatively fixed number of stocks, inflating the price of the market broadly. It's very difficult in that kind of market condition to find undervalued stocks that have strong fundamentals because the money's already been chasing them. So if you decide that you're only going to buy stocks when they're undervalued, you may be sitting on your hands for quite some time because bull markets can last for years. Do you really want to sit out the market for years? So it puts us in the situation where if you want to make money, you need to invest. And so there may be times when if we want to play, we're just going to pay. Otherwise, you're left with the choice of not participating or going elsewhere with your investments while the market is in that overvalued state. The key here is that you now have a metric to understand all of those situations. And now you can make a decision, an informed decision, on how you want to play that market condition and how to best align that trade or that investment with your objectives. It's information that you can use that's actionable that you can't get anywhere else. All right, let's look at the second way we look at valuation. Because as investors, we are forward-looking investors. Right? We're looking to the future performance. And so we have an analysis that we do that looks at the upside potential of that stock as part of the valuation model. So every day we measure and map the upside potential for every stock in the database and report that information to you, again, to help you make informed decisions about the stocks that you're considering investing in. Now that was the first question, what's a stock really worth? Let's talk about safety, because it may have great upside potential, but I may not be really interested in taking on a lot of risk to attain that potential, right? So is this stock a Maalox moment waiting to happen, or is this a sleep at night stock? Well, every day VectorVest measures and maps the safety of every stock in the database, and again reports that to our subscribers to help you make a better informed decision. Our third question was, when should I be buying, selling, or holding that stock? VectorVest assigns a buy, sell, or hold rating to every stock in the database every day. The stock's performance is what drives that rating. And it's based on rules. No gut hunches, no narratives, right? No funny business. It's all driven by data. So in that system, we give preference to stocks that have fundamental strength that are rising in price. Those are the stocks that in our VST system, value, safety, and timing or price trend. Stocks that have strong VST scores are stocks that have those attributes. And we like to buy rising stocks because we don't like to buy falling stocks. And the problem with buying falling stocks, even though the industry will tell you, well, you're getting a better price. Well, you are, but if you buy the stock while it's in downtrend, you don't know how far down is. So we say instead of buying the stock while it's falling, let's wait for that to stop. Wait for the stock to start rising again. Now that's a better time to enter that position. So that VST system of finding stocks that have fundamental strength that are in rising price patterns leads us to our mantra. VectorVest believes in buying safe, undervalued stocks rising in price in rising markets. We also believe in selling falling stocks in falling markets. So let's unpack this a little bit. The VST system gets us to the buying safe, undervalued stocks rising in price. But we've added a little bit of information here in that we want to buy those stocks when the broad market is rising. And why do we want to do that? Well, we want to do that because market direction is actually the most important consideration when you're buying stocks. Market direction has more to do with your trading success than stock selection does. And if you think about it, when the broad market is rising, by definition, the majority of the stocks in that market must be rising, the good and the bad. So the probabilities of the stock that you selected rising are much improved. Conversely, when the market's falling, the majority of the stocks in that market must be falling, the good and the bad. So you may have a great stock, but simply because the market's pulling back, and I just asked you to think about recent history, good stocks get crushed just like any other stock. They may be more resilient, but still stocks are broadly falling when the broad market is falling. So doesn't it make sense that we would buy our stocks that we hope will go up when the market's rising instead of buying into a falling market? VectorVest, again, identifies with our market timing system when those conditions are present, when the market's rising. Again, actionable information that you can use to make better investing decisions. Now, the inverse is also applicable here, right? We also believe in selling falling stocks in falling markets. And here we're simply looking for the mirror image, right? So if I'm going to sell stocks, then I want to sell weak stocks. I want to sell stocks that are overvalued, have weak fundamentals, that are in downtrends, and sell those stocks when the market's falling. There's one last inference here, and I want to make sure that you got it. There are times that it's not a good idea to be buying stocks. Right? If we're going to be buying stocks when the market's rising, if it's not rising, we shouldn't be buying. When's the last time you heard somebody in the financial media say, you know what, market's kind of stinky right now, let's not buy anything? No, you turn on CNBC and there's this panel that has the bulls over here, the bears over here. They argue it out for 10 minutes. At the end of the segment, the moderator comes back in and says, so what are you buying? Right? So to Dr. DiLiddo's point, it's always buy, 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 buy. Well, VectorVest says, well, no, there are some times when it's more prudent to just sit in cash. Right? Cash is a position. Hold your money back. Don't put it at risk because conditions are not favorable for you to be successful. What a concept. All right, so that is our belief in buying safe, undervalued stocks in rising markets. What's the biggest mover of that market direction? Well, there's a couple things. First of all, at a very elementary level, it's people buying and selling stocks with volume driving prices, right? Okay, yeah, I get it. But when you go to the next level, there are actually macroeconomic forces that are driving those decisions. And as we go through this will probably ring a bell for you. So the first piece is earnings is the engine driving this bus. Now, from a market standpoint, when earnings are rising, market prices rise. And this is very easy to demonstrate. If we go into the program, and all I have to do is find my link for it. That's not it. Are you doing that for me? Yeah. All right, hang on a minute. My tech team is going to get me into the program. Appreciate that. Gives me a chance to take a sip of coffee. Not Cafe Bustelo this morning. What's that? Does it matter what account? No. So in the program now, I'm going to go to our graphing tab, and I'm going to open a market climate graph. So the market climate is where we house all of the macroeconomic data in the program. That data, by the way, feeds the algorithms within the program. I'm going to put on this graph the S&P index and the 50-day moving average of earnings for the component stocks of the S&P index. And I'm going to flip that around so that I get the S&P on the top graph. So first, a word about earnings. So VectorVest calculates earnings or measures earnings to include earnings forecasts by the industry analysts. And we include forecasts in our algorithm because investing is a forward-looking endeavor. So we want to keep track of the future prospects of the stock. So we include those future earnings prognostications by industry analysts in our number. But what I want to do is take this time frame and I want to stretch us out to something more like 20 years. I don't have enough mouse pad here. All right, now that's a little washed for me, but I'm going to hope that you can see it. And the key here is I want you to notice the correlation between the earnings performance and the market's price performance. The market is represented by the S&P 500. So it shouldn't take too much convincing for you to see the high correlation between the two. So we can easily demonstrate that earnings is driving or helps drive market price. Let me see if I can get back to our slide. So what about the inflation and interest rate aspects of our philosophy statement here? When the economy is strengthening, right, when the broad economy is strengthening, earnings go up, inflation goes up, interest rates go up. When the economy is falling, earnings, inflation, and interest rates fall. So when the economy is strengthening, earnings improve. That typically drives up stock prices. But also as the economy improves, people's buying power and demand increase. That gives companies pricing power, and so prices rise in that scenario. And so inflation is rising along with those earnings. The central bank is charged with monitoring and managing the economy so that it doesn't overheat and it doesn't go into recession. So they establish a benchmark, a target rate, if you will, for what they want inflation to be. And when the economy gets overheated, goes above that range, they step in to slow down the economy by raising interest rates. When they do that, they actually kind of plant the seeds of their own demise, right? And that by raising those interest rates, it slows the economy, and hopefully it slows it just a little bit. Earnings come down a little bit. They slow, but don't actually start falling. Inflation, right, that's the goal, slow it down. But it's not an exact science. And so sometimes we overshoot, and the raising of those interest rates actually turns the economy into contraction. Earnings actually start to fall. Inflation falls. And so the Fed, in order to stop the fall, turns from tightening, hawkish behavior, into dovish behavior, and they start stimulating. And so we have this cycle of economic factors driving earnings, driving stock prices, and inflation, the Fed stepping in to manage that whole process. So the Fed is a pretty heavy hitter in that nexus. So VectorVest closely tracks earnings, inflation, and interest rates in the economy because of their impact that they're going to have on markets. We do that in the climate section of the program. So hopefully off I go to the program again. Clay, if you can drive that for me, since I don't see an icon. And this time I'm off to the Views. Now the Views is our daily newsletter, printed Monday through Thursdays in abbreviated format, where we just give you timing and strategy guidance on a daily basis. But on Fridays, and I'm going to go back to last Friday because we haven't published yet today. On Fridays, we have a much more extensive publication. Let me get rid of the toolbar here. And so you see all the chapters that we have here in the Views. Well, I'm going to go down to the climate section. And we start with narrative about the macro indicators and what's happened this past week. But if I scroll down, you'll see a table where we identify those macro indicators and their current trends. So you see, particularly in the context of our conversation, we're tracking earnings, we're tracking inflation, and interest rates. You see the current level in our table, and then you see a weekly column for each of the indicators, and the values that you're seeing expressed in those cells are on a 0 to 2 scale. And this is a convention that we use in VectorVest, again, because we're trying to convey information, not just overwhelm you with numbers. So on a 0 to 2 scale, 1 is neutral. Values above 1 are favorable, values below 1 are unfavorable, from the context of an investor. So with inflation, with CPI inflation currently at 8.3%, right, it's unfavorable, so it's below 1, but notice that the score is actually improving. So inflation at 8.3%, while it's still high, is pulling back from its higher values, so it's getting less bad. That's another way of saying improving, I suppose. Interest rates, however, right, are doing what? Falling. They're getting worse. So a situation just from the raw numbers where we can see that inflation is moderating, interest rates, however, are still cooking, still rising. We take this information, and you can see if we scroll back up to the narrative that we had above, after we talk about the changes to those numbers from the week, you see narrative that says we currently have a case 3 bull market scenario in which earnings interest rates are rising while inflation is falling. And for the uninitiated, you're thinking, case 3 bull market, what is that? Well, fear not, my friend. We give you the reference. Let's jump to the Views to give you some more information. We're going to go back to an essay that Dr. DiLiddo wrote back on March 21st of '03. So let's take our Wayback Machines. I click on the year, I click the year again, and I get a date range. So now, a little faster to get back to '03. March, where did you go? 21st. And I need to go, because it was in his essay, I need to go back to the overview section to find that essay. And in that essay is a thing we call the truth chart. So let me set it up. First of all, you can see that we have earnings, inflation, and interest rate columns, right? Our 3 factors. And each of those factors have 2 conditions. They can be either up or they can be down. We also indicate their effect on prices. So we have the possible combinations of the indicators, and we've given a case number to each of those situations. So we have 4 up situations and 4 down situations for earnings, right? By the way, 4 up situations for price and 4 down situations for price. Do you notice how they correlate with earnings performance? That shouldn't surprise you based on the conversation we've just been having. So the setup here is the bull market begins as a transition out of the down market, right? So the market is falling, earnings are down, inflation is up, interest rates are down, prices are down. The bull market ends when, lo and behold, somebody makes money. right? Somebody actually has a profit and they have earnings power that comes with generating that profit. So the bull market begins. The Fed, that's been dovish, now turns back, pulls back from stimulating. The economy and the markets normalize, and we go into the Goldilocks scenario where the bull market thrives because earnings are up and inflation and interest rates are not. Right? So very little drag on the economy and on companies' earnings. We're going to skip case 3 right now. That's where we are. We see that it rarely happens. Case 4 is what more typically happens is as the economy heats up, inflation rears its ugly little head, the Fed tightens, and they start raising interest rates. We're still in uptrend, however. Prices are still up because earnings are still up, but you can see the writing on the wall that the Fed has stepped in and that's going to have impact. So how do we get to case 3? Well, we have a case 3 that inflation has actually started to slow, but the Fed has not. Right? So it rarely happens because the Fed rarely tightens into a slowing economy. But that's where we are now because we got a little bit out of hand. We're behind the 8 ball and we're trying to pull back inflation from that 8% threshold back to their target, which we'll see if they make some adjustments. Right? But if they think they want to be in that 2% range, there's a way to go. So in stage 4, we call this climbing the wall of worry. Right? We're in the late stages of the bull market, which can last for quite some time, by the way. But we're dancing, I was going to say dancing with the devil. That's not the right way to say it. But we're approaching the top of the market. Right? So everybody's getting nervous about how much further can this go. And we're all very sensitive to any kind of news that companies say, oh, by the way, we didn't make money or we don't expect to make money into next quarter. That's kind of the telltale sign we're looking for. And FedEx was last week, came out with very weak guidance, right? And the market got crushed. So one company does not an economy make, right? But as the bear market begins, inflation is high, the Fed is tightening, prices are moving down. As it develops, right, the market continues to slow, bear market prevails, we're easing now, inflation is falling, interest rates are coming down because we're trying to stimulate, but the market doesn't care, we just keep moving lower until we get to our bottoming threshold and we just reset and do it all over again. Rinse and repeat, right? That's the market cycle. So where are we now? Right? Remember, one of our theses here is you can come up with a narrative, but we want to come back and check that narrative with the facts. So let's take a look at where we are now. If I come back to my climate graph, and instead of looking at 20 years, let's just look at a year. Where are we now? Well, the market peaked, the S&P peaked in January, the broad market peaked, our VVC peaked in November. What was happening in December? Well, remember we were having this argument about whether or not inflation was transitory or sticky. Well, in December, the Fed decided, well, at 9%, it looks like it's sticky. So we're going to start defending. Right? We're going to start raising interest rates. The market's been to this rodeo before. The market starts saying, well, I'm not fighting the Fed. Prices start to drop as we start repricing in this new environment of higher inflation and interest rates. What happened to the company's ability to make money? Well, that didn't change. The companies are still improving their earnings, at least the companies that are the component of the S&P 500. They're still making money. Earnings are still moving higher, but at a slower rate. Notice the change in slope from this part of the graph to this part of the graph. So earnings start slowing, and now we've actually started pulling back. But how would you characterize that trend? Right? We're off the highs, But are we dropping? Well, no, we're actually kind of hanging in there, right? So depending on how you define the trend, from a one-year basis or longer, we're still up, but weakening. If you wanted to measure the trend in 2 months, you'd have to say we're down. But we analyze the trend using our earnings trend indicator tool, again on that 0 to 2 scale. And let me back this up a little bit. As long as the earnings trend indicator is above 1, then that trend analysis tells us that we're still in uptrend. A weakening uptrend, to be sure, as the slope is pulling back, but still an uptrend. And so that's how we're in a case 3 bull scenario, because the trend has not yet turned to down. So what has to happen for that trend to cross from above 1 to below 1? Well, the earnings have to actually start falling. So keep an eye on earnings, and that's why particularly this earnings reporting season, and probably next quarters as well, are going to be very important for us to see who wins this foot race. Are companies able to manage their way through this economy? Do we get our soft landing? Or does the market continue, the economy continue to deteriorate and throw the market into bear trend? But right now we see weakness developing, right? So we ought to be changing strategically our outlook to being something much more cautious. Our market timing signals are the tactical tools we use to say, oh, hey, wait a minute. The market is moving against me. So those signals move much more quickly than does our trend analysis, right? So think of the earnings trend analysis, the case scenarios as strategic, the market timing signals as tactical. So that's how we use data to analyze market conditions and map our way through the different economies and the different cycling of the economies, right? It's earnings, inflation, and interest rates that are driving the system. Well, this is true at the stock level too, right? Stocks improve their value. Companies improve their value by making money, by making more and more money over time, right? So when their earnings improve, their valuation goes up, and that typically commands a higher price. Inflation and interest rates, while they have macro impact, they also have local impact in the company too. When inflation and interest rates are high and rising, $1 of earnings that you made when inflation is with 2% is much different than $1 of earnings you made when it's at 9%. So companies struggle more when you're in that high inflation and interest rate environment because their costs are going up, but so are the costs of their customers, right? So their business slows in that kind of environment. So we want to look and keep in mind both levels, what's going on in the economy and how is it impacting the individual stocks that we're investing in. Well, of course, part of the theme of this presentation today is that VectorVest measures and maps all of this for us every day, intraday. So it gives us actionable information that we can use to make better investing decisions. And we'll next turn the corner so that we can see how those analysis tools apply at the stock level. All right, but first let's go back to Ray and we'll introduce our next speaker.
Thank you, Todd. That was a great presentation on the philosophy of the VectorVest system. These are the concepts that we follow day in, day out. So everything you're going to learn about today, everything you will see, will fall under this overarching category of what our philosophy is. Next, we're going to have a great presentation, and we're going to go to Mr. Glenn Tompkins in a moment. But before we get there, I want to address just a couple of things. There's been a lot of questions coming in about the recordings of this video. How long will it be available for? Well, we're going to leave it up on YouTube at least until November 30th. Okay, so you have plenty of time to watch the video, to understand exactly what we're talking about and do the replays. And if you want access to the slides, the incomplete slide deck for all of today's presentations, just simply go to www.vectorvest.com/MC slides. So that is vectorvest.com/MC slides, and you can download all of the slides for every presentation. Okay, so next we're gonna move into the next layer, and we're gonna keep layering concepts on top of each other throughout the entire day, so that those of you who are brand new and seeing VectorVest for the first time, you're gonna have a complete understanding of the system by the end of the day. So next we're gonna go over to Mr. Glenn Tompkins. He's our senior instructor. He's a friend to most of you. You see him on YouTube all of the time, and he's gonna give us a talk on the VectorVest system of analyzing and ranking stocks. Take it away, Glenn.
Good morning, VV Nation. Glad to be here. My name is Glenn Tompkins, senior instructor here at VectorVest, and you know that I'm a lot on this channel. So, first off, let's get VV Nation up and running. If you are a subscriber to the VectorVest software, click a 1. If you're not a subscriber to the VectorVest software as of yet, click a 2. Now, for those people who are clicking on number 2, listen, we're not going to try to hard sell you anything. We're going to let the software do the work because it's just that good. If you are not a subscriber to the channel, I invite you right now to hit the subscribe button, because what you're seeing here is a big event, right? That's what we've got going on. But on our channel, we put a lot of good content, a lot of great information about what's pertinent to the market to keep you abreast on making the best decisions utilizing the VectorVest system. As Todd talked about, and as Dr. DiLiddo has talked about, the founder of the company, this is a lot of common sense. And a lot of us incorporate what we think, what we feel into our investing. And time again, the market has a way of humbling you each and every time. There's a difference between just data and information. And as Dr. DiLiddo talked about, the information that we have here is mathematical. It takes the emotion out of the market. Now, how many of you, whether you're a subscriber or not, how many of you still struggle with making the best decisions on the stocks that you buy? Type a me in the room. I'm curious to know, because a lot of you who are subscribers tend to go your own path, and then you stray away from what VectorVest provides for you, and you get yourself caught in a quagmire of hurt each and every time. And every time the market goes down, people are nervous, people are afraid, and people leave. Folks, this is not the time to leave. This is the time where you need a system like VectorVest that's been around for as long as it has, to prepare you for when to get back into the market. So you know something? Cash is a position. If you're not comfortable with the current market conditions right now, cash is a position. But there's many of you who are a little bit more aggressive. You still want to take advantage of all the bumps and wiggles in the market and in stocks, and you can still trade that. But that's not for everybody. All right? So big. This is not the time to be running away from the market. This is a time to come and snuggle up to the market with the helpful guidance of VectorVest to help you to make the right decisions at the right time. All right, if you haven't already, hit that like button, especially if you feel that the information that we're providing for you today is useful. Remember, it's all about you on this channel, and VV Nation, you've made this channel what it is, and we are thankful for that. And we're going to continue to provide you with the information based on the philosophies of what the VectorVest system has to provide for you to help you to always make the right decisions at the right time. All right, so the next talk we're going to get into is the VectorVest system of analyzing and ranking stocks. Now, why is that important? Because you know that there's people on TV, you got your next door neighbor, you got your dentist when you're sitting in the chair, and he's saying, so, I got a stock pick for you. Yeah. All of those people are out there to give you stock picks. But how about you take those stock picks and not blindly buy into them, and use our way of analyzing stocks so that you have a head start on what's really going on with those stocks. Because in the book that Dr. DiLiddo wrote, Stock Strategies and Common Sense, the key words there are common sense. All right? Common sense. Why not put to the forefront of your investing the best information that makes sense, and not buying stocks by what you think, by what you feel, but what's there for you to give you the right information. You know something? That's what it's all about. All right, so when you're looking and thinking about common sense, it's the idea of truth versus fiction. Truth versus fiction. Which side would you rather be on? I would say you want to be on the side of truth. And sometimes when we analyze a stock that we think is the best stock since sliced bread, the VectorVest system has a way of going, not so fast, my friend. And a lot of times we don't want to hear that. And because we don't want to hear that, we ignore the information. Not the data, but the information. And again, it puts us into a world of hurt. We need to keep you from recovering and keep you on a path to building. And that's what this is going to help you with in regards to ranking stocks. So, VectorVest believes every investor should know what a stock is really worth, how safe it is, and when to buy, sell, or hold. Todd covered this. He covered it in great detail. So, in regards to what your stock is worth, we want you to be in undervalued stocks. How do you value a stock? We're going to talk about that. How safe it is. How consistently does the company meet or exceed earnings expectations quarter over quarter, year over year? Why? Because earnings is the engine that drives the stock's price higher. When to buy, sell, or hold. You know how many times I hear, hey, Glenn, like what you do. What do you think I should do with Tesla? What do you think I should do with Apple? Well, we have in this system buy, hold, and sell recommendations. You never have to ask anybody that question. And if you're asking that question, it's because you're thinking with your heart. You think the stock is going to go up, and you don't want to get rid of it. Let the information supersede that and say, you know something? There's a bad time to be in a good stock. That's useful information when analyzing stocks. This information is, you can't get anywhere else because it's proprietary, but we give you as much information as we can behind these stocks to let you know what's going on and how to use it. Now, what's your stock really worth? Well, value is computed by VectorVest, and it tells you what your stock is currently worth based upon a couple of things. Earnings and earnings growth rate. Why? Earnings is the engine, and if the earnings are good, what's the rate that they're growing their earnings going forward? Our earnings is forecasted 12 months out. So it gives you more than just what the current earnings are. It tells you what the current earnings or what the earnings should look like a year from now. That way you can determine, wow, that stock's got great potential to grow in its earnings over the next year. I like that stock. It's also based on profitability, inflation, and interest rates. Well, we're going to get into inflation and interest rates in a second because those are one of the, couple of the three main movers of the market. If a price is less than value, a stock is considered to be undervalued. That's where we would like you to be. But a lot of companies right now are overvalued. Does that mean you don't buy those stocks? No, that just means that people are willing to pay more than what the stock is worth. All right, but now there's other things to look at besides that in regards to, is this a stock that we want to get into? And when a price is more than value, you're paying a premium. All right, so when a stock is over its value, I misspoke. If a price is less than value, a stock is considered to be undervalued. But when it's overvalued, you're paying a premium. You're paying more to own it. Well, that's because a lot of people are jumping on board because they feel the same thing too. All right, now, what your stock is really worth. We're going to look at two stocks in this presentation. LNG, and this is as of 8/22 of 2022. Don't worry about the date because we're going to do some now analysis as well. All right. Cheniere Energy, LNG, carries a price of $165.24 with a value of $220. That's what you consider to be an undervalued stock. Normally on an undervalued stock over the next 1 to 3 years, price should rise to meet value. That's why we want you in undervalued stock. It's got potential to rise. Now, when you're in an overvalued stock, people who are willing to pay a premium to own the stock, normally over the next 1 to 3 years, the stock's price should fall to meet value. Thus, the reason why we want you to be in undervalued stocks, you should be favoring buying those types of stocks. So we put a value on every stock. It is an intrinsic worth on every stock. So before you buy it, you have the wherewithal to know if the stock is currently under or over its value. Again, we favor you buying into undervalued stocks. Now we look at its upside potential. Now we get into our proprietary indicators. These indicators are all cast on a scale between 0 and 2, and we make it extremely simple to understand. If the indicator is above the value of 1, it's favorable. If it's below the value of 1, it's unfavorable. I don't think you can get any easier than that. And then when you look at a stock that's just at the cusp and you say, well, listen, it is what it is. Maybe you wait for that indicator to get above the value of 1 before you pull the trigger on it. That's the useful information. Not just, hey, go buy. Oh, what do you think? I should buy it. Oh, why? We don't want all of that. You know what that's called? Noise. What you need to do is keep your heads off the swivel and focus on the information that's going to help you make money and grow your portfolio. Relative value looks at the future. It compares price and value. It takes a stock's risk and earnings growth into account and indicates the investment's potential of a stock compared to a similar investment in AAA corporate bonds. You buy into a bond, after it matures, you get your money back with a small little interest rate on it. Is the stock's ability to make money, is it going to outpace that AAA corporate bond? Is it going, and in this case, we're looking at the AAA corporate bond as the market. Will it outperform the market? And that's important information before you go buying into a stock. You want to make sure that the stock's relative value is above 1. Now, the higher above 1 it is, the higher the potential that the stock should outperform that AAA corporate bond. All right, so as we look at that, Cheniere has an RV rating of 1.83. Well, we know right off the bat, it's above the value of 1. At 1.83, the stock should outperform that AAA corporate bond by 83%. Whew. So if I'm looking at a stock that's got an RV that high, I feel a little bit more comfortable long-term being in that stock. The upside potential of that stock is definitely there. Now, the other stock that we're going to look at, and I didn't talk about it on the other slide, was Beyond Meat. BYND, it's got a relative value of 0.08. Whew. Well, is that stock a good stock? Now, you'll hear on TV, you'll see a news article, hey, something happened with Beyond Meat, it's going to explode. And you go out and go, yeah, I'm going to buy that stock because it's going to explode. Long term, the information that you get from the VectorVest system says, oh, not so fast, my friend. I don't think it's going to go. And remember, this is mathematical. It's not what the people on TV are saying. It's not what a news article is saying. It's not what Joe the plumber down the street is saying. It's none of that. It's all mathematically based. That tells me from a system-oriented program or looking at these indicators, that doesn't have good upside potential. Cheniere Energy has a far better upside potential over the long term. The long term. So if I'm looking at stocks and I'm trying to hold a little longer, RV plays a major role in that. Does it have good upside potential? Now, I'm a fan of Apple, love Apple, but you know something? I also know that there's a bad time to buy into a good quality stock. And I'm going to use these indicators. And even if RV is above 1, when I look at a graph, is it falling? That's information. That's useful information. And it's designed to help you to make a better decision in the stock. Because how many times, type of me in the room, how many times have you been in a stock, not done the analysis, and the stock falls off the face of the earth, and you say, what happened? Type of me in the room if you've been in that situation. And you sit back and go, what happened? Now you have VectorVest. You look and you go back to the time where you went and bought that stock. You saw that the indicators in VectorVest were telling you that they were falling. And that's when you sit back and go, man, I wish I had VectorVest back then. Because now you're in a state of recovery, not in a state of growing. We always want to keep you in a state of growing, and the talks that we have for you today will set you on the path to be on the way of growing and not always having to recover. How many of you sit back sometimes and go, I'm tired of recovering? Type of 1 in the room. How many of you feel that you're tired of recovering? You're tired of working twice as hard to make up what you lost on the stock? Folks, that's real world stuff right there. And I think a lot of you can relate to that. But this is why these indicators were created. Dr. DiLiddo saw the need for these indicators, and he put them out there for you guys. He wanted to touch all the investors that he possibly could in regards to making better decisions that he made before he made this. He was in that hurt locker. He was in that quagmire of what's going on. But he sat down and put together a system to help you make decisions so that you, especially if you're brand new out there, so that you don't have to go through what many other investors have because they didn't have a system like VectorVest. That's what this is all about. All right, let's go to the next indicator. How safe are your stocks? Todd did a great part of his presentation on explaining just how important safety is. It's an indicator of risk. How many of you don't want to take a bunch of risk in your stocks? Relative safety is ideally suited for you. You're going to find that these indicators are suited to you no matter what type of investor you are. Whether you're an aggressive investor, a midterm or swing trader, whether you're a longer term investor, we have an indicator to help define the stocks that fit your investment style. Folks, we track over 9,000 stocks in the system. Folks, that's enough to help any of you out there. But knowing what these indicators are all about is ideally suited to help you to make those decisions. It's computed from an analysis of the consistency and predictability of a company's financial performance. Debt to equity, sales, business longevity, and that's big. Business longevity, price, volatility, and other factors. Folks, there's a lot of stuff. And a lot of people always ask me, well, do you have debt to equity? Do you have price to book? Do you have a lot of those indicators? A lot of that data is tied up into this information. All of that financial stuff that you could be looking at and poring over for hours can be easily discerned on if this indicator is above 1 or below 1. Now, I'm not trying to say that investing is just that easy. It takes work. But if you want to have an opportunity to shave off a lot of hours of research, that's what this system will do. How much is your time worth? And if VectorVest can save you time on analyzing and ranking your stocks, is it worth it? Think about that. Now, that's an internal question. That's a rhetorical question. But if you sit back and go, I got you. I want you to keep listening because this information is for you. If you're sitting back having to second guess a little bit of what you're currently doing, if you want to take that investing to the next level, that's what these indicators will do. Now let's go look at those same stocks. Cheniere, it's got a relative safety of 1.37. It's favorable. This company consistently meets or exceeds its earnings expectations quarter over quarter, year over year. That's what you want, right? Beyond Meat, on the other hand, remember, this is that hot stock that's on the news and everybody's telling you got to go buy it because they got a new contract with Arby's. So you're going to have Beyond Meat roast beef. I'm just making that up. I don't know if anybody wants to eat Beyond Meat roast beef. If it ain't meat, it ain't meat. That's just me personally. But look at that relative safety at 0.51. This company doesn't always meet or exceed its earnings expectations. And knowing that earnings is the engine that drives a stock price or a market higher, So if you go buy the stock and you say, Joe Schmo on TV was saying that this was coming out with it and this was coming out with it and this is coming out with it, and you go, fine, I'm going to go buy that because Joe Schmo said it's okay. And he gave me and argued the point why it is. And then when the stock misses earnings on consistent quarters, hey, Joe, what happened? Well, that's the difference between data and information. And VectorVest is out there to provide you with the information. An investment in Cheniere Energy carries far less risk than a similar investment in Beyond Meat. And the cool thing about this is no matter how expensive or cheap the stock's price is, these indicators bode well on the individual stock to help you to make an individual decision, whether the stock's $1 or $100. These indicators will put them in place to let you know what's going on. Are your stocks rising in price? Oh, in the current market conditions, a lot of stocks are not rising in price. You know why? Because the market's direction affects about 80% of the stocks in the market, number one. Number two, from a market timing perspective, it's not a great time to be buying stocks. Can you still find that extra 20% that's going against the trend of the market? Absolutely. Do you want to do that? Some of you might say yes. We'll help you with that. But most of you are going to say no. And I understand that. But when we look at relative timing, is the stock going up in price? It's looking at the analysis of the direction, the magnitude, and the dynamics of a stock's price movement over 4 time periods. A lot of people ask, well, how do you determine RT? We look at day over day, week over week, quarter over quarter, and year over year, and we put the most emphasis on quarter over quarter. Why? What happens every quarter on the stock? Earnings. Why is that important? Earnings is the engine that drives the stock's price higher. So we look at 4 time periods to dictate or to tell you where RT is. And if it's above 1, the stock's in an uptrend. Now look at this. If a trend dissipates, RT will gravitate towards 1. Can that help you with when to get out of a stock if you've taken a profit? Absolutely. If I'm in a stock and I'm up 10, 15, 20% and I start to watch on an end of day basis, RT starting to fall, that uptrend is waning. Would that be a good time to start to think about taking some of those profits off the table? How many of you buy into a stock, it goes up 30%, and by the time you get out of it, you've up only 5% or you've taken a loss? Type a 2 in the room. This helps you to keep that from happening. If I can see, if it tracks the direction, the magnitude, and dynamics, if I start to see it wane and fall, and I still have a gain, don't be afraid to take that off the table. But that's information. A lot of you will just see the stock fall without the VectorVest system, will see the stock fall and go, it's all right, it'll recover. Oh, it's fine. And then it goes down, I think it's fine. And then it goes down some more and you go, crap, it wasn't fine. And then you've got to make that hard decision. When do I get out of the stock? Well, everybody should have some semblance of a line in the sand before you get into any stock. We have a line in the sand for you on every stock. We're going to get to that in a second. Favor buying stocks whose RT is more than 1 and rising, because that tells you that the stock is definitely in a uptrend. All right, now let's put all of this together. Well, before we put it all together, Cheniere has an RT of 1.37. There's that Beyond Meat again. That's hitting the news. Oh man, you got to go buy the stock, folks, because it's got this, that, and the other thing going. That's the information that you need to make the better decision. Beyond Meat's got an RT rating of 0.66. Stock's in a downtrend. The more below 1 it is, the faster in the downtrend it is. The higher above 1 it is, the faster in an uptrend it is. Cheniere Energy is rising in price, while Beyond Meat is falling in price. Kind of interesting, right? We talk about we want you to be in safe, undervalued stocks that are rising in price. Guess what? I just gave you those indicators. Safe, relative safety. Undervalued stocks, we give a value for every stock. Is that stock undervalued? That's rising in price. RT will help you with that. Folks, you want to stay with the mantra? When you look at these indicators, are they on any stock you're looking at? Is it safe? Is it undervalued? Is it rising in price? We've got it all there for you. If that's the mantra, you can stick to the stocks that meet that mantra at any point in time, folks. That's the power of the VectorVest system to help you to make the right decisions. Folks, that really does become common sense. There's no guessing here. There's no input from me here. There's no emotion from me here. It is the power of the system to help you to make the right decision. Now again, many of you will look at these indicators, I think that, I heard this news that this was getting ready to go on. VectorVest is wrong. How many of you ever thought that with the system, only to find that the system was doing exactly what it was supposed to do and could have saved your bacon? Type of 1 in the room. Well, I know there's a lot of people out there, if you want to be honest with yourself, that have been in that situation. Oh, the VectorVest system doesn't know what it's talking about. And then when you look back, you sit back and go, holy smokes, if only I had listened. Oh yeah, I hear that more times than I'd like to. But that's why we do things like this. So that even if you're not doing these things now and you know you should, we're bringing you back to the table. We're taking you from that recovery path and putting you on the growing path. Folks, we can only bring you to the path. We can't make you walk the walk. We're going to talk the talk. But it's up to you to walk the walk. That's all we can do. And that's why it's important to know what these indicators are so that you can incorporate them into your buying decisions. Now, let's take all three and put them together in the master indicator. Do you own stocks with good combinations of value, safety, and timing? Value, safety, and timing, that is our VST vector. That is what we were named after. It's computed from the square root of the weighted sum of the squares of RV, RS, RT. Don't ask me anything more about that than that, because it's math. I can get past 1 + 1 is 2. But it's the square root of the weighted sum of the squares of these indicators. Stocks with the highest VST ratings have the best combinations of value, safety, and timing. Now, I keep getting asked this question. Does that mean it's the best stock in your database? It means it's the stocks with the best combination of value, safety, and timing. And now you know how important those indicators are. So now these stocks represent the cream of the creme, the good stuff of what those stocks are by VST. Okay? Stocks with the highest VST ratings have the best combination of value, safety, and timing. Favor buying stocks whose VST are more than 1. Still looking at these two stocks. LNG's got a VST of 1.51. Notice that LNG was the best of all worlds. Beyond Meat had a VST of 0.24. Beyond Meat was the worst of both worlds. But somebody on TV is telling you go buy it. That's blah, blah, blah. This is the information that you need to make the better buying decisions. Cheniere Energy has a much better combination of value, safety, and timing. All right. Remember I told you there was a hard line in the sand for every stock? It's called the VectorVest stop price. The stop price is computed from a 13-week moving average of closing prices. And here's the other part of it. A lot of people think, well, I'll just go put a 13-week moving average on a stock. I get the stop price. Oh, no. It's fine-tuned according to the stock's fundamentals. Well, which indicators are the stock's fundamentals? Relative value and relative safety. See, I didn't take that when it came down to VST. Because when I look at the overall VST, we are using a combination of fundamental analysis with the insight of technical analysis. The RT is the technical indicator. So you're getting a well-rounded picture of that stock before you buy it, looking at the fundamentals and the technicals. So when I'm looking at the stop price, though, I'm strictly concentrating on the fundamentals, RV and RS. What does that mean? Well, if the stock is fundamentally sound, we're going to lower the stop price to keep you in it longer. If the stock is not fundamentally sound, we're going to get you out of that stock faster by raising the stop price. Oh yeah, every stock in the database has a hard line in the sand. Now it's more of a conservative stop. But a lot of people out there are a little bit more conservative in the market for the most part. Not everybody. could be somewhere between prudent and conservative. That stop is ideally suited for you. Again, I get the question, well, should I hold on to that stock? Well, a stock is going to get a buy, hold, or sell recommendation, which we'll talk about in a second. But if a stock goes below the stop price, that 13-week moving average adjusted for the fundamentals, if it goes below that stop price, the stock will automatically get a sell recommendation. Well, I don't want to sell it. Don't. Whose fault is it if it continues to go down and you take a bigger loss? Oh, no. I'm not trying to be cocky. I'm trying to show you the importance behind the information that you receive as a VectorVest subscriber. You hold on to that sell recommendation stock at your own detriment. And when it goes down, because we don't know how low is low on any stock, and you sit back and go, wow, there's another one of those times, I wish I would have listened. Our stock price can be treated as gospel or guide. That's something that Steve Chappell has taught me for the longest time. And I'm sure he learned it from Dr. DiLiddo. I'm assuming. Gospel or guide. Gospel is, if it falls below the stop price, it's a sell, I'm getting out. Guide, well, it's a sell, but I'm willing to give it a little bit more room. Understand that you made that decision. And you have to be and will be accountable for that decision, depending on what that stock's price is. It's up to you. All right. Price stop comparison. Because the stock is fundamentally sound, LNG carries a price of 165 and a stop of 141. Notice how further down it is on LNG to get out of that stock if you're using it as gospel. Notice that Beyond Meat has a price of 27.06 and a stop price of 27.24. Ooh, it's below that price. Because the stock wasn't fundamentally sound, we raised that price and got you out faster. Now it's a sell. You don't need to be in it. Oh, but no, Joe Schmo told you you got to go buy it. Well, Joe, stock doesn't have any fundamentals. Stock's not going up in price. Stock's a sell. Even if you think it does have some upside, wait for a better opportunity. Wait for these indicators to improve before you pull the trigger on those stocks. Cheniere Energy has a much better combination of value, safety, and timing. The bottom line, all factors are considered in making buy, sell, hold recommendations because there's three ways a stock can go. It could be a buy, it could be a sell, or it could be a hold. We'll start with the sell first. The price is below the stop price. That's the easiest way to know stock's below the stop price, the stock's a sell. Now, let's talk about how a stock gets to be a buy. It takes four things to happen. One, the price has to be above the stop price. That 13-week moving average adjusted for the fundamentals. Two, VST has got to be above 1. The full complement of indicators has to be above 1. RT, stock's got to be rising. Stock's got to be, RT's got to be above 1. And the price has to be moving away from the stop price. It takes a stock a lot of work to get a buy recommendation. When you see a stock in the system that's got a buy recommendations, it's not because we're sitting in a little secret room determining whether or not we want to give this stock a buy. It's got to meet criteria in order to get a buy recommendation. And then hold, if any of the other, if the stock doesn't have all four of those things happening at the same time, the stock will be a hold. The price is still above the stop price, but any of the other three factors needed to receive a buy are not met. That's why we have as many hold recommendations in the system that we do at any given time. People always ask, why do you have so many hold? Because they don't meet the full criteria to be a buy or to be a sell. All right? Cheniere Energy has been a buy since 7/21. Beyond Meat has been a sell or a hold since 3/18. So what do you do with a hold recommendation? Well, you do just what the name says. You hold it. And see if it continues to go down, or if it continues to go down, especially if you're looking at RT, make a decision, especially if you're up in the stock. All right? Now, this is where we start to get into the software. The stock viewer is your entrance into the VectorVest. It's an enormous spreadsheet of all of the VectorVest indicators and parameters. So we just went over all of the indicators, right? So I'm going to bring this up here. It's an enormous spreadsheet of all of the stocks that we have. We track a lot of stocks. Let's get into the software. And I'm going to create a watch list in here. All right, no, I'm not going to do that yet. Let's go to the Viewers tab. Let's go to the Stock Viewer. Here's our enormous spreadsheet. Now, Dr. DiLiddo wrote an essay back in 2006, 11/10 of 2006. Let's do that real quick. Let's go to the Views tab. Let's go to 2006. Hit here again. 2006, November 10th, which happens to have been the Marine Corps birthday. Click on OK. How I use the stock viewer. I invite everybody in this room, if you have a subscription to the software, to go back and read this. Not only that, I would say print this. You probably have heard the story about a guy who was called in by the IRS to have his tax return audited, showed up to the IRS office. He carried in 2 large shopping bags of check stubs, receipts, and stuff, and dumped them on the auditor's desk. Here, he said, figure it out. A lot of the market is designed to do a data dump on you. But within the VectorVest system, by utilizing these indicators, you have a way to sift through that data to find the stocks that fit for you. So I'm not going to go through all of it, but Dr. DiLiddo says the stock viewer is a gold mine. And it is. Who doesn't like mining for gold? 9,000 stocks to be able to sift through and find the gold within and extract it. Dr. DiLiddo in this essay talked about using earnings per share, why it's the engine that drives the stock's price higher. He looked at another indicator that we hadn't talked about today called CI. It's another technical indicator. It's the comfort index, and it looks at price growth persistence. Stocks that have the ability to keep moving up and up in price. We got an indicator for that. Also casts on that scale between 0 and 2, where above 1 is favorable. The stocks that have a CI above 1 are stocks that consistently move up. He also likes to look at the big boys by looking at the dollar change. He also likes to look at, from a more aggressive perspective, which stocks have gone up the most that day. So I invite you to go and take a look at that essay. And again, I would love for you to print it and go through how Dr. DiLiddo uses the stock viewer. I'm going to go back to the stock viewer, and I'm going to look at a couple of things here. All right, remember, we tracked over 9,000 stocks. For exactly, we tracked 9,164 stocks. The first thing you'll see is that this list is sorted by VST. So the stocks that have the best combination of value, safety, and timing already come to the list. How cool is that? Out of 9,000 stocks, to show you the stocks that have the best combination at your fingertips. Woo! How much time did that take you? Remember, how much is your time worth? Does this prove useful to you? Instead of looking through all of the stocks to see which stocks have the best combination, I can go through and look at the stocks that meet my pricing criteria. Maybe I'm looking at less than $10 stocks. Do I have some VST stocks that are less than $10? We can sift through that. Maybe the $20 to $50 range. Whatever it is, we can do that. Now, keep in mind that the market overall is down, right? Even though these are the best combinations of value, safety, and timing, you also know that some contras are up in here as well, which means the system is doing exactly what it's supposed to do to help you to find the best stocks to get into, even right now. Folks, when I say that this is not the time to run because the market is moving down, I ain't just whistling Dixie. The system is going to provide for you, whether it's bullish or bearish stocks, what's the best for you to get into. And now that these contras are moving, it's putting to the forefront of the top VST stocks that way to take advantage of the market as well. How easy is that? That's useful information, folks. You're not using emotion to find these stocks. All right, fine. Let's say you're looking for the safest stocks in the database. Well, we can sort from this viewer right on safety. Relative safety, boom. These are the stocks that consistently meet or exceed their earnings expectations quarter over quarter, year over year. This is the engine that drives the stock's price higher. Now, a couple of these stocks are sell recommendations. Why would I want to buy those? Well, understand that the market is still moving down. Even the safest stocks will exhibit some pullback. Maybe I just concentrate on the holds or the buys. But do you want to go against the trend of the market? So when the market's good, you sort by these indicators. Or if you say, no, I still want to be in the market, but I want to find the stocks that are the safest stocks, can you do that? I'm still going to say you don't want to bet against market timing. We're going to talk about that later this afternoon. But that's important. Yeah, I can bring out the stocks that have the highest relative safety. I can bring up the stocks that have the best potential to outperform the market. Those are those growth plays or those value plays. Yeah, they're getting hurt. That's why market timing is so important. Let's go look at the stocks that have the most, that are moving up the fastest. Wow. Look at these stocks. Look at these relative timings. Way up there. Look at this. Got a contra up in here. I got a contra up in here. I got a couple of contra. I got another contra. I got another contra. Those are the fastest moving stocks in the database. We're doing the work for you. You know what we're like? And I love using this analogy. We're like the Dow scrubbing bubbles. We work hard so you don't have to. These indicators are going to bring to the forefront, and you know something? They may bring up stocks that you don't even know about. That's okay. If they're doing what they're supposed to do, you might be introduced or exposed to a stock that you don't even know about, but the indicators say it's okay. I know that this stock beat is moving because on YouTube, it was either yesterday, it was trending Thursday, I talked about some news on the stock. A lot of these stocks that have RTs above 1 could be news driven. But look at the stocks, look at the graphs to determine if they have some more upside potential. All right, big move back after the move up yesterday. That's probably some profit taking. That's going to happen with some of these RT stocks. Remember, market's direction is important. All right, so now we let's go look at earnings per share. Stocks that have the biggest earnings per share, they're going to be some more expensive stocks. But remember, these are the stocks that have the ability to meet earnings per share, high earnings. These companies make money. These companies make money. All right, and it's something that you want to consider as you go through the treasure trove of looking through the stock viewer. All right, so in the stock viewer, we talked about these indicators. We've now been able to sort the list by these indicators. Again, this indicator in the view is called CI. Again, stocks with high CI are stocks that consistently grow higher. Stock growth, price growth persistence. Stocks that just keep moving up. Is that something that you want to feel, that you want to get into? But keep in mind the market's direction. All right? I'm always going to put that out there. Market timing is paramount. All right, we're going to do one last thing before we go. All right, we're going to build a watch list. Watch list viewer all. I'm going to create one for today called new group. We're going to call this masterclass. So anybody that's giving a presentation today that needs to use this watch list, we're going to call it masterclass 2022. All right, so I've created a new group. Within this group, I can create a new watch list by simply clicking on new watch list. Boom. Let's bring this over. And let's call this my stocks. And I'm going to build a watch list of stocks that many of you might or might not have. These are going to be names that you know. All right, these are going to be names that you know. Sigh. We had the stock that was put into the slides, LNG. Simply when you put it and build a watch list, type in the symbol, separated by a comma, INSW, shipping company, comma, CPRX, drug company, sigh, comma, BTU, another energy company, comma, ARLP, a coal company, comma, CLFD, comma, CEIX, comma, Apple. You know if I'm up here, Apple's going to be in the list. If you know that, type a 1 in the room. Apple, Adobe, tech stock, and Ford. So now when I open it up, let's say this is a listing of your stocks. This is something that everyone should do. If you're an existing customer, you should have done this long time ago. And if you didn't, you need to do it now. If you're brand new and you're taking the trial, you need to do this to see where you stand right now. Take the ambiguity out of what you're doing. This is information. This takes this and this out of the equation. Now you look at this and you say, well, I don't like that, what they say about my stock. Get over it. We're not designed to tell you what you want to hear. We're designed to tell you what you need to hear. That's the difference between data and information. Listening to the talking heads on TV and having a system designed to help you get off the road of recovery and back on the road of growth. Folks, that's common sense. And many of you sit out there and you're looking at, well, Glenn says that Apple's a great stock. Absolutely. Not now. Who's to say that I can't wait for the stock to come to me instead of buying it and holding it on the way down? Now, there's some savvy people out there that have Apple a long time, but you're playing defensive measures on it. You can do that. But not everybody is that savvy. Those three stocks at the bottom, Adobe, Apple, Ford, all have sell recommendations. They may have some good upside, excuse me, and actually two of them are fundamentally sound. That's the information. They're in downtrends. Sometimes it's a bad time to be in a good stock. You gotta listen to that and adhere to that. Because no, it's good, it's sell, I'm taking a loss, but I know it's gonna come back. Do you wanna double the move to get back to where you were? Or wait for a better buying opportunity when the time is right? A lot of you want to catch the falling knife. A lot of you want a dollar cost average down. Ooh, Doc don't like that. It's like trying to catch a falling knife. How low is low? Do you want to keep taking a hit in that stock? It's on you. The stocks at the top of the list, they're doing exactly what you wanted them to do. They're buys. But you know something? Keep your eyes on these RTs. Are they starting to fall? That could be a good opportunity for you to take the profits off the table to make sure you lock in profits at the right time. The ones that are holds, one of it's fundamentally sound, ARLP, and it's got RT above 1, but it doesn't meet all the criteria to be a buy recommendation, and neither does CEIX. Folks, if you haven't done it already as a subscriber, you need to. If you're brand new and you're signing up for that trial, do this first. Todd did a great job of telling you the philosophy. Why we are what we are and who we are. This is the next step. Analyze your stocks so that you know what to do and at the right time. One thing we do need to read the graphs real quick. I can do this. Highlight them all. I want to do that really quickly. When I'm looking at a graph, putting on a 1-year graph. When I'm looking at a graph, I want the stock to go from the bottom left to the top right. Is my stock doing that? The stock's at the top, most likely. Look at that, INSW. CPRX, little pullback, but running back up again. Clearfield, bottom left, top right, came off a high hard. Look at that rebound. Look at the earnings per share. Look at the VST. Look at BTU, a little bit of a sideways move. Look at ARLP, pulled back, starting to move back up. But look at the overall graph. Look at the earnings per share. Folks, as you do this, woof, look at Adobe. It's a sell. Look at Apple. It's all over the place. I might like it, but it's all over the place. And Ford, definitely in a downtrend. All right, so that's real quick on looking at the graphs. This is all the information you need to get started making money with VectorVest. Folks, we want to move you off the road of recovery and always have the recovery stocks to growing your portfolio consistently. Todd led it off. I took you the next step. Everything else today is going to build on that foundation. And folks, like I said, this is not the time to run away from the market. This is the time to hold on to what VectorVest has to offer, and you need to invite your friends to do that. Folks, I'm done. We got a break. I'm getting ready to put this over to Ray. It was my pleasure to give this presentation. Hopefully you took something away from it. If you did, by all means, definitely type in the comments or hit the like button. Ray, I'm sending it back over to you, bro.
Thank you, Glenn. What a great presentation. You know, the stock viewer truly is a gold mine of information. We've used to spend a lot of time going to different trade shows and just talking to customers. And the primary theme or the primary question we used to get was, what separates VectorVest from everybody else? I can get this data from Yahoo Finance, or I can get this for free anywhere. And the reality is no, you can't, because there's a major difference between data and valuable information that you can actually make educated decisions with. And that's what VectorVest provides. We are fact-driven. There's no opinions. There's no fluff. Sometimes, you know, what you need to hear is not what you want to hear, according to the holdings you have, but it's fact-driven, and there's a huge difference between the data and the valuable information that we provide. The other great thing about VectorVest is that we don't hide behind what we've said. You can go back historically, all the way back to the beginning, and see exactly what we said when we said it, because we've never missed a major market call. And our analysis of stocks and our vision and way of ranking stocks is unmatched by nobody out there on the planet right now. So we truly do have a gold mine of information. So we're going to take a quick break. Before we take that break, I just want to mention once again, if you would like to download the slides, you can go to vectorvest.com/mcslides. So it's vectorvest.com/mcslides. If you're brand new to VectorVest and experiencing what we have to offer for the first time, take advantage of this trial offer that we have. It's free for 60 days. And you're going to get all of the tools that we're showing here today during that trial. You're going to get the auto timer we'll talk about later. We're going to get the pro trader searches we'll talk about later. You're also going to get access to our group coaching the successful investor for the duration of the trial. After that trial, it'll automatically convert into an intraday subscription. And if you wanted any of those other components, you could always add it. Just give us a call. But we encourage you to take that trial, take that next step to financial freedom. Once we come back from the break, we're going to get into buying low and selling high. We're going to take this one-day seminar to an all-new level with Mr. Steve Chappell. So stay tuned. And we have a very special presentation from Dr. Bart DiLiddo coming up during break. That's going to start here in a moment, and we'll see you when we come back. Thanks for being here, everyone.
Best advice I ever read was in Ben Graham's book. Said buy undervalued stocks. You know, something like 10 million people entered the market this year so far, and they don't know from beans. You know, I wrote a piece called Zero Commissions Ain't Cheap, because I figured they understood ain't better than aren't. I don't know if anybody knew what the correct English was. So I thought ain't would appeal to them. There's a broker out there that took the name of Robin Hood, and I think he was a leader with zero commissions. So he's got a ton of subscribers, and they were doing pretty good for a little while. But they think they're getting, hey, I can get in there and make all this money for nothing. But I understand that their trading has diminished substantially in the last 6 months. Making money in the stock market is not a matter of shooting craps. It's not a matter of gambling. It's a matter of knowing what you're doing and having the proper information. And that's my goal in life. That's the goal of VectorVest, is to use the proper information and pass it along. That's the message I want to make. You got to have the proper information. And I believe VectorVest does this. But look what we got. We got the name of the company. We give you the symbol name, the exchange. We give you the price. I like to look at the dollar change. I like to see what's that stock doing today. What's the price change? Okay? But we give you value. And then we have three indicators: relative value, RV, relative safety, RS, and relative timing, RT. If that number is over 1, it's favorable. Now, who's going to figure all that out? Well, we made it easy. We built a value, safety, timing indicator. It's all between 0 and 2. We got over 8,000 stocks. There it is, staring you in the face. What could be easier than that? And I want to tell you something else about VectorVest. As far as I know, VectorVest is the only service that gives you a stop price for every stock every day. That's the stop price. And when that price goes below the stop price, that's a sell. You could use that stop price either as gospel or as a guide. You know, I listen to Fast Money on TV. These guys are always looking for stocks going down in price. I like stocks that are going up. If you went and bought a puppy at a pet store, do you ask them, you say, is this puppy housebroken or not? I want a puppy that's not housebroken. I want one that poops all over the place. And that's what a stock that's going down. It's like a puppy that needs to be broken of a bad habit. You want stocks that are used to going up. Well, what could be easier than doing this? And what could be more helpful?
Hello, everyone, and welcome back to the masterclass. We're excited to have you. Thank you for sticking around. Please show your support by hitting the like button at the bottom and subscribing to our channel. We put out all kinds of educational content every single day of the week in, week out, and ring the bell to get notified every time one of our new educational pieces come out. We're excited to have you. Please show your support by doing that. And next, we're going to move into the next phase or the next layer of information. And one of the biggest gurus of VectorVest, Mr. Steve Chappell, Director of Trading Systems Development, is here with us. And he's going to teach you how to buy low and sell high. Take it away, Steve.
All right. Thanks, Ray, for that nice warm introduction. Guys, I'm just privileged to be here. It's been quite a ride. I've been with VectorVest now going on my 21st year, and really have been here since, seems like the inception of the company. Of course, I did come along many years after it actually started, but boy, I've seen the growth, and it's just been a tremendous, tremendous, tremendous company to work for. This presentation here, buying low and selling high, is what it's all about. If you get this right, it can absolutely change your life. And so that's my goal. My goal over this next 50 minutes or so is to change your life. And I think if you pay attention, it's going to get the job done. So let's get to it. The first thing that we've got to understand, and we'll harken back to what Todd brought to the forefront the first talk this morning, is that one of our fundamental philosophies is that we believe in buying rising stocks in rising markets and selling falling stocks in falling markets. And this presentation is really going to bring that to light, because when you do it right, it can have life-changing results, okay? So let's talk a bit about it. How do we go about this process of getting that right? The essence in the stock market, the essence of making money in the stock market rather, is the fine art of buying low and selling high. So the first thing that we have to tackle is that it's an art form. It's not an exact science. It's something that you get better at over time. However, I have great news for you. VectorVest has been working at this for more than a couple of decades, and we are the best in the business. And it's my job to show you how good we really are. And so that's what we're going to do. We're going to show you the art form that we've developed, and we're going to show you then how you can take full advantage of that. Before I begin that real journey where all the meat is on the bone, I think it's important, particularly for those that are new, just to broach into the subject a bit, hit some of the critical questions and obstacles, and then show you the solution. Okay, so first obstacle, I guess if you will, is how do we know when a stock's price is low? Does anybody have an answer to that question? Well, is a stock's price low when it hits a 26-week low in the stock market, like I'm sure a lot of stocks are these days? Do we feel like stock prices are low right now, or could they go lower in the future? By the same token, what about stocks that seemingly somehow are hitting 52-week highs right now? Cheniere Energy, one of the stocks Glenn talked about last presentation, very recently hit a 52-week high. Truth of the matter is, that stock price could certainly be low. And so what's low to a buyer is high to a seller, so who's right? So when we talk about that art form, what we need to do is work out, do we want to be the buyer or the seller? And what we're inevitably going to land on is that by definition, a stock's price is low when it's more likely to go up than it is to go down. And so, like the fine art was a couple of key words on that prior slide, the real important word on this particular slide is likely. It's our job as investors, traders, whatever the case may be, to assess likelihood. There are absolutely no certainties in the stock market. So if you're out there looking for the holy grail that never makes a mistake whatsoever, you're not going to find that. But what you do is you get really good at establishing likelihood. And there's been a couple of camps out there in the general investment community that have been going about this business of, well, how does one know when a stock's price is more likely to go up than it is to go down? So you have fundamental investors and you have technical traders. And what you're going to find out is that here at VectorVest, we combine the best of both worlds. But let's really break it down first, because if we remember what Todd was saying earlier on today, fundamental investors who hold for the long term say, they buy stocks when they see attractive situations regarding value and safety. And what did Todd say was the key thing that drives value? Earnings. So earnings is a huge focal point for VectorVest. And so when we look at attacking the stock market and buying stocks low and selling them high in the future, our first objective is to make sure that we're buying the very best stocks to get that job done. And then what we're going to find out is when we can nail market direction along with that, boy, that's when it really gets fun. Okay? But just remember quickly, in terms of fundamentalists, when we're looking at safety, what are we looking at? We're looking at companies with outstanding financial performance, consistent predictable earnings growth, above average earnings growth, steady increases in stock price, low debt to equity ratio, and high sales volume. Why do we look at that? Well, certainly, as companies grow their earnings quarter after quarter after quarter, year after year after year, investors like that. Seems like, boy, if I want to make some money in the stock market, I'm going to go out there, find a company that has an incredible track record. Because what does that mean? It means in the future, I should see that same beautiful increase quarter after quarter, year after year after I make my purchase. The other, maybe lesser thought of quality that we're talking about here is, does anybody ever remember a drug called Vioxx? We're going back in some time here. So the millennials probably have no idea what I'm talking about. But that was a billion-dollar problem for a little old company called Merck, right? And did Merck go out of business? Even being hit with billions of dollars of lawsuits in the fray of all of that was going on? No, they're still around today. So they can withstand these little bumps in the road of billion-dollar lawsuits. So high safety companies not only grow their capital quarter after quarter after quarter, year after year after year, they also have incredible fortitude to withstand situations much like what we have now with a very, very uncertain market. Technical analysts, on the other hand, they're more short-term oriented, right? So often thought of as traders, and they time their purchases when they expect a price to go up. So what are they going to use? They're going to use things like breakouts, support and resistance breakouts, uptrends, higher highs and higher lows, increasing volume in terms of conviction behind that price rise in the stock, and often news-related situations. Like Glenn had Beyond Meat in his slides earlier. Did you guys see where the CEO of Beyond Meat got out of his vehicle and I think attempted or plausibly did bite somebody's nose? I guess he's a meat eater. but you know, the funny thing is, I mean, they're both right. You know, what we want to do is we want to take situations that are happening where we have a nice, strong, fundamental company, but we also have a catalyst that's going to be helping to drive those stock prices higher. That's going to come by way of technical situations on the stock charts themselves, and also even news, and it could be macroeconomic news. You know, what are some things that could turn this market situation around now? How about some resolution in Ukraine? You know, how about a real strong softening of inflation? Things of that nature. So what we want to do is combine it all and condense it all down and make the very best decisions possible. So VectorVest is the only service that combines the power of fundamental valuation with the insights of technical analysis. And friends, I have been saying and using this slide for 20 years. And I think we're still, as far as I know, the only service out there that combines the best of both worlds and does it well. I might add that little caveat. But our mantra is that we advocate buying safe, undervalued stocks rising in price. The question becomes, if you haven't thought of that question yourself already, is are they right for you? Well, let's talk about it. Let's have a quick peek. So what I want to do is get into VectorVest here quick. And Glenn did a nice job with Stock Viewer here and with Watch List. I'm going to go back to Stock Viewer. over here on the left. Boy, this thing's slow. There we go. And in Stock Viewer, we said that we leave a track record, right? So what I'm going to do is I'm going to go back in time. I'm going to go way back in time. One of the things that I want to bring to the forefront in a big way right now is that it's our experience, and has always been our experience, that high VST vector stocks, stocks with the best combinations of value, safety, and timing, are the stocks that tend to outperform the market, particularly over the longer term. And then when we get some of the highest safety stocks with those same attributes, boy, it really gets good. So let me show you what we mean. I'm just going to go back to the first full year that we have data. You can see where we were actually a weekly service at this time. This is all the way back to 1996. VectorVest has been around forever, right, guys? Some of you have been with us virtually the entire time, I know, that are in the audience right now. I'm going to go ahead and click on OK here, and when I do, what it's going to do is populate the stock viewer with the stocks that we would have found at that time. And so I'm simply going to make sure that it's sorted by the stocks with the best combinations of value, safety, and timing. And when I do that, I get little old companies like Aflac, Paychex, Walgreen Boots, Fifth Third. Sure. Anybody ever heard of these stocks? Hopefully you bought some of them along the way. Let me show you what's going on here. I'm going to come here to the top. You're going to learn more about this tool later on. I'm just going to quick test, say, the top 20 stocks here and show you if VectorVest is any good or not at putting you in situations where you can outperform the stock market. Little old United Health Group is only up 6,466% since that time. Sherwin-Williams, only 2,956. 15 of these stocks went up, 5 went down. Is that a pretty good start? Do you think if we focus our investments on high VST stocks that we're heading in the right direction? Because this is just buy and hold. Boy, it's really going to get good when we start looking at being able to time the market, only buy when it's the best and most appropriate times to be long, protect those profits when markets fall, and just keep doing that over and over and over and over again. The next slide in your book deals with safety. It says, all right, let's do the same test with the highest safety stocks. People always say, man, I don't want to go after safety. That's going to be boring. Those stocks don't go anywhere. All they do is they go up a few percentage points here, a few percentage points there. Man, I want to go out there and buy Beyond Meat. You know, that sucker's up 20% today. Well, let's see what the track record looks like with some of these high safety stocks. And guys, you can go back to any time you like historically. It's getting a little more challenging now because we've had a pretty substantial pullback in the stock market. But look at this. Given the time to operate, do you think owning a good selection of top relative safety stocks is a good foundational starting point for you in terms of building your wealth over time? You know, what they tell you on CNBC is all you want to do is just buy a little piece of the S&P. You want to do it every month. Doesn't matter whether the market's going up, going down, going sideways. And what are you going to get? What's your performance going to be? 6% a year? 8% a year if you're lucky? What are we looking at here, Ray? What's that number say down there? I can't hardly read it. 37. Yeah. 36, 37%. That's year after year after year. Have you ever heard of the rule of 72? You take your annualized rate of return, okay, divide that number into 72, and that's how long it takes you to double your money. So if you start with 100,000, then you got 200,000, in this case, in about 2 years. And then that 200,000 becomes 400,000 in the next 2 years. And then the 400,000 becomes, and here's where it starts to get fun, you know. The 400,000 becomes 800,000. And then the 800,000, that's where I'm at now. That's when it really gets fun. Okay? So just buying high relative safety stocks and holding them for the long term is your foundation to making money in the stock market. When we start tying that into market direction, protecting these portfolios in the worst of times, collecting the dividends that these portfolios pay over time, the numbers go way up, guys. This is just raw. They go way up. Okay? Let me get back over here. Now that's buy and hold. I mean, if you want to do buy and hold in VectorVest, boy, you can do it. But my job is to show you how to do even better than that. We're going to do better than 39% a year, Todd?
Yay.
Yay. He says yay. We're jaded here at VectorVest, folks. 37% doesn't seem like a whole lot anymore. All right. So high relative safety stocks, they're usually classified as prudent or conservative, and they've been proven to go up over time. We just showed you that. I encourage you to go back, do some of that, pick different dates. Do it to your heart's content. And what you're going to find is a system of just buying high relative safety stocks is a great place to start. Okay, so I did include in your paperwork that you can print out some historical look at this. It's actually, the number's gone up. It was 35.6. So what are those safety stocks still doing, Jim? They're still going up. They just keep going up. Here's where it gets fun. Everybody ready? The secret weapon. Market direction. Only problem is, I dropped the mouse. I got so excited I threw the mouse across the screen. Market direction. Market direction is the single most important thing to know. The single most important thing to know is whether the market is going up or down. Everything follows from that. Very wise words from our founder, Dr. Bart DiLiddo. Guys, market direction is a secret weapon because we can do even better. And you're going to see a heavy dose of that this afternoon. That's when it's really going to get fun. We're going to start getting your feet wet a little bit, though, in this presentation here. So it's long been an expression in the market, let the trend be your friend. At VectorVest, we do it better than anybody else. What we want to do, again, is buy rising stocks in rising markets, sell falling stocks in falling markets. The VectorVest market timing system has never failed to signal a major move in the stock market. That's a bold claim, isn't it? What do you think the track record of this is for some of the folks that you see that have a very heavy presence on a lot of major financial networks and newsletter writers? That guy Prechter, he's been bearish since the early 80s, right? So what we have in VectorVest is a place where you can get matter-of-fact, common sense information showing you when it's okay to be buying stocks and when it's not okay. And in fact, selling stocks short for profit if you're willing to do that, or buying contras, whatever the case may be. But this graph is so important, you need to make it part of your daily routine. The market timing graph clearly shows when the market is rising, falling, or transitioning and gives explicit market timing signals. So let's go take a look, because the VectorVest market timing graph is your key to success. Follow the signal that best fits you as an individual. So we're going to get over there and take a look. All right, so here I am. Oop, get out of that. I might have. There we go. Seasoned Pro. We'll get fixed right up. Okay. So in order to access that graph, we're going to go to the timing tab within the platform. From that tab, we're going to go to market timing graph. Once we get in there, let's first by just taking a broad look at things. When you take a look at this graph that's on your screen right now, and you consider some of that guidance about just buying a little bit of the S&P every month, you say, boy, in reality, that's not terrible guidance. I mean, the markets do tend to go up over time. But what else do you see? Boy, I tell you, they got some roller coasters over here in South Carolina just across the border. And I don't think they go down quite as fast as some of those dips, little dips that you see in the market. Like, anybody remember the COVID collapse? Right? If we go back further, does anybody remember the financial crisis of 2008, into 2009? If we go back even further than that, does anybody remember the dot-com bubble of 1998 into 1999? Right? And so at VectorVest, we feel that's not what you want to do, is try to hold and see fortunes evaporate into pennies and have to reinvent yourself over and over and over again if you're lucky. So what we feel is a better way to go is to buy stocks when the markets are low and sell them when they get high, and buy them when the market gets low and sell them when it starts to really turn over and go down, and buy them when it's low. And who do you think is going to make more money in the end, even with the same stocks? If you buy when the markets are low and sell them when they're high, versus just try to buy and buy more all the way through? Well, the answer should be obvious. So hopefully it is. But the trick becomes, what do you hear on TV all the time? You can't time the market. It gets my blood boiling every time I hear it. And I think there's some confusion, because then they'll bring up a chart analyst telling you what's happening with the current stock and whether it's high or low, right? What they're talking about is you can't predict the market. And I'll be the first one to tell you that. In other words, I can't tell you what the market's going to do next week. What I can tell you is that I've been bearish on the market for a good little while, most of the time this year, and making money while the market's going down, versus trying to buy stocks every time it looks like the market's going to take up off a low. And so we're going to talk about that. Now, that truth be told, we did go bottom fishing 4 times this year in the Jockey Club, which is our daily trading room, and we made about 30% year to date on very short bottom fishing opportunities. But that's what VectorVest can do for you. It can, even in the worst of markets, give you indications on when's a good time to make a really good, solid, quick buck. Okay? And when markets get on a roll, boy, the money just starts funneling in. 2020, guys, 2020 into 2021 was life-changing for me. I mean, I was making more money per day than my salary. Okay? Per day, some weeks. I mean, Monday, Tuesday, Wednesday, it was like Groundhog's Day. So let's talk about how we do it, okay? First things first, let's just start around COVID, because everybody remembers that. Actually, I should walk you through the hits. Let me walk you through the hits first. You see this peak back here? Let's start here with a dot-com bubble. You see this? What's that high point there? 3.6? Okay. Can VectorVest get you out of harm's way before the market does nothing but really go down for several years before it starts going up again? Let me go to VectorVest Views, and let's go to March of 2000. And my presentation might end up running long, but I don't care, because what I'm going to do is convince you that VectorVest is all you need, and this presentation is all you need to do really well in the stock market, okay? I'm going to go to March, and we said that it peaked there pretty close to the 6th, at least on a weekly chart, right? I need to go back to 2000. What am I doing? Or 99, I'm sorry. Boop, boop, boop. Check your date, I think it was March 6th of 2000. What was it? March 6th of 2000. 2000, yeah. I'm looking at the dates there, Todd, and I was like, I'm in the wrong year, man. See, I know the dates. All right, March 10th of 2000, okay? This is what we said. Go down here towards the strategy. All right, what did we say? Now listen, this is a daily investment newsletter that goes out to all of our subscribers. Okay, so we're talking about market direction and market guidance. Here's what we said that day. Well, I chickened out at the first sign of a downdraft and I feel much better now. I'm more concerned about preserving capital than I am about wringing out the last penny of profits from this astounding rally. Although the price of the VectorVest composite rose again last week, the BSR is sounding alarms. I continue to believe that downside risk outweighs upside potential. Prudent investors may continue to do some selective bargain hunting, but caution is advised. Aggressive investors and traders may continue to play the high flyers to the upside, recognizing what? That a major downturn is likely. Guys, this was written when? 310. The peak on the weekly chart was what? 3.6. Do you think you can find another software company, another stock analysis and portfolio management that a major downturn is likely on this date? All right, let's put some more. Whoops, that's Todd's graph. I can't see the graphs here hardly. Let's put some more color to this. Let's go forward a little bit further. Yeah. Oh, there we go. How about here? I want you guys to remember this date right here. This is the financial crisis, or what soon would become, at least by about June of 2008. Right? This is October, November of 2007. Would that have been a good time to tell you that a major downturn is likely? All right, well, let's go take a look. Again, we leave footprints in the sand. So we're going to go forward here, this time to 2007. We're going to go to November the 2nd. Now I want you to notice something here, because we're going to talk about, you see this red square? That's what's known as a confirmed down call. So what might on the surface at this point seem like, well, boy, these guys are pretty good at predicting when things are going to happen. What we're really doing is reacting to the information, the useful information that VectorVest provides by way of market analysis to know that these situations are on the horizon, okay? The confirmed down was the day before, so we'll click on the 2nd, and what does it say here? A word to new subscribers. The confirmed down signal that we received yesterday could be the entree to a long bear market. We aren't there yet because earnings are still rising according to our method of analysis. Does that sound interesting to you, Todd?
That's the one I saw. All right, I was new in the seat and I read that and I went, oh.
Yeah, that's the one Todd was talking about. Yeah. Eerily kind of sounds like, potentially anyway, the current situation.
And scroll up.
Right? But it says, we aren't there yet because earnings are still rising according to our method of analysis, yet we no longer appear to have the support of an accommodative Fed. Does that sound familiar? That can make things very bad for the stock market. So don't be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. This is not the time to buy stocks. Now, we were much more on the very precipice of the ball dropping on this particular essay than we are current. But the situation is very similar indeed, okay? Now, if we come up here and go back to the chart and do it one more time. Hopefully I've got the chart open still. Oh wait, let's have a bit of fun. Does anybody want to have some fun? Todd, you want to have some fun? Let's have some fun, man. This thing bottom, when is this? When's the bottom? March the 9th, 2009? Mamma mia. Watch this. Here we go. What did we say March the 6th of 2009 before it even bottomed? Look at this. The market is itching to rally. While stock prices have been going down since the market broke out of the wicked wedge, I've been watching a little sideshow. And he's going to show you some of the things I'm going to talk about in the market timing graph here in just a minute. Okay? But he's noticing that with our core timing indicators on the stock market, they're beginning to hit higher watermarks while the stock market is hitting lower watermarks, which is known as a divergence. Okay? We saw that in 2009. We've seen it plenty of times since. And that's what aids us and helps us in making these big calls. Okay? Now, what we did was, if we fast forward and just take it a day at a time here, boy, look at the color guard. The color guard, is, boy, it looks like today's color guard a little bit, doesn't it? Lots of red and a little bit of yellow in there. For those of you who are riding the wave, we're playing the downside of the market with the high. So we've been short, guys, and been short, taking full advantage of that market down since November of 2007 predominantly. There was a little piece in time there where through late March of 08 into June 6th, the stock market actually went on a pretty good roll. And then the financial crisis hit, and we were back on these contra ETFs, making money hand over fist. Now the stock market is ripe to explode the other way, and we say, all right, we're going to go along with one of these searches when the market takes off. And guys, watch what happens the very next day here. Uh-oh. I lost the screen. I lost the other screen. So, listen, all right, thank you. I can roll, I could have just given you the facts, okay? But let me go forward and show it to you because it's better to show you if I can. So for those of you who are riding the wave, we went long with Jailbreak that morning, March the 10th, 2009. Never forget that morning. That was another life-changing moment for me. That morning, first thing I do is kind of begin to roll out of bed, grab the remote, don't have the coffee yet, right? Flip on CNBC and put it on mute. That's what I always do first. But I looked and I saw, boy, the Russell was up 6%, the Nasdaq was up 5%, and the Dow was up 4 or 5%, and the S&P was up. And boy, I was like, wow, I got to get to work. We got to buy some of these stocks. Let me go over here to see. This is where I start talking about all the fun stuff, which is the life-changing moments. But I think it's good to add the color, because without the color, it doesn't mean as much, at least in my view. You got to have lived it. You got to have done it. You got to have seen it and know it. And so anyway, if I go over this tool you'll learn more about this afternoon called Unisearch, I go back here and go to searches bottom fishing, right? And we go to that little old booger called Jailbreak that we went long with. Guys, I'm going to tell you, when you get to market bottoms, there is no better search than this one right here. And you just got to trust it, because it's going to scare the daylights out of you. But boy, is it fun. Watch this, March the 9th, because we would have bottomed that morning of March the 10th, okay? So we would have gotten this would be our list that night. Century Aluminum, oh my God, Citigroup. Citigroup's what started the rally to begin with. They said they turned a profit the first quarter of the year, and the stock market took off like a bird. Watch these stocks, guys. Those stocks are up 1,200% to today. 1,200%. Is that buying low and selling high? I'll ask it again. Is that buying low and selling higher? And we didn't even, watch this. Let's go back 2 weeks. See, Glenn's got me fired up now. I'm going to start yelling. Let's go back to 2009. All right, let's go forward to April. I can't see the bottom of that sucker. There we go. Let's just run it for about a month. 200% in a month. Todd, would you be happy with 200% in a month or two?
I would be happy.
I would too. Look at this thing. Citigroup went up 203% in a month. Triple leverage financial ETF up 200% in a month. HBAN up 200% in a month. Look at this one, Las Vegas Sands. up 422% in a little over a month. Guys, this is how good it gets with VectorVest, okay? I mean, I'm going to some of the best opportunities that have ever been presented over the past couple decades. I get that, but that's where the real fun is. And I got to tell you, the lower this stock market goes that we're in right now, the more apt you're going to be to get those kind of results in the not too distant future. If I show you how to do it now, you're going to be able to do it then. You need VectorVest now more than you ever have, because that opportunity is coming. And it's probably not this week, it's probably not next week, and it may not even be in the next few months. Okay? But when it comes, we're going to be there to show you how to do it. All right, so let me walk you through our core analysis, though, now that I've hit some of the high water marks. Okay? All right, so I'm going to get back over into VectorVest here quick. Clay, see if you can get the program open for me. Perfect time for a sip of coffee. All right, we got on a roll there. Sorry, guys. Bring in the heat. I could keep doing that ad nauseum. We got you out before the COVID collapse, or at least really on guard before it even happened, within days after it started. Even our confirmed signal told you to get out of harm's way. So it just happens over and over and over again. What I'm going to do is show you how we do this, okay? So a couple of things. Over here on the right, whenever you open up a market timing graph in VectorVest, you're going to be confronted with the top price graph. That is the 9,000 stocks tracked as one unit. So instead of isolating things off into the Dow, the S&P, the NASDAQ, we just lump everything together and produce a straight arithmetic average, okay? Then what we do is we apply some core indicators to that. It's going to be hard for me to see, but I'll be able to drive the message home as follows. So we had a market coming up into the COVID collapse that was going what? It was going up, 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 right? Even hitting a new high before the collapse happened. We've got a couple of indicators that are going to give us very useful information to let us know to start to get on guard, okay? I'm going to start with price, and then I'm going to come down below and get even better information. But when price, let's just use price alone to start things. We came up, hit a new high, right? As price starts to turn over and fall, I'm going to come down here to the bottom. The first signal you're going to get from VectorVest telling you that the market is changing direction is this little guy right here called the primary wave. So this is the first day when price closes below the closing price from a week ago. That's the first signal you receive from VectorVest that the market looks like it wants to try to change direction. Okay? So when markets are high and a primary wave comes to roost, that's your opportunity to clamp down and make sure that your portfolio doesn't unravel. That's where you want to start thinking about becoming cautious, using puts, going towards cash, tightening stops, doing things to minimize future risk. Now, as price goes down for another week, then you have preliminary signal of sustainable downtrend. Now, if I come to the bottom, from the primary wave, we're going to then go to the confirmed call, okay? Now, the confirmed call came in here. Now, in order for a confirmed signal, so we're going from one extreme to the other, and then we'll come back in the middle. We have the earliest signal possible, which is the primary wave. The confirmed signal requires 2 weeks of price movement, week over week. And it requires confirmation from this indicator here called the buy to sell ratio. So When price goes lower week over week for 2 consecutive 5-day trading periods, and the buy to sell ratio confirms that by going below 1, it produces the signal. And you can see that is, even if you waited till the very last signal VectorVest provides, it could have kept you out of most of the damage from the COVID collapse. Okay? Then, as we come down and eventually get to a low, did we ever have a primary wave up? The answer to that question is no, until here. This is March the 25th of 2020. Does that look like a good idea to start to relinquish some of those puts that saved your bacon, and or even thinking about starting to buy stocks long, realizing we might want to walk a little bit before we run? Well, let's see what happened. I'd say that would have been a pretty good decision. How about you? Okay. And so anytime a market goes on a major move and the primary wave then gives you that first signal that things are really beginning to head the other way, that typically becomes your very best opportunity to buy stocks in this case, or get defensive in the prior case. Then once the signal is confirmed, for those of you that have bigger accounts, multi-million dollar portfolios, you're most concerned with preservation of capital. You probably don't want to really attack the stock market again, even until you get a confirmed up or a green light, which we'll talk about here in a minute. Probably don't want to start throwing multi-million dollars at the stock market just on the first little indication of bounce. I'm not an idiot, right? But boy, was that a good time to think about it right there? Market just kept on going. Boop, 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 boop. Plenty of opportunity there, right? So this was the first time price went higher week over week for 2 weeks, and the buy to sell ratio confirmed that by going above 1. Now guys, we have some other specialized things that we do. The most important parts of the guidance are already underway. This is really something that can kick things up in a big way. And that is, we have levels. So with these indicators, particularly with the MTI, we'll start there. It's on a 0 to 2 scale. Now the MTI combines the price movement that we were just analyzing. It combines the buy to sell ratio information, which is the number of buys divided by the number of sells in the database, which is why we were leveraging that. So the buy-sell ratio is high when there's more buys than sells. The buy-sell ratio is low when there's more sells than buys. Okay, that's why we use that as a confirming indicator. So we want to buy stocks when most stocks are earning buy recommendations, more of the stocks in the database, and get defensive when more sells begin to populate in the database than buys, right? So price, the buy to sell, and the relative timing. Glenn talked about relative timing this morning. So we look at that on the market level as well. We combine all of that information into one single comprehensive indicator for timing the market. And it's 0 to 2, as I was mentioning. Once you start to get up into the 1.5s, you start looking for a market that is potentially getting ready to turn over and head the other way. So the market becomes overbought, okay? So as we were even getting up here, what's our MTI ratings at that time? So I'll just highlight it here and you can read it over there on the right, 1.5, right? What did the market do just for the next several weeks? See how it really turned over and dipped quite a bit, right? What was the, now the MTI here, as price made a higher high, the MTI was making a lower high. That's known as a divergence, okay? And that's how we knew, even prior to the collapse, which of course came out of nowhere, nobody could have predicted that, that's not what we're saying. The market was already getting tired to begin with. And when we see these kinds of things, the market then typically begins to really follow through in that direction and in a big way, okay? So that's on, when markets are high. Now when markets are low, when the MTI gets down below 0.6, we start searching for a market bottom. Now, your first evidence that a market bottom is truly in play, at least mechanically from VectorVest, was what? The primary wave up. So here, since the MTI is below 0.6 and the primary wave turns up, I believe, the very next day. We go down here and turn the signal on. 2 days later, sorry. That would have been your most opportune time to go what we call bottom fishing. And that's what we did, ladies and gentlemen, with that jailbreak situation from 2009. We were seeing the same kind of things then that you're seeing here. This happens to be 2018 that I'm looking at there. I went back a little too far, but you can see it all still applies. No matter what market you're looking at, everything that I'm explaining to you applies to that current market situation. Okay? And then as the markets get on a roll and the MTI starts to get up into that 1.5, 1.6 territory, how much higher and fast is the market driving higher at that point? See how it just comes down to a crawl? All of the really juicy price appreciation is gone. Okay? So that's where you start putting on the brakes. Until it does what? Until it gets low again. Okay? And then that's where all the fun begins, and it just over and over and over and over again, even on the back of the COVID collapse. The buy to sell ratio, we like to see that indicator get down below 0.2, and to be honest, that is the main indication that we lean on for helping us to pick out major bottom fishing opportunities. When the buy to sell ratio gets below 0.2, that is, you'll see us saying things like searching for a bottom on most occasions in the VectorVest views. Okay, so where are we today? With the buy to sell ratio, we are below 0.2, and with the MTI, we are below 0.6. And so I told you earlier that we have gone bottom fishing several times this year, even if it was just for days. And that was in situations like this, where those indicators were at those levels, even back here. And there's been 4 good opportunities so far, and we've made 10 to 20% just about every single one, okay, in just days. Okay, so we've covered a lot of ground, I know to be sure. At the end of the day, all you need is a subscription to VectorVest. We tell you all of this stuff right in our daily newsletter, the VectorVest Views. As you saw, that's where I started. We're going to tell you when these major situations arise. We're going to tell you when confirmed calls come into play. We're going to tell you when the primary wave of the market changes direction. All of that is going to be explained for you right here back in our daily newsletter. Okay? All right, so quickly, I think I'm already beginning to run a bit long. We have a couple of more timing models. I just quickly want to hit on that, and then we'll probably go ahead and send you to break, because I should be coming to the end then anyway. So let me get back to the market timing graph here quick. So over here on the right, we've covered the confirmed call and the primary wave. And as you saw, those give explicit signals, particularly when used in conjunction with our core indicators, right? Now, we have a couple of other timing models. One we're going to use quite extensively this afternoon, so I'm surely going to cover that. It's called GLB RT Kicker. So GLB RT Kicker, you're going to see a confirmed down signal. Price goes down 2 weeks, buy-sell ratio goes below 1. You get signal, right? We're going to get out of harm's way. We're going to go to cash. After the markets come down enough and start going up again enough, really the answer there is start going up again enough, eventually you're going to get a green light in the price column of our color guard. When that happens, you're going to see this green triangle appear on this graph as an opportunity to start buying a bullish campaign. Okay? All right, we'll really bring this forward here a little bit. What you're going to notice is predominantly you're going to be getting green triangles when the market is rising, When the market's really falling, there's going to be an absence of those green triangles. So we're going to be either in cash or short or protecting profits in those situations. Whenever green is populating on a regular basis, we're going to be more long the stock market until real trouble arises again, okay? So that's how this one works. Now, when we say green light in the price column of the color guard, it's right on our homepage. You have this column here. We do not see any green lights right now for any of the days over the last 3 weeks. So we are not buying stocks according to that model right now. In fact, what we see out here to the right is what? We see a C/down. That means confirmed down. That means we are playing the market to the downside or in cash under that timing model right now. And then finally, we have another timing model called the DEW. So I'm going to come over here to the right. This one's kind of like Goldilocks and the Three Bears in that it's generally, the porridge isn't too hot, it's not too cold, it's more in the middle, it's more edible for some even. It's not trying to nail the bottom, it's not waiting as long as the confirmed calls on most instances to change directions. And so what we're looking at right now, we're looking at price, right? We have a white line, which is a 30-day weighted moving average. We have two green lines, which are envelopes, and we have this DPO down here on the bottom. So this DPO acts a lot like the buy to sell ratio for our confirmed calls. It's the confirming indicator for the price graph. So when price goes below the white line and the DPO is negative, that's a signal. So if I come here to the bottom and click on DEW signals, you're going to see the signal began here on 8/29 most recently, and we've been short by this model ever since, or bearish on the stock market by this model ever since. If we go back to the prior up signal, we were bullish on the stock market by this methodology, July 19th up to August 29th. So what did the stock market do over that period of time? Did it go up or did it go down? Went up, right? How about when the down was signaled? Did the stock market go up or did it go down? It went down, right? And so this is going to get you buying stocks early on in an up wave and protecting that portfolio, if not going short, fairly early on in the ensuing down wave. And so that's the methodology here. And it tends to fit right in the middle. So we're going to be using these signals all throughout the session today. I have some examples of results in your paperwork. I'm just going to leave those in there. I've got plenty more examples this afternoon, so I don't feel the need to go in and necessarily show result after result after result. I think you get the picture. If we can buy stocks here and sell them there, our odds of making money in the stock market go way up. And if we can do that over and over and over and over again, what do you think's better? Buy and hold this year? Buying a little piece of the S&P every single month this year? Or protecting profits on each one of these red triangles and buying low on every subsequent green triangle and doing that over and over and over and over again? I hope this resonated with you guys. I'm going to give myself a solid B- on this one, but hopefully you paid attention. This afternoon, I'm going to hit the ball out of the park for you. I'll make sure I do that, okay? But this is the name of the game. The name of the game in buying low and selling high is market direction. We can play it very aggressively with the primary wave. We can play it more prudent to conservatively with the confirmed call. We can go somewhere in the middle with the green light buyer or the DEW. And we're going to do a heavy dose of that this afternoon. Go to lunch. And actually, Ray, take it away.
Thanks, Steve. Wow, what an amazing, powerful talk. What Steve just showcased was
buddy.
how this software, how VectorVest can really change your life. I know many of you, it looks like we have a split room. Many of you are VectorVest subscribers right now. Many of you are not. If you're a VectorVest subscriber right now and this software has changed your life for the better, please type into the room, say, changed my life. I know it has changed mine. When I first started with VectorVest was back in 2009. We had come off of a humbling from the housing collapse, and there was blood in the streets, very similar to what we have right now. But that was the best decision I ever made, was coming here, learning the software, learning the market timing, understanding the analysis, and I can't speak enough for what this software has done for me. For those of you who are brand new, seeing VectorVest for the first time, maybe you took a look at it at one point in the past. I know the pain you're going through. I know what these down markets, the havoc it can wreak on your family, on your future plans. But I can tell you right now from the bottom of my heart that you have an opportunity right now. And I encourage you, take that trial. Give it a shot. It's 60 days. We're going to show you how to turn it around. Steve had mentioned that we're going to get in front of this analysis. Every single night, one of these guys gives an analysis on what the market is doing. So we're looking at what we're seeing. You don't have to memorize these levels, although you will over time. Where the MTI, the buy to sell ratio is. We do that work for you. All you have to do is show up. We can remove the amount of time it takes you to invest, the stress it may cause on you. So I encourage you, take that trial. And just for example, tonight, every Friday night, we do a special presentation. Tonight's special presentation is called Preparing for the Opportunities Ahead. You'll see that posted later tonight. For those of you who don't have VectorVest, take the trial and you can be able to view that in the software. But we're going to have you prepared. We're going to tell you what we should be looking for, what we're looking for internally to make the next moves, whether you're aggressive and you want to go bottom fishing, whether you're more prudent or you're conservative. We'll keep you on the right side of that path. But right now is an opportunity, and seize the day. Take advantage of that. www.vectorvest.com/mcbundle. That's going to give you a trial to our intraday software. You're going to get all the tools that we're showing today. And even better yet, we have a successful investor coaching group where Mr. Todd Schaefer and Brian DeMico, they come together once a week and have a group session where they show you how they manage their portfolio in the current markets. What should we be doing? What are we looking for? Are we getting ready to buy? Let's build our watch list. They do that hand-holding for you. You're going to get to be able to take advantage of that during this trial as well. So I encourage you to do it. So moving forward, next up we have Mr. Jim Penna, the manager of retirement services, and he's going to show you exactly how to build a winning stock portfolio. So Jim, go ahead and take it away.
Hey, and thank you all for taking the time to be here today. Again, my name is Jim Penna, manager of retirement services. I'm very happy to be here. Tough acts to follow. Some great foundation has been laid here today. Todd first Dr. D's wonderful opening here. Todd laid out the VectorVest philosophy. Glenn talked about how we rank and analyze stocks, and then Steve just gave a great overview of using market timing, buying low, selling high. And so my goal here in this presentation is to talk about how to build a winning stock portfolio. What I'm trying to do here, my goal here is to lay a foundation as the day progresses, and as you'll hopefully noting that we're building step by step here. As the day progresses, we're going to continue to build, and by the end of the day, we'll have this process laid out for you. So I'm going to take that next step, talking about how to build a winning stock portfolio. Now, I've said this for those in retirement courses and retirement coaching group. I've come to a point where I'm no longer able to. It's hard for me to say how to build a winning stock portfolio because I've put the two words together: build and manage. Right? To me, it's one word now when I talk about using VectorVest to build and manage a stock portfolio. Right? We're going to build it, but you have to manage it as well. Right? It's really all encompassing, and so that's the key takeaway that I'm hoping we have here. When we talk about building a portfolio and managing a portfolio, it begins, as Dr. DiLiddo has written and said many times, I've heard him say and write over the years, that good portfolio management begins or starts with buying the right stocks. And so I like to always use the sports analogy, right? To win, right, to have a winning portfolio or whatever you're going to do, you have to have the proper team out on the field, okay, or the court. or the ice, whatever it might be. I usually use my 1969 New York Mets picture. I used to use the 27 Yankees. Steve and I went through, we picked the dream team here, right? This is the idea, right? You want to win, you got to put the best team on the field, ice, or the court. And that's our goal here. That's what we're going to talk about when we're building our stock portfolio, right? I'm the general manager, the manager of my team. The only way I'm going to win is when I build it the right way. Okay, so there are different ways to do that, and I'm going to discuss those. First of all, we like to talk about our strategic investment matrix. Right here at VectorVest, we believe it's important that you put yourself in the right position based on what your investment bias is, right? What you're looking to accomplish. Now, when I talk to somebody, what's your goal in the market? The answer that drives me crazy is, well, I just want to make money. Of course, that's the answer, but how you do it, right? The strategical and tactical ways we do it are very important. It begins with the strategic investment matrix, and as you can see, right, the more speculative investor is not worried about high risk. They don't care about the value of the underlying stocks. They're just looking to make a quick buck, and they're going to struggle in the market more than not. We categorize as an aggressive investor, someone who's looking for value. The safety is not as important. So we break that down, but where the target is for most investors, and when you sit and you kind of analyze it on your own, or you analyze your investment matrix or your bias, hopefully, right, we believe that the best spot to land, of course, is as the prudent investor, where we're talking about high reward and low risk. High reward and low risk is the definition of the prudent investor. The conservative investor is to a position where they may not even worry about the high reward. Maybe capital preservation is more in mind for the really conservative investor. So we like to think that the prudent investor is getting the best of both worlds with that high reward. So we look at stocks with relative safety that are higher and relative value being very strong. So the fundamentals being in place when we talk about that strategic investment matrix. So when we talk about building a winning portfolio and managing a winning portfolio, basic risk management tactics are essential to achieve success. In other words, you've got to have a plan. You have to have a process, a technique, whatever you want to call it. But risk management tactics are what's going to make you a better investor, right? Having a plan. Right? There's an old saying I like to use that a goal without a plan is just a wish, right? A goal without a plan is just a wish. So you've got to have a plan in place. So the management tactics, how you protect and preserve your portfolio, whether it's your retirement portfolio or your trading portfolio, I don't care what it is, you've got to have a process behind it. That's how you're going to be successful. So again, remember, I'm laying a foundation here with some key points when it comes to building and managing your portfolio. So the guidelines that we use here at VectorVest, and they begin here, and you're going to tweak them, and both Jerry and Steve are going to come up later and delve a lot deeper into the system and the process that you can employ to be successful. But I'm going to lay the foundation here for you, and it begins here with number one, buying stocks in up waves and selling or protecting stocks in down waves. Steve just talked a lot about market timing and market trends, how we go into the program to use the power of VectorVest to know when to buy, what to buy, and when to sell. Okay, so it only makes sense that we're buying stocks in an uptrending market, we're selling them or protecting them, right, using risk management techniques such as stop criteria, our exit strategies. What we use a lot in our retirement coaching groups are buying put options and using other ways to protect your net worth in downtrending markets. Okay, so again, buying rising stocks in a rising market, protecting or selling them in a downtrending market. I'll talk about that. Point number 2 is using a dollar-weighted system. So I'll discuss that more when I go in and build a portfolio, but it's just the idea of diversification, right? We don't want to put all our chips on the table on any one stock. We don't want to risk scuttling our entire portfolio because we have 80% of our net worth or what we allocate to that portfolio invested in any one stock, no matter how good you think that stock is. Okay, so we're going to dollar weight our portfolio so that we don't over risk any individual portfolio. We're also going to weight our portfolios by position, right? So the individual investor, we talk about 10 to 20 stocks in a portfolio for the average individual investor. You may have 5 stocks, you may have 50 stocks. It depends on the size of your portfolio. That beeping is not me, right? Okay, so it may depend on the size of your portfolio. Or the dollar amount allocated to your portfolio. Generally speaking, for the average individual investor, we talk about maybe 10 to 20 stocks. Sometimes for a larger portfolio, perhaps on a dividend portfolio, you may add a few more stocks to that. But we don't want it to come to a point where you feel as though you're managing, your own mutual fund or hedge fund. So we talk about 10 to 20 stocks. Whatever number is comfortable for you is what you're going to insert there. I'm going to talk more about don't risk more than 1 to 2%. If you've got notes out, if you've printed these out, put in per position, right? You don't want to risk more than 1 to 2% of your portfolio on any one position. So that doesn't mean we're putting 1% stop loss on any individual position. Okay, I'm going to go through a formula for that in a moment, but I don't want to risk any more than 1% of my or up to 2%, again, depending on how you're playing this, but 1 to 2% on any single position as it relates to the value of my portfolio. Okay. And then finally, don't ignore sell recommendations, right? Or sell ratings. We call them recommendations, we call them ratings. There's a lot of information in the VectorVest program. You should be aware of and have it available to you at all times. It doesn't mean you're going to act on every single piece of information, but to ignore it is a huge, huge mistake. And I'll talk more about that when we go in and talk about building the portfolios. So let's break these down individually here as we walk through them. Key point number 1 here is buying stocks in up waves, selling or protecting in the down waves. Right, so you're going to pick the market timing system that best suits both your temperament and your profit objectives, which you darn well better know before you start hitting the enter button. Okay, for example, one just broad example, if you're building or managing a retirement portfolio, okay, your temperament or your objectives may not be based on the primary trend of the market. Okay, and if you are a more aggressive investor, which, by the way, there's nothing wrong with being aggressive versus being prudent, as long as you know what it is and you have your tactics. I'm not saying one is better than the other. Speculative, I'm not so sure of, but aggressive investor, you're going to have a process and a system in place. Now, Steve talked about, he's got the market timing graph right up here. I can just come back in real quick, and I'm just going to go to the basic MTI layout, and if we just set up here, I'll use the DEW as the example, and I'll use this area of the sell-off because it's easy to illustrate here, right? So depending on, and I'm just reviewing what Steve very nicely went through, we have the market bottom there. I have the DEW timing system here. Okay, what about 7 or 8 trading days after the downturn there? Still a great time to enter back. This is the pandemic sell-off that we're looking at. Confirm calls would have had you in a bit later. Okay, is that right or wrong, better or worse? The answer is it's up to you. It's up to what your objectives are. How much confirmation do you need that the market is moving up? Are you more aggressive? Then by all means. And I know Steve is going to talk more about this later when he comes up. The green light buyer technique is a wonderful way to look at this. The key here is understanding your objectives and understanding what you're looking to do, and then taking the power of the VectorVest system of market trends and timing to put it to the best use for you. Okay. Okay, so it's very important that you understand those objectives and what you're looking to do in the market. So that's a very important concept, in my opinion. So again, I talked about investing evenly into each position and making any new purchase at the average value of the current position. Because I'm not a mathematician, I'm going to use some basic numbers as my examples, right? I don't have a degree I have a degree in political science, which tells you how good I am at math. But we're going to talk about investing evenly. The example I'm going to use is this. You have a $100,000 portfolio. You're going to own 10 stocks. You're going to put $10,000 into each position, right? If you do that, you're investing evenly into each position. Then add on the fact that if you had a 10% stop loss, what are you doing? Going back to the point I'm going to come up to again in a moment. You're risking 1% of your portfolio on any one position, okay? And I'll talk more about that. But that's what we mean by dollar weighting, okay? You don't want to have all your chips on the table on any one individual stock, all right, or even two of them. I talked about holding on to 10 to 20 stocks, diversify in how many stocks you buy to help manage your risk. When I go into actually building the portfolio, and later today when Jerry and Steve talk about more specific trading systems or investment plans, we're going to also diversify and talk about, the stocks in any industry or sector, right? You don't want to overload any industry or sector either. So diversification comes in how many stocks you own, how you allocate your assets, and the industries and sectors that you invest in. We talked about this. Don't risk more than 1% to 2% per trade or per position of your entire portfolio. We're going to use one of the techniques, or an important one that you're going to learn about, if you don't already, I'm sure you do, is using stop losses to help manage the risk and avoid catastrophic losses. Right? We always say the idea of when you invest in any position or your portfolio, right, 4 things can happen. Well, technically 5, you break even, but 4 things can happen. You could have big gains, small losses, or large losses. Right? Those are the 4 scenarios. What we have to avoid when building and managing your portfolio, of course, are the catastrophic or the large losses. Right? That's what we can't have, whether you're trading management type safe stocks or if you're trading options on a short-term basis. Right? The catastrophic losses are what we need to eliminate. So we have a plan. There are tactics that are involved. The VectorVest Foundation for building and managing a winning portfolio says don't risk more than 1% to 2% per position as it relates to the overall value of your portfolio. Okay. Now, I'll let you guys use this. You have it on the slide. You can write it down. There's an actual formula here, but if you look at the bottom, it actually breaks it down to what I just talked about. When you apply this formula, you fill in the numbers as pertains to you. Fill in those numbers. So the percent risk of loss in any single position should be equal to 1% to 2%. 1% as you're beginning and starting out with this idea. So it says with 10 positions and 100% of the capital that you allocate to this portfolio, you can afford using a 10% stop loss on each individual position. Right? If I have $10,000 in a stock, I put a 10% stop loss, I lose 10%, that's $1,000, that's 1% of my overall portfolio. As you get more comfortable, you may tweak that. We say go up to 1, 1.5%, 2%. But feel comfortable with what you're doing. Understanding that the takeaway here is that I'm not going out, right? Glenn talks about how much he loves Apple. Now, I'm pretty sure it's not 90% of his portfolio. Although knowing Glenn, it might be. He does love Apple, but he loves his Apple. Okay, so that's the point there. And then finally, we talk about don't ignore sell recommendations, right? Use hold ratings as an early warning to watch closely, right? The same way, if I'm a little more prudent in watching the market trend, right? I may not sell all of my prudent high relative safety stocks, you know, when they become a hold rating or when the first red light appears in the color guard. Okay, that might not be my trigger to all of a sudden go to cash and run from the market. But it is a piece of information, and it's an important piece of information. So one illustration of that, one example of that is if you own a stock, it's a buy-rated stock, it's moving, it's doing what you need and want it to do. Suddenly that stock becomes a hold, use it as an early warning. Use it as a red, or in this case, a yellow flag. Okay, to watch your position closely. What could you do? Buy some puts, sell some calls against it, tighten the stop. Maybe you turn around and sell the position because you're not comfortable with the overall market. Right? It all comes back to kind of take the entire day and put the power of information, especially the VectorVest information that we talk about, right? It's the old quote from the movie Wall Street, right? For those who remember Gordon Gekko, right? He said that the most powerful or the most valuable commodity that he knew of was information. It's the most valuable commodity that you can have when investing. Owning a stock that's a buy-rated stock, going to a hold rating, is a piece of information you should not ignore. Doesn't mean you act on it right away, but you mark it down and you know what you're going to do from there. Okay, so with that idea in mind, right? So with this idea of coming from the overview of the strategy of how to build and manage portfolio, how to use VectorVest, we'll talk a little bit more about the tactics that are involved. I'm going to do some navigational walkthroughs for you using the portfolios. Again, Jerry and Steve are going to build on that as the day progresses. Now, the VectorVest portfolios allow you several things to do. To paper trade, right? If you're interested in kind of testing a system in a portfolio, you can build a model portfolio to track, or you can plug in your current portfolio and monitor that those existing positions that you're in. Okay. So that's the first thing I'm going to do. I'm going to go into the program. Let's see. I just passed it. Let me go. I'm going to go into the program. If I could find the program. Where are you, program? That's a graph. Where's the... There it is. Okay, thank you. A lot of graphs were up there. So we'll start from the home page. We're taking a look here. And what I want to go in, I just want to do it from the home page and start showing you some navigational things and then coupling that with how to use the tool here, how to begin to build and manage that portfolio. So the first thing I'm going to do is click on the main toolbar. I'm going to choose Portfolios on the main tab. Over here on the control panel, we have Portfolios Home, VectorVest Portfolios, and My Portfolios. So I'm going to choose My Portfolios. Okay, there are some available here already, but what I want to do is walk through the process of building a portfolio, showing you how to manually do it first, and then showing you a little quicker way. If you want to paper trade some stocks you've been following, or if you want to mirror your real-world portfolio. So from the My Portfolios tab, I go to Create Portfolio, and let's just name it My Portfolio. Did I spell it right? Look at that, I did. You could fill in, you know, whatever you have here that meets your criteria. Whoops. Right, so you want to build a $100,000 portfolio, for instance. You could fill in the commission type. I usually put none. Most mainstream brokers no longer charge commission. Do you use margin, interest, whatever you want to put on there? And then you can put whatever description you want, why you built it, what it's following, whatever you want to do. So when I click OK, what it does is now creates my portfolio. But we've got nothing in it yet. I want to show you how you can add a trade manually to either test paper trade or to mimic a real world portfolio that you may have. Let's say you went out, I don't know, it doesn't matter when. You went out on May the 4th, okay, and you bought, I'm just going to use the alphabet here. You bought Agilent Technology, okay? I'm using a $100,000 portfolio. What price did you buy it at? Let's see what the price is now. It's trading at 123. Let's say you bought it at, I don't know, let's say you bought it at $98, okay? And because I am dollar weighting my portfolio, it means I would have bought approximately 100 shares of the portfolio. If I hit edit, no commission, hit apply, gives me a chance to check it out, and I hit OK. Are you sure you want to place the following trade? Remember, you're not actually buying this for real, so hit yes. And what I've just done is enter into a blank portfolio a position. Again, whether it's a real world position or if you're looking to manually set up a paper traded account that you want to use. So, because I used the earlier date, it actually shows an equity curve for owning it, and we're up 2.5% on the stock. The portfolio has the spreadsheet, just like the other viewer pages. You can set it up, have all the important information that you need or want. Here, you can graph your stocks. There's a lot you can do. Okay? That's how you add a trade. I'll walk through it one more time just to show you again. Right? I'm going to use B this time. Let's say I just bought it today. It's trading at, we'll call it $30 a share. So I could buy what? Roughly what? 310 shares would make it how much? Right? There we go. I'm still using roughly my dollar weighting here. I hit OK, hit yes. Now I've just added my second position in. And that's how you would go about manually building a portfolio. Now what you see here is me manually doing the cost basis. It shows you here the cost basis. If I had a $100,000 portfolio, I could continue to do that and add one stock at a time, making sure I'm within this range. Okay. Now I could come up here and I can also manage my portfolio. I can edit the portfolio. I can edit these trades if I want to. I'm going to talk more about some of the things you can do. I can could view trade history. There's a lot of tabs here. I'm going to talk about that at the end. So that's how you would go about building a manual portfolio. I'm not going to enter 8 different trades to show you that. Okay. You can, if you have issues, you can always call product support. They'll help walk you through any of these navigational issues. And maybe now's a good time. Glenn's navigational series is under training or welcome? Under training. Let me take 30 seconds here just to show you something really valuable. If you're new to VectorVest, click on the training tab and come over here to the right is the navigation training series. And this, whether you're new or not and you're just looking for a review of how things work, Glenn put together these sessions here to walk through a lot of different navigational things for you to use. So he's got portfolios up here. Now to sit through all of these presentations at once is a lot of Glenn at once. So be careful of that, right? You know, I'm just teasing. But anyway, it's really important stuff and good information there to have. Okay. So that's how I would manually set up my portfolio. What I want to show you now is how to, I'm going to use the quick folio option here. So that's how you can you can paper trade using any system, or you can monitor your existing portfolio manually. What I want to do now is build a portfolio using those 5 key points that we talked about. I'm going to use just high relative safety stocks that follow all the guidelines that we just covered on that basic foundation that I've been talking about. Right? So let's go ahead and build a portfolio of high relative safety stocks that will allow me to do that. So to do that, now I can go ahead several ways to build this portfolio. I can come in and I can simply go to maybe a watch list that I created. I know Glenn created a watch list earlier. If I go to the Viewers tab and I go to Watch List Viewer, and I think just Glenn set it up. Where did he put it? Oh, he created a whole, that's right, he created a folder called Masterclass. Oh, okay. So he created a folder called Masterclass, and then he put a watch list in here. So if I want to create a watch list, I can do it, a portfolio, I can do it right from my watch list. And we were commenting earlier there, but if I were building a portfolio from this watch list, one of the things I'd have to be careful of is the diversification I talked about earlier, right? Again, Jerry and Steve are going to talk a lot about this, but if I look at the industry, I got a lot of energy stocks here. I have petroleum stock, so I want to be careful that I'm not overweighted in any one industry. So I can do it from a watch list. What I'm going to do is go back to the stock viewer page. I'm going to set it to current, so I'm going to hit stream. It's going to set it up here. And I think it's already sorted the way I want to sort it. So I'm taking over 9,000 stocks in our current database, and I've sorted them. The default sort in the stock viewer page is value, safety, timing, which is also a great way to sort them. But I just want to show you some of the things you can do. We're sorted by relative safety, right? And we're in real time here. We're just not running them right now. First of all, the thing that amazes me is that right now out of 9,100 stocks, this is like its own market timing indicator, there's only 10 stocks with a relative safety rating of 1.4 or higher. That's an amazing number. For 15 years I've been looking at this, and I don't think I ever remember, I don't know if you guys remember, a time where there's only 10 RS stocks above one at 1.4 or higher. Anyway, the market's in a downtrend. We've got red lights. We've got confirmed down calls. So I'm not saying you'd start a portfolio today. I'm saying this is how you would create it or prepare yourself to create it for the next confirmed up call. So what I'm going to do is take these high RS stocks and I'm going to tag these top stocks somehow, eventually. Okay? And I'm going to put them into a portfolio. The way I'm going to do that is to come up here to this toolbar and choose Quick Folio, the stocks that I've selected. When I do that, it's going to bring me to a control panel that will allow me to fill in, again, the information I want to put in, whether I'm using margin, whatever it is. I'm buying these stocks, so I'm going along these particular positions. And I also have the ability to add stop criteria. Again, now we're starting to add risk management to this. I can hit Edit Stop Criteria. And there's a lot of choices here. I'm not going to go through every stop criteria that we have built in here. I'm going to use, you could use rec equals sell. I'm going to use just a gain-loss percentage and say, all right, if we gain, I don't know, 50%, or if we lose 10%. So this is sticking with that 10% loss for my $100,000 10-stock portfolio. Okay. I hit OK. I would name it. I'll just leave it as Quick Folio 1. My investment, everything's in order. I hit OK. The system now knows that I've created and set up this portfolio. All I have to do is left-click on that, and under the Portfolio tab, I am now looking at my portfolio that I just created. Okay. I've got all the important information I need. I've got my my price, the VST, and again, you can customize this to have what you want in here. And I've just created my portfolio. I've got my stop criteria in place. It even gives me my stop value, whether it's a gain or a loss on the individual stock. Okay. Now, what this hasn't done is diversify by stock, or by industry or sector. Right? It doesn't break this down by industry or sector. So I don't know if I'm overweighted in any one industry or sector here. Okay. So that's important to understand. But what I'm able to do is set up that quick folio, and now this portfolio is set. But remember, we talked about the certain risk management techniques that we need to add in here. Well, I can do this manually, and I can keep an eye on it, and I can, as I showed, I can add trades, I can sell stocks, I can right click, close a position, edit stop criteria. There's a lot I can do via the right click on the mouse within the VectorVest program. The old saying is, when in doubt, right click. Right? If you're looking to do something in the VectorVest program, highlight a stock, right click, and it'll take you there. What I'm going to do is come over here to the Edit tab. And here's where I can begin to automate or set up my trading system. And I can hit Edit. And here is where I can add some of the things that we talked about in our building and managing techniques. Now, we have what's called the Genius, the portfolio manager. It's called Genius. I'm going to shut that off for now. That automates the management of my portfolio. I'm going to come here, and remember, I started either with typing in manually stocks, or I picked a watch list, or a search. You can use a unisearch or whatever it might be. So I've picked those stocks. I've chosen the stocks that I want to purchase, assuming the market is right. I'm not saying go do this today. But now I can build my system right through the market timing, right through the portfolio manager. So let's put that together. Remember, we want to buy stocks in up waves, we want to sell them or protect them in a down wave. So if I'm looking for times to replace or build this portfolio using my retirement-minded process, I'm going to click Use Market Timing, and I'm going to select Confirm Calls. Keeping in mind that you can use the DEW, primary trend, green light buyer, whatever it might be. It'll define that for you, and I'm just going to leave that there for now. I could either hit Next or just click on Automation Rules for a confirm. Remember, I'm automating my portfolio now. So I have no plan or system in place. I just have 10 stocks that I purchased and I put a stop loss on. That's all I've done so far. Moving forward, I can automate this portfolio now and say, when I'm going to replace these stocks moving forward, well, if I'm looking for high RS stocks, I'm going to use my favorite search, ruler stocks. Okay, that now becomes part of the rules of my investment plan. Okay, now the system knows to do that. The stop criteria I chose, and again, you can choose any one you want for our purposes here, was a 50 gain and 10%. 50 gain and a 10% loss. Okay. I'm going to hit More Settings. Again, the tactics that we use. In this portfolio, it's a $100,000 portfolio. I want to maintain 10 positions at $10,000 per share. In other words, the average value of my portfolio. That $10,000 will go up as the average of my stocks go up. Over time, if your portfolio, I have portfolios that we use, go from $100,000 to $200,000. Well, now, using this context that we have, when I use the average value of my portfolio, what's happening is now I'm investing $20,000 into each position. But for here, we'll automatically replace using 10%. We won't limit the number, and Steve and Jerry will go into greater detail here. When entering this position, I'm not going to sell any stocks. Right? I'm going to hold them and let the stop criteria extinguish the positions. You have the choice to limit repurchases, maybe a week, maybe you want to use the wash rule, make it out to 30 days, whatever it is you want to do. Now here is where you're able to make sure as you build the portfolio that you're not over-invested in any one industry or any one sector. So for 10 stocks, generally I would say I don't want any more than 2 per industry. Right? You could say 2 per sector, however you want to do it. Okay, again, Steve and Jerry will talk much more about that. All right. I then go to Automation Rules Down. for my purposes here, it's a more prudent portfolio. During a confirmed down, technically, we're not going to sell our stocks or go to cash. You can, and there are great ways to do it. I'm just illustrating the portfolio right now. We're going to allow the stop criteria to extinguish the position. Doesn't mean if you hold these positions in a confirmed down, you can't protect them. You can tighten stops, and you can buy put options to protect an overall portfolio or an individual stock. I hit finish, and I hit save. So now moving forward, the portfolio is now automated, and the system knows what to do as I move forward. Okay, it's going to automate it for me. It's even going to give me alerts. It's going to let me know when a stock is stopped out. Okay, whether it's to the upside or downside, right? We could hit that profit target. And we move forward from here. But that's how you build and manage your portfolio. So just to review, those guidelines. See if I just want to go back to keep it in perspective of the 5 key points that are built on this. Market timing, the trend. Buy stocks in up waves, sell or protect them when the market timing trends tell you to. Read the strategy every night, really. Watch the daily color guard report. Read Friday's views. Heed the color guard. Don't overweight any single position. Right? Now you're just becoming speculative. And while it might work once in a while, over time, it's not going to be the tactic that you want to use for a winning portfolio. Make sure you're not over-managing too many stocks. Don't risk more than 1% to 2% on any one position as it relates to the size of your portfolio. And keep in mind market trends, the trend of the stock, buy, sell, or hold ratings are very important. So make sure you keep an eye on all of that information. Okay? So we went through that. I showed briefly there's a transaction log, summary report. Okay, all of these things are available to you in the program by this reports tab where you can go in. You can look at every transaction that you do. Trade history, there won't be any yet because it only shows the round trip trades. Summary report, there's a lot you can do here, okay, right under that reports tab. Nobody does it better than VectorVest, right? VectorVest has everything that you need to both build and manage a winning stock portfolio. So we've taken the step going from the philosophy, how we rank and analyze stocks, how we recognize trends in the market, to actually going into the program and understanding the power that's available there for you to build and manage your portfolio. Again, those are the basics. Steve and Jerry are going to come in and show you a whole lot more. So with that, again, thank you for taking the time. I'm going to throw it back to Ray. Everyone stay safe and stay healthy, and we'll see you next time. Ray, back to you.
Thanks a lot, Jim. What a great presentation on how to build a winning stock portfolio. This is really going to propel us into the next phase of today's presentations when we come back from lunch, which we're going to take a break for lunch here in a moment. And we've got a very special presentation during the lunch break from Dr. Bart DiLiddo as well on how the market works. So he's going to piggyback off of some of the things that Todd was talking about earlier with the climate of the market and looking at the earnings trend indicator. So stay tuned. That is a great presentation. Just a couple of things. Some of you have been asking about the slides. Again, if you want to download the slideshow presentation, just go to vectorvest.com/MC slides. And then if you want to take advantage of that trial that I mentioned earlier, it's a 60-day trial. It comes with all of the tools. It comes with your auto timer, which gives you the genius that Jim was just talking about, that you can automate your trading system. It comes with Pro Trader, which has technical searches. We'll be talking about that later on today. And it also comes with the group coaching, the Successful Investor Group Coaching, where Todd Schaefer and Mr. Brian D'Amico will hold your hand week by week as they manage a portfolio and navigate the current markets. Just as a side note, for that trial, it is free for 60 days, and you do have access to all those other tools. At the end of that 60 days, it'll automatically just go into a regular standard intraday billing and conversion for that tool. And then if you decided, hey, I want the auto timer or I want the coaching, then you'd have to give us a call because that's only available during the trial. So just a side note there. And then we've also been getting some calls and product support if we have any discounted courses. A lot of people have been asking about the Successful Investor course. And I talked to marketing, and we're going to extend our Labor Day sale that we had on courses just for today for all of you. For anybody who wants to take advantage of one of those courses, you can go to www.vectorvest.com/mccourses as well and take advantage of any of the courses that are listed there at those discounted prices. So we're going to take a quick lunch break. We'll be back in a little while, and you'll be able to hear from our founder, Dr. Bart DiLiddo, once again. We'll see you soon.
I'm going to talk about how the market works. And what I'm going to talk about is what causes bull and bear markets and when they begin and end. I find that to be one of the most interesting subjects to talk about when you're talking about stock market, because the worst thing that can happen to an investor is to be on the wrong side of the market. And I wrote an essay today about this subject because on December the 29th, in the news section of VectorVest, there was a one-liner that said, how I was wrong on the market in 2017. And I thought, well, I'll read that. And the gentleman who wrote it has a newsletter, and he admitted that he was talking about a bear market before the end of this year. And then he goes on to say that he was bullish throughout this long bear market since 2009. And he finally follows up by saying he predicted a bear market in January of 2016. And I recall that when I started investing in 1960, I didn't know anything about bull and bear markets. And so I read books and did everything I could to learn all I could about the stock market, and I subscribed to various newsletters. And there wasn't one of them that ever mentioned a bear market. Now, I asked this question earlier tonight. Nobody got the right answer. But does anybody know, other than those folks that know the answer, how many bear markets there were between 1960 and 1975? Anybody know? I'll tell you, 6. There were 6 bear markets, and nobody mentioned a single one. And then, of course, in 1982, the market exploded in August of 1982. Interest rates came down, and Greenspan became the new Fed chairman. And I was subscribing to a newsletter written by Joe Granville. Anybody remember Joe Granville? Yeah, he was the guru of all time. Well, when this market exploded, he said it was just a bunch of balloons going up in the air. It wasn't going to last. And it was going to end up badly. And it was, in other words, it was a false rally. Well, that call cost Joe his business because he stayed bearish all the way into 1988. He didn't deviate. He just stuck to his call. And it hurt Joe a lot. Up until that time, he pretty much had his way. So I think it's very, very important that we have a feeling for what causes bull and bear markets and when they begin and end. So let's get started. The efficient market theory states that all market participants receive and act on all relevant information as soon as it becomes available. That sounds pretty good, doesn't it? But I have never received any relevant information as soon as it is available. And the reason why is I'm not a participant. I've been in the market now for over 50 years, but I'm not a participant. And the reason why is I haven't signed up with the news agencies to get their information as soon as it is released. So I'm not a participant. And so I don't feel bad about that because it's my fault. And also, what is relevant information anyway? Relevant information is any economic, financial, political, geopolitical news or anything else, such as new products that cause share prices to rise or fall. Anybody ever hear of Apple computer? They had a little problem with their batteries running dead earlier than expected, and it hurt Apple pretty bad. That was product news. But usually anything happening with economics is big stuff. And there's a tremendous industry that goes into providing this information. And so everybody wants to leg up. They want to get that piece of information as soon as they can. Since everybody supposedly gets it all at the same time, it makes it an even playing field. Everybody except you and I, of course. So let's move on. The efficient market theory implies that it is impossible to beat the market since all relevant information is efficiently incorporated and reflected in share prices. That is reflected by the professors at the University of Chicago that preach the random walk theory, that you can't beat the market since everybody has the same information. Everybody's on an equal playing field, so you can't beat the market. The only way that they say to make more money than the market, to outperform the market, is to sign up to their service. That sounds reasonable, doesn't it? Okay. The efficient market theory compels market participants to get relevant information sooner than anyone else and implement it faster than anyone else. And to get it sooner, these companies, they will install their computers right next to the data centers, right next to the stock exchanges. And to implement it faster, you ever hear of high-frequency trading, where they can make 100,000 trades in less than a second? I mean, a split second means a lot to them. Now, I happen to have one of those outfits in my backyard, so I'm okay. That's a joke. So anyway, let's move on. Finally, Thomson Reuters delivers the University of Michigan Consumer Sentiment Survey on a preferential basis. The data is released to elite clients at 9:54 minutes and 58 seconds a.m. Regular paying customers get it at 9:55, and the public, that's you and I, we get it at 10 a.m. So if a split second means hundreds of thousands of trades, imagine what 5 minutes means. It means all the money they want to make, at least for that day. So how does the average investor, in other words, you or I, cope with this situation? We have to look at the big picture. And after mulling over this for some time, it appears to me that we have to look at the big picture. Stock prices rise whenever the news implies that the economy is improving and earnings are rising. That sound reasonable? There are two other forces we have to think about. All relevant information is manifested by changes in earnings, inflation, and interest rates. So those three things are all we need to care about. Of the thousands of news items that come out every day, you don't even have to bother with that stuff. The only thing you need to look at is earnings, inflation, and interest rates. And that is talked about a lot. Let's go on. So let's look at earnings. Here's a graph of the S&P 500. Oh, this thing goes back, I don't know, 10, 12 years. Can you read the numbers at the bottom, Kathy? 96. Well, it goes back about 20 years. Here's the price of the S&P 500, and here are the earnings. This is a 50-day moving average, so it's a little bit skewed, but you can see the correlation is fantastic. So we conclude, the next slide, that stock prices increase with rising earnings. Anybody disagree with that? You know, we still have some booze out there if you want it. This slide here is the S&P PE ratio versus the Consumer Price Index from 1960 to December 2017. We're using a 20-week moving average here because the data is pretty wild. On the left, in the blue, we have the S&P 500, and that's it, that's this line here. And on the right, we have the Consumer Price Index percent change. And we can see that as the CPI goes up, the PE ratio of stocks goes down. And when the CPI goes down, the Consumer Price Index goes up, and so on. Well, we finally came to 2008. In 2008, you know, this was a wild time. And now we're finally starting to recover from that major perturbation. Anybody ever heard of that word? I learned that when I was in college. That means a big move. And this graph started in 1960. That's when I started investing. Part of that, nothing meant anything. That's like medieval ages, okay? So this is the important time in history here. Inflation. Stock prices decrease with rising inflation rates. I have a very interesting graph here. What we have is the S&P earnings yield versus 30-year T-bond interest yield. You might wonder what the earnings yield is. The earnings yield is the reciprocal of PE ratio times 100. Everybody has heard about dividend yield. The dividend yield is simply the dividend that you receive divided by the price of the stock. So if you receive a $1 dividend and the stock price is $20, you know that the yield is 5%. And earnings yield is the same thing. If their earnings are $1 a share and the price is $20, the earnings yield is $1. And I like earnings yield a whole lot more than I like PE ratios, because PE ratios, when you get down close to zero, the PE ratio goes sky high, and when it is zero, it's infinite. And I have to have an extra double header of scotch to understand what that means, okay? So I like to use earnings yield. And what we have here, in the blue, we have the earnings yield, as I defined it. And on the red, we have the interest yield. So we see that when the interest yield goes up, that means when inflation, when interest rates go up, their earnings yields go up. And the earnings yields go up when the earnings go down, okay? All right? And the reason why is that when interest rates go up, it usually slows down the economy. When the economy slows down, earnings per share go down, and the earnings yields go up because the earnings is in the denominator. No, it's in the numerator, I'm sorry. And the prices go down. So this is a very excellent correlation here. And the reverse happens too. Back in 1979, 1980, the interest yield was, you see that red line, it hits 14% there. Anybody remember that? It's a great time to buy bonds. And the PE ratios were something like 3 and 4. They were low. And then a guy by the name of, who was that guy that was a Fed chairman? Oh, he came in. Wow. Okay, but he raised interest rates. He raised them and raised them and raised them until, and his interest was to break the back of inflation. but he raised interest rates, and finally they started coming down. And it came down, 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 and it's still coming down. Okay? And here's 2008, 2009 again, and you see the earnings yield is coming down also. So, we have those three factors, and what can we conclude? Let's go to the next slide. Stock prices decrease with rising interest rates. So let's sum it all up. Here we have stock prices go up when earnings go up, inflation goes down, and interest rates go down. Okay? Those are the three things we all look at. Now, what's interesting, let's go on the next slide. What causes bull and bear markets? Earnings, inflation, and interest rates rise in a strengthening economy and fall in a weakening economy. The next thing we know is that the Federal Reserve Bank is mandated with the task of maintaining monetary stability and full employment. So the Federal Reserve Bank has two mandates. One, to stabilize the monetary system, and two, to maintain full employment. But these two goals are incompatible. You either get one or the other. And so they're walking a tightrope. To maintain monetary stability, they raise interest rates to cool overheated economy because they're afraid of inflation. So to maintain full employment, they lower interest rates to stimulate a weak economy. So when the economy is strong, they raise interest rates. When the economy is weak, they lower interest rates. And if you've been following the market reasonably well, you know that they're always talking about inflation. Inflation is a wild card. So let's move on. And I call this the virtuous vicious cycle. Inflation dictates the Fed's interest rate policy because they're always talking about inflation. When the economy was weak, they were lowering interest rates because they did not want inflation to go into deflation, and deflation is worse than inflation. So they wanted to maintain a low enough interest rate to avoid deflation. And they set a target of, they wanted 2% per year core inflation. So interest rates then dictate the strength of the economy. Well, they lowered interest rates and they kept the economy going since 2008, 2009, and it slowly was getting better. And as the economy gets better, it dictates earning growth, and earnings growth gets better and better. Earnings growth, in turn, dictates the stock price performance. And only a few of us can complain about what the stock market has done since 2009. I know there are some of us that will complain no matter what happens. I get calls from them all the time. Okay, so the Fed policy actually dictates bull and bear markets. They have a lot to do with it. Those 6 bear markets that happened between 1960 and 1975, does that sound like a reasonable natural cycle? No. They had people as head of the Federal Reserve, that jacked interest rates up and down like crazy. And so they were responsible for a lot of that up and down business. Okay, let's move on. Now, we at VectorVest, having recognized all of this, we monitor the level and trends of earnings, inflation, and interest rates. And we do this in the investment climate. And the investment climate is published each and every week in the VectorVest Views. I hope everybody here reads it. Do you all read it? Raise your hand if you do. Okay, you're a bunch of liars, I know that. So let's move on. What we have here, we have a situation where we know that rising earnings are good and falling inflation is good and falling interest rates are good for stock prices, okay? And then they're bad when they turn down. I have to say one thing about interest and inflation, however. When the economy is weak, the Fed is lowering interest rates and wants to get inflation to start moving higher because it's afraid of deflation. And rising interest rates, when inflation is low, like right now, if it gets up to 2%, that's fine. It may even go up to 3%. But if it does, the Fed's going to start worrying. Prior to 2008, it would have to go up to 4 or 5% before the Fed start acting and raising interest rates. But the Fed already is raising interest rates because they got other problems. They spend a lot of money, buying bonds and doing a lot of other stuff. But they're eager to try to get back to normal situation. So we put all this together, and we have three variables with two conditions. They either go up or down. And we would put that together. We have 8 cases. So we've identified every combination. So like E stands for earnings, U means up, F means inflation, I means interest rates, and P means prices. So a bull market begins when we see the first hint of inflation. Interest rate can still be going down, and the first hint of earnings power. If somebody raises their prices at the bottom of a bear market, boy, that news will spread like wildfire. For example, in 2009, the thing that sparked this bull market was that word came out that Citibank made money in the first quarter. That is all that it took. And the market took off like a bird. So here's a situation where everything is going right. You've got rising earnings, decreasing inflation, decreasing interest rates, and rising prices. This is what I call the Goldilocks scenario. Because in our valuation formulas that we have in chapter 3 of my book, prices go up big time. When earnings go up, inflation goes down, interest rates go down. So the bull market thrives here. But this situation doesn't last too long. And you relatively seldom get a situation where inflation is going down and interest rates are going up. So finally, we get into what we call the case 4 scenario, where earnings, inflation, and interest rates are going up and prices are going up. And we've been in this scenario now for a long time. Case 4 situations last a long time because this is where everything is going up and it's still a bull market because earnings are going up and the Fed is careful about raising interest rates normally. And so this is a situation where we are climbing a wall of worry. People are worried about when is it going to end and that sort of stuff. And people are always talking about the end of the bull market and yada, yada, yada. And one of the things is psychologically, when you're coming off of a bear market, a bottom of a bear market, investors are looking for anything at all that could spark a rally. And they take the economic news and they spin it so it's always good. When they're in a situation like we are now, a case 4 situation, they generally take economic news that if it's a hint, like a CEO says, well, you know, he comes in with blockbuster earnings and the price of the stock goes up. And then he says towards the end of his talk, but next year it might not be as strong as this past year. Bingo, stock drops 20%. You've seen it over and over again. People are worried. They made their profits. They don't want to lose them. And so they got to climb that wall of worry. Okay? Now, this looks very complicated, and I made it that way because we get a higher price for our product. But it really is very simple. E stands for earnings. And note that every time earnings are going up, we're in a bull market situation. Every time earnings go down, we're in a bear market situation. So the thing we have to watch, and watch very carefully, is earnings per share. And what we do is we look at the average earnings per share. We look at forecasted earnings per share of the S&P 500 stocks, because that is where the best data is. And the data is readily available. And this is where, the big money follows the S&P 500 very closely. So let's move on, Kathy. Bear markets begin when the economy is strong, inflation and interest rates are high, and earnings are expected to fall. Okay? I'll answer that last part in a minute. So let's go to the next slide. On Friday, November 2nd, 2007, I wrote an essay about buying contra ETFs and warned readers that yesterday's confirmed down signal could be the entree to a long bear market. Why did I say that? Because we track earnings, the earnings trend indicator, very, very carefully. And we could see this thing went up rather dramatically from the bear market bottom of 2003. It kept going higher and higher, and it started coming down. It was going down, it was going down, and going down, and we're tracking it. And that earnings trend indicator has to stay above 1 for it to say we're still in a bull market, because if it goes below 1, then it's in a downtrend. So we were tracking that. And that is actually based on an earnings forecast. So when the analysts start lowering their forecasts, it's a sure sign that trouble is brewing. Okay? So let's move on. So from November the 1st, when we got the C down signal, to March the 10th of 2009, when the market exploded, this is what happened to the price of the VectorVest composite. Okay? That's not a pretty picture. Unless you were short. And of course you have to remember, VectorVest advised its subscribers to buy contra ETFs. Anybody know what a contra ETF is? You do. That's why she's wearing that very expensive dress. Contra ETFs go up when the market goes down. And we wrote an essay and explained it. And we could have a lot of fun with that. But so this is when the bear market was identified. Actually, the earnings trend indicator crossed below 1 in February of 2008. So we did it months ahead of time. But you can see it started coming down. And we have not only the ability to sense when the bull and bear market scenario is topping out, but we time the market. We don't predict it, we time it, we track it, and we follow it. We're market followers. We don't predict it. So let's go on, Kathy. Bull markets are born when the economy is weak, inflation and interest rates are low, and earnings are expected to rise. Just the opposite, okay? And let's look at the scenario back in early 2009. On Friday, March the 6th, in case you may have forgotten, Obama was inaugurated in 2009, and the economy was in big trouble, huge trouble, because of the housing bubble. And, all those bonds and everything that were sold. So the world was gripped in a financial crisis of monumental proportions, and I mean that. The S&P was down 57% from its all-time high of 1265. On that morning, it was a Friday, 651,000 non-farm jobs were lost in February, and the unemployment rate hit 8.1%. Now, a lot of people think that was pretty bad. But in 1980, it hit 10%. Some of us remember that. I was running B.F. Goodrich Chemical at that point in time, and we were the world's largest producer of polyvinyl chloride. And I think Carter was president then. And he implemented a credit freeze. And we sold a lot of PVC on credit. People made siding and pipe and everything else with it. And before you know it, the rail cars were coming back to us full. It never happened before. In 50 years, the company was making that stuff. Of course, I was a lucky one. It happened while I was president of that company. But anyway, that credit freeze really hurt. And so I was relating what was happening in 2008 and 2009 to what I experienced in 1979 and 1980. You know, I'd been there and I'd done that once already. So it wasn't anything new, but it was pretty bad. So the situation, and then after Obama became president, the market just kept getting clobbered over and over and over again. It kept going down and down and down. We saw it in a previous slide. Investors were looking for any hint of good news. On Friday, March the 6th, I wrote an essay called Itching to Rally and said we would go along with one of the following strategies if an explosive rally occurs. And I listed these 6, there's 5 there, these 5 bottom fishing strategies. And you know, this wasn't all black magic because we tracked the market, and those of you that have been with us a long time know that we have an indicator called the buy-sell ratio. And that buy-sell ratio, when it goes down below 0.20, in other words, it's 1 buy and 20 sells. Is that right? No, that's 0.5. 0.2, it goes, it's bottoming out. And so we were tracking that. But the trigger to me is on the next slide. VectorVest advised aggressive investors to be alert for an explosive rally. We said for those who are riding the wave, we are playing the downside of the market. We will exit these positions and go along with the following strategies if an explosive rally occurs. The thing that was interesting to me is we had that terrible jobs report. The market opened up to the downside, but then went up. It went up. People were saying, well, 651,000 jobs lost? Could have been worse. So they started buying stocks. This was on a Friday, okay? So let's go on. Monday opened up, and it was a wishy-washy day. So we didn't do anything. And then Citibank came out and said they made money in the first quarter, and the market exploded. Absolutely exploded. I went along with jailbreak no contra ETFs at 10 a.m. because we were advising our subscribers to wait until 10 a.m. The top 10 stocks were up 31.92% in 3 days. They were up 117.59% in a month, 660.73 in a year, and 1,715 and 8.81% in 12 months. No, to 12/21. That was absolutely the buying opportunity of a lifetime. The prices were so low, it was unbelievable. A lot of people made a lot of money in a big hurry. I haven't seen anything like that happen until recently with some of these marijuana stocks. I mean, they were going crazy until somebody in Washington put the kibosh on the whole thing. We'll talk about that later. Okay, so we nailed the top and we nailed the bottom. Let's go on, Kathy. And here's what it looked like March the 10th all the way to September 22nd, 2017. And it's still going. And even today, I wrote the essay today about the naysayers still saying this market isn't going to keep going. So the question is, will it keep going or not? And how are we going to know? Okay, let's move on. The current situation. The U.S. market is in case 4 bull market scenario. That's earnings, inflation, and interest rates are rising. And what did I say about from the truth chart? If earnings are rising, we're in a bull market scenario. Okay? And we have to start seeing evidence that earnings are starting to go down before we will change that. So, Kathy, could we go into the database and see if we can find the market climate graph? Let's see, we got, this is the earnings trend indicator. Put the earnings per share on there. Cancel them both and put the earnings per share above. I like to see that above. That's the white line is the earnings per share. And ladies and gentlemen, this is a 50-day moving average of the earnings, the average of all the stocks in the S&P 500. Okay, and this is the no, that's on the bottom again. Why does that thing keep going on the top? There you go. You got it. All right. This is the earnings per share. It's a lot like the S&P slide that we saw earlier. In fact, it's the same. Down below, we have what we call the earnings trend indicator. And you could see it did go down in 2016, and it dipped again here. And the reason for that was because the oil companies in the S&P 500 were getting killed. And we recognized that. And even though the ETI was below 1, we said, okay, the truth chart is saying we're in a bear market scenario. But we were cautioning our readers and saying, hey, look, if we take all the oil companies out of the S&P 500, and there were about 50 of them, the rest of the companies were going gangbusters. So we cautioned our subscribers not to be sidetracked by this, okay? And so the oil companies started recovering. In fact, in the database you can find 3 watch lists. One says S&P 500, that's the standard. One says no petro, that's the other companies without the petroleum companies, and one says all petro. You can look at those 3 slides. We are the only ones in the country that are doing anything like that. And I was at a money show and I showed it to people. And they weren't impressed. And I thought, you know, this is why. You got people telling you there's a bull market, there's a bear market, the market's overvalued, all this gobbledygook. They just don't understand and they don't want to believe. Nevertheless, we charge on. There they are. Kathy, see here, put the slide of the S&P 500 up. Do that average graph. The one on the bottom. Now these are forecasted EPSs. What we do, ladies and gentlemen, we buy earnings forecasts from Reuters. We take that forecast and we tie it to the trailing 12 months. And the forecast is out 2 years. And the trailing is back here. And we interpolate between the two. And we march forward towards that earnings forecast a week at a time. And this is what we see. Kathy, go back 5 years. Let's take a look at it. This here is a result of the downturn in the oil companies, and you see it's getting lesser and lesser. So let's look at the earnings curve without the oil companies. No petrol. Watch this. You're going to see something. Do 5 years. There we go. Now that's an impressive record. Let's look at the all petro. And I'm happy to say that the petroleum industry is recovering. And if you're a bottom fishing type person, do 5 years. You have 5 years? Here we go. It peaked here in about June, July of 2014. And it started coming down. And the earnings peaked later. This is a 50-day movie. No, this is the earnings itself, okay? And they went negative, they went positive, negative, and now they're rising nicely. And oil's back above $50 a share. Cold winter is helping out. A lot of things are helping out. But prices are back above $60 a share, and the frackers are coming back. And the frackers are the one that broke the back of OPEC. And it's not the little guys this time. The big guys, the Exxons, the Shells, are coming back. And the Chevrons are coming back. And they're going into fracking big time. So we're liable to see this whole thing all over again. And the Saudis know that they got trouble down the road. Now there's a country, anybody ever hear of Parkinson's law? Parkinson was an English economist. And years ago he studied what was going on with the British Navy. And he saw that many years ago they had most of the Navy personnel was on ships at sea, very little was in headquarters. Then as the years went by, fewer and fewer of the personnel were on ships and more was in headquarters. Okay? So he formulated a number of laws. One is that expenditures will always rise to meet income. And I know that's a fact because it happened in my family, it happens in your family, everybody does it. The more money you make, the more you're going to spend. Or if you have a job to do, the time it takes to get it done will always rise to meet the deadline. So if you want something done in a hurry, give them a short deadline. If you're not in a hurry, make it long, and nobody will start working on it until 2 weeks before it's ready. It's almost like the law of gravity. It never fails. When I was running a chemical company, people would come into me and say, you know, Dr. DiLiddo, we need more help and blah, 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 you know, and we need 4 or 5 people. So you had 4 or 5 people. You had these 5 people, and the rest of the people do less work. I've seen that happen over and over again. So you got to be careful. And what's going to happen, and well, I was talking about the Saudi. I was in Saudi Arabia, oh my God, 83, 84, something like that. And they were already talking about money problems, and they had money coming out of their ears. We were selling them some technology, and they didn't want to pay what we were asking. But anyway, but they became so used to spending money, lots of money, that when these oil prices dropped, they really got hurt, and they're hurt now, you know, and they were talking about going public with Aramco. And I don't know whether they're going to do it because they got real money problems. A lot of the native Saudis don't work. They just get money off the government. So anyway, that's another story. But this is the inside story. We're the only ones in the country that saw this, at least that I'm aware of. But these are facts, all right? Let's move on, Kathy. So we're near the end here. The U.S. market is in a case for a bear market scenario. Inflation, earnings are rising, and the bull market will continue as long as it is perceived that earnings are rising. Okay? Let's take another look at that market climate graph. The earnings and VBC. And go back 10 years this time, or 15 years, or the whole schmelly. Take it back as far as it'll go. We actually started doing this in 2003, okay? And when we started doing it, earnings were way up here. And can you zoom in this area here, Kathy? We could see that the earnings were way above 1, and they came down and they came down, and we watched it and we watched it and we talked about it and talked about it. And so we signaled that the onset of a serious bear market. You know, the companies like that sold mortgages were in trouble, and there was a lot of noise to go along with it. But it's nice to have some data that corroborates it. And earnings crashed. Now, I didn't expect earnings to crash this badly, but it was bad. And not too many of us heard about, you know, these bundles of mortgages they packaged, and they mixed them very risky mortgages with the safe mortgages, and they classified the whole bundle as safe. There's a lot of bad stuff going on, but that's what happens. And so you are in a position. What I'm trying to accomplish with this presentation is to let you know that if you deal with facts, you're a lot better off than if you deal with speculation and guesswork. And we don't guess. We deal with facts. And we've been doing it now for a long time. And I believe very strongly in this model. Thank you very much, ladies and gentlemen.
Welcome back from lunch, everybody. Hopefully you had an opportunity to go grab something to eat, something to drink, and mulling over some of the notes that you've taken. Hopefully you've taken some notes. We'd love that you're here, and hopefully, you know something, if you're getting something out of this, be honest. Type a 1 in the room. Whether you've been with us for a while or you're brand new experience to the VectorVest system, type a 1 in the room if you're getting something out of it, because it's all about you. Our channel is all about you and our ability to bring you the useful information. Just like Dr. DiLiddo's book, Stock Strategies, we want to give you the common sense to help you to make some money. So far we've had some great talks from great people. And hopefully at least turning on some light bulbs, opening some doors to helping you make money in the market. Guess what, folks? You know me, I love to give stuff away. So we're going to start off with, I'm going to give away 2 mugs today. All right? The key word that you're going to put in, it's either going to be, you can type in masterclass or type in MC. All right, no, don't type in masterclass. Don't do that. Type in MC for masterclass. Type in MC. We're going to pick some winners today by the end of today's session. I'm going to give away 2 mugs. And then also, for all you Radar O'Reilly fans, I'm going to give away a couple of VectorVest bears. Look at this. Good throw, Jim. So, no, I don't want both of them. We're going to give away 2 bears. These are nice, fluffy bears. Look at that. With VectorVest on them. So this might make a gift for somebody, but they're really soft. Again, the key word is going to be MC. Giving away 2 VectorVest bears, giving away 2 VectorVest mugs, and by the end of the day, we're going to announce who the winners are. So in a second, right now, we're getting ready to turn over to a good friend of mine here in our education department, Jerry D'Ambrosio, as he takes on the next talk. Jerry, take it away, man.
Thank you, Glenn. Really appreciate that. Haven't seen you in a while. Always good to see you. Welcome, everybody. Thank you guys for joining us today. Really glad we were able to put this masterclass together and deliver it for you folks. Again, my name is Jerry D'Ambrosio. For those of you that don't know me, I'm the manager of educational content with VectorVest. Just a little background on myself. I won't bore you guys too much. I've been with VectorVest now 16 years. And when I first started, I knew absolutely nothing about the stock market. I came from an education background where I used to teach back in New York, and I think that's it says a lot, because when I first started, everything that I've learned about the stock market is kind of through the VectorVest lens. And I know a lot of folks out there are struggling right now, making money in the market. If you're not a VectorVest subscriber, you might be a little frustrated. You guys are in the right place. I think we're giving you a lot of tools here that will help you turn your lives around, turn your portfolios around. Conventional wisdom of buying stocks that are falling in price. If you've been doing that over the last 11, 12 months or so, you know that you're in a world of hurt right now. Your portfolio has kind of imploded and you're wondering, what do I do now, right? So you guys are in the right place. What we're going to talk about here are powerful tools to help build rules-based trading systems. So rules-based trading systems rules-based trading has gained considerable popularity in the investing community really over the last decade, I would say. And I can't remember exactly when it was, but many, many years ago, a big suggestion, I would say, from our clients was to provide automated trading systems. They would say to us, hey, you guys are the experts. I want you guys to tell us when to buy, what to buy, when to sell. All right? You tell us how to navigate the markets. And that's why we made a big push many years ago for these automated trading systems. Todd Schaefer, who's the manager of research, really has done a lot of work over the years putting a lot of these trading systems together. Steve Chappell, of course, director of trading systems development, put together these automated trading systems. So why should I consider it at all? So why should you consider a rules-based automated trading system? So let me just say this. There are two types of portfolios that you might be managing, right? Some of you might be managing a what we call a manual portfolio, where a lot of the stock selection and money management is done manually, based on charts, based on certain other indicators that you might be using, but it is a manual process. There are then automated trading systems, which takes all the guesswork out of managing a portfolio. So again, we tell you exactly when to buy, which market timing system to use, what stock selection search or scan to use, and then how to manage those positions. And one of the big things too about automatic trading systems is that they lay out rules for signal changes, right? So you're using a market timing signal and signals change from up to down, and these automated trading systems kind of guide you in terms of how to manage and adjust portfolios when those signals change, when markets change. So why should you consider a rules-based automated trading system at all? It frees up time. You click a few buttons. The hardest part, I think, about an automated trading system is setting it up. You have to set up the system within the VectorVest program. We provide you guys with all the tools necessary to trade these automated systems, and it only takes a few clicks a night. It does free up a lot of time, as opposed to having to look at charts and understanding when to exit positions. Again, that's done manually. A lot of you guys are doing that, and that's fine, but this again speeds up the process and allows you to kind of do other things. It reduces stress and emotion, right? So you're looking at your portfolio every night, and you're got these list of stocks in there. Should I sell this one? Let's look at the chart. I don't know if I should sell this one, right? That question is, okay, well, I might be down a little bit, but I think it's going to go back up, right? You might be down a certain percent, or maybe your stop criteria was hit. You have to then take the position out of your portfolio. You have to sell it. That's done manually. Automated systems get rid of all that. So it's completely emotionless. You allow the system to tell you exactly what to do. Sometimes we do get in our own way. But that's not the case with automated rules-based trading systems, because all the variables and all the questions that you might ask yourself along the way, we have answers for. And generally speaking, number 3, it does produce better results. When we step away from managing our portfolios manually and we allow a systematic rules-based trading system to do the work for us, it does produce better results over time. So a few of the powerful tools that we'll talk about today is one of them is the Trading System Viewer. The Trading System Viewer is a great place to look for fully created, rules-based trading systems that are already put together for you. Or, I'll show you guys here in a moment how, if you want to, you can create your own. Okay? Here are the tools to get started. We're going to talk about these tools in a moment, but let me open up the VectorVest program first. Let me just close a couple of these charts. And I'm going to hop right in, guys. You know what? First thing I always like to do when I start a presentation, just let's take a quick look at the market. We are using our VectorVest Premium program, which is real-time data. You can see all the major indices are down today. Dow, NASDAQ, S&P in the red, but the VBC is up about 20 cents a share. We talked about the VBC earlier. So again, just taking a quick peek at the market, you got 3 yellow lights across the board in the color guard. Our guidance is still the same though. We don't advocate buying any stocks at this time. We'll wait for some sort of a trend change, and Steve talked about how the primary wave will be your first signal, your earliest trend change to start thinking about buying stocks again. Okay, so we're not there yet. Market's still in a downtrend, and that's why our guidance reads as it does at the top. So I'm going to go up to the top, click on Viewers, and I'm going to go right into the Trading System Viewer. Now, I'm not sure exactly how many trading systems are in here. There are dozens of them in here. But these are fully created, rules-based, automated trading systems. So just to go through some of the metrics and the columns here that you'll see, you have the name of the trading system. You have the category, whether the trading system is aggressive, prudent, conservative, or speculative. This is very important. Because if you are not an aggressive trader, you're going to probably favor some of the more prudent to conservative trading systems, right? So it gives you a nice head start and say, you know, I'm not prudent, or I'm not aggressive, or I'm not conservative. So I'm going to kind of shy away from those other trading systems where, you know, with an aggressive trading system, your returns might be greater, but the risk that comes along with those returns is greater as well. So you always have to weigh, you know, your risk-reward profile for yourself to then determine which trading systems to use. And let me say this about trading systems and the categories that you see here. You can manage multiple portfolios. So we have what we call the investment matrix. If you're a VectorVest subscriber, you know and you've seen the investment matrix before. The investment matrix breaks down the different investment styles that we have here in this category column: aggressive, prudent, conservative, and speculative. And it breaks down the levels or the values of our RV and RS indicators. If you're managing a conservative portfolio, so what does a conservative portfolio look like? It looks like or contains stocks that are safe, that are companies that consistently and predictably grow their earnings every quarter, every year. You're not too concerned with the upside potential, but really capital preservation is key for that portfolio, right? It might be a retirement account. Maybe you've kind of self-directed some 401k money, or you're just trying to manage a retirement portfolio conservatively because you know that capital preservation is key, right? So you're managing that type of portfolio a lot differently than you might manage a more aggressive portfolio, where maybe the stocks in that portfolio are a little bit riskier. The relative safety indicators below 1. You have the nice upside potential with relative value, but you're willing to take on a little bit more risk. Sometimes, and generally speaking, returns are greater with more aggressive portfolios, but there's a lot of risk that comes along with it. You, as the individual investor, can manage those different types of portfolios. You allocate a certain portion of your capital to a conservative portfolio. You allocate a certain portion of your capital to an aggressive portfolio. So when I say, find out for yourselves whether you're conservative or aggressive, just understand the objectives for each portfolio. So if you had a certain amount of money allocated towards an aggressive portfolio, then you can kind of favor some of these top aggressive trading systems, okay? So very important, again, for us to label them accordingly so you know the risk involved before you take on one of these trading systems. So the first one here, it's called Pirate Short. It uses a 50% gain, 15% loss as the stop criteria. Now this is a short-only trading system. We have short-only trading systems in here. We have trading systems that do both, go long when the market's rising, go short when the market's falling. And we have long-only portfolios, trading systems in here as well that just go long in up markets, okay? So just again to go through the metrics here, this system at the top, Pirate Short, uses the DEW market timing system. So this is your when to buy. This column here, this market timing system column here is when to buy. When are you going to begin buying stocks, and when are you going to stop buying stocks? Okay, that's the market timing signal. So this one uses the DEW. Then if I move over to the right, we have some performance metrics here. You can view the 1 month percent gain loss, the 3 month percent gain loss, the 1 year percent gain loss. So it's no surprise, it shouldn't be a surprise to anybody to see that a short only portfolio over the last 1 year has performed very well. 70%, about 70.5% over the last 1 year. That's year over year. Okay? You have the year over year equity curve, and then you also have the year to date gain loss as well. You have the annualized rate of return, the 1 year drawdown, and any add-ons that were used in this trading system. This one in particular, the one at the top, did not use any add-ons, does not use any add-ons, so there's nothing in this column. Okay, so if you want to, for example, wanted to say, all right, I want to find the trading systems, and I'll dig into these a little bit more, but in terms of kind of a practical application of this trading system viewer, if you want to say, okay, I want to see all of the trading systems at the top of the list that have performed the best over the last 1 month, you just simply click on 1 month percent. It reshuffles the order and puts the best performing trading systems at the very top, best performing trading systems over the last 1 month at the very top of the list. Okay? Buying contra ETFs. I love this system. I kind of dug in here this week and I really looked at this trading system because I trade contra ETFs a lot. In our swing trading coaching group portfolio. And a lot of what we do in that swing trading coaching group is manual. We take a look at the contra ETFs, we determine which type of ETF we want to trade, whether it's a broad market ETF, a gold ETF, an oil ETF. And then we manually manage the positions based on just some basic risk management guidelines. Who was it? Jim earlier talked about the 1% rule, not wanting to risk any more than 1 to 2% of your overall portfolio capital. So we size positions according to that. But I love this trading system because it is a trading system solely for contra ETFs. You guys out there, are you looking for an automated trading system that trades contra ETFs? You probably are. If this market, gets any worse and continues to move lower, this is a great alternative, right, to shorting stocks or just being in cash at all. Contra ETFs are a great alternative to shorting stocks and a good way to make money when the market's falling. This is an aggressive trading system. It uses our fastest market timing signal. It uses the primary wave. It's up about 14% in the last month, 16% over the last 3 months, about 14% over the last 1 year. And that includes, of course, September of 2021, when the market was rising. I think the high was in November, right? So scrolling over to the right, 36% year to date, very low drawdown, little less than 11%. Annualized rate of return, about 11% a year. Drawdown a little bit under 19%. This trading system uses the Profit Locker Pro, which I will talk to you guys about in a moment. Okay? Gravity. Look at the trading systems at the top of the list. If you had no idea what the market was doing over the last month, which I'm sure most of you, of course, do, and you came in here and just sorted this trading system viewer by 1 month percent gain, and you see all of these bearish searches at the top, now you know. Now you know what the market's been doing over the last 1 month, right? It's been falling, and here are the best trading systems over the last 1 month. You've heard the disclaimer, right? Past performance is not indicative of future results, and that has to be understood going in. This is how these trading systems have performed over the last month. The whole point here is, okay, if the market continues in this manner, these trading systems should, because they've performed well in the same environment that we expect moving forward, that they should continue to perform well. Okay? If we want to go to 3 months, you can say, all right, here are the best performing portfolios over the last 3 months. Bottoms up, that's actually a bottom fishing search that uses a 50% gain, 10% stop as 50% gain, 10% loss as its stop. It's aggressive. It uses the green light buyer. Why has there been no performance over the last 1 month? Why does that say 0? It's up 27% over the last 3 months. Not performing all that well over the last year. This portfolio is in cash, and it has been in cash over the last 1 month. Okay? If you click on the portfolio name, what you can do from here is take a deeper dive into some more performance metrics. You can see the positions that are currently in the portfolio, and you can view the trading system rules as well. So I'm going to click on bottoms up, 50-10. I'm going to go to trading system details. And at the top it says, finds Russell 2000 stocks in the 30 worst performing industries. It's called bottoms up, right? So we're kind of taking that bottom fishing approach where we look at stocks that have been performing poorly with the overall market. And this is specifically looking at the 30 worst performing industries. The sort brings to the top the list of the top of the list good stocks that have been beaten down. That's the whole idea of bottom fishing. Trying to find those good stocks that have been beaten down with the overall market, and the sort brings the worst or the stocks that have been beaten down the most to the top of the list. Okay? Here is the 1 year equity curve. You can see it's been flat here over the last 1 month. That's why the portfolio has no performance. It's 0 because we've been in cash. Why are we in cash? Well, if I go to trading system rules at the top, the system uses the green light buyer, and we have it set here to go to cash when a confirmed down signal is given. Okay? We buy stocks when there is a green light in the price column of the color guard. We go to cash when a confirmed down signal occurs, and then we stay in cash until the next green light appears in the color guard price column. Very rules-based, very systematic. You know exactly what to do at each of the situations that are provided for you in a particular market timing system. With the green light buyer, there are 3 situations. There's an up situation, you know what to do, and the system lays out the rules for you during that situation. When the signal turns down, you know exactly what to do, and if it's ever neutral, you take no action in this case. No action means no action, don't do anything. Okay, you're not buying stocks again until a green light appears in the price column of the color guard. So one of the systems that I want to talk about today is Chappell's Champs goes ballistic. Now this technique, this strategy goes both long and short, depending on what the market's doing. It uses Chappell's Champs. Steve Chappell developed this strategy a long time ago, actually put this trading system together coupled with ballistic new high short. It's a great trading system. We consider it prudent because of the type of stock that Chappell's Champs finds. I'm going to go into Unisearch real quick, and I'm going to go into our Searches Prudent folder, and I'm going to go to Chappell's Champs, and the universe of stocks that Chappell's Champs looks in is only our top VST stocks. So it's not looking at the entire database of 9,000 stocks. This search only looks at top VST stocks. So if I run that search as of right now, why is this considered a prudent trading system? Because, do I even have RV? Let me just reset something here, guys. Because the RV indicators and the RS indicators, for the most part here, are favorable. A lot of these RVs, all of the RVs are above 1. Most of the RSs are above 1 as well. That is a prudent stock, okay? So I know this trading system goes short, but it is considered prudent because of the type of stock, the types of stocks that it buys, right? Fundamentally favorable, fundamentally sound companies. Uses the GLBRT kicker. 3% over the last month, 27% over the last 3 months, 60% year over year. Not a bad looking equity curve, a little bit of a drawdown here, 43.5% year to date, 184% annualized. Drawdown a little high at 26%, and this trading system also uses the Profit Locker Pro. So if you're looking at the metrics, at the performance metrics here, and you're prudent or you want to manage a prudent portfolio, right at the top of the list with just one click, I can also sort by 1 year, and it's close to the top of the list as well. So across the board, you're looking at favorable performance, right? So if I was looking at something like, let me scroll up a little bit here. Pirate short, down over the last 1 month, down over the last 3 months, up a little bit over the last year. I'd kind of pass on that, right? You want something that has been consistently working short-term and long-term, and that's why we have those three performance metrics right at the top there. So Chappell's Champs goes ballistic. Let's take a deeper dive. I'm going to go to Trading System Details. First off, when you go to Trading System Details, it gives you, there's the equity curve. Now this is from inception, which is back in January of 2019. Great looking equity curve, right? Great looking equity curve. Here is the max drawdown, which was just this year, all right? Held up pretty well during the COVID crash, actually performed well during the COVID crash in 2020. Why? Because it goes short, right? So if I scroll down, there's the same trading system statistics that we saw on the spreadsheet in the trading system viewer. Also here is the 3-year performance, 557% over the last 3 years. There's your all-time performance, 688%. Total trades, winning trade percentage, 55%. Not bad. That's all-time as well. So all-time, 317 total trades, 55% winners. Okay? Here are the positions that are currently in the portfolio. It tries to maintain, I believe, 10 stocks, but there are currently 8 in the portfolio now. Okay, and I'll explain why there's only 8 and not 10. But here are the 10 stocks. Here are the ROIs. You can sort by ROI, bringing the biggest winners to the top. And you just have some, some kind of brokerage indicators and columns here. How many shares of each, the current price, gain in dollar amount, cost per share, and so on. You can just scroll over to see all the other values there. Okay? So you say, okay, I like this portfolio. I like this trading system. Let me go back to trading system details, trading system rules. So what does this require me to do? Well, it uses the GLBRT kicker. We talked about that just a few minutes ago, right? It has 3 rules to it. An up situation, a down situation, a neutral situation. Notice now for the down situation, this trading system short stocks. It doesn't go into cash. It doesn't stay neutral during down situations. It actually shorts. It uses ballistic new highs short during down situations. It uses Chappell's champs during up situations. And it uses a proprietary exit tool, proprietary stop tool called the Profit Locker Pro. Okay, you're not going to see the Profit Locker Pro anywhere else but VectorVest, and it's a fantastic exit criteria tool that takes into consideration the fundamentals of each stock, and it adjusts the stop criteria to that particular stock. Okay, so I'm going to close this now, and we're going to set this up. So the beginning, the first step is identify a trading system that you want to move forward with. You can do it by yourself. And Steve, in the next presentation, is going to show you guys how to build an automated rules-based trading system on your own. You guys are creative. Maybe you want to, tweak some things or create a search of your own, a scan of your own, and use kind of different stop criteria. You can do all that. We have the tools that allow you guys to do that. But if you're in the camp where, listen, I want you guys to tell me what to do. Right? You guys are the pros. You developed all these. I have no problem using any of these. I don't have to spend the time of building one myself. I'm going to go ahead and use what's working now, right? So you can do a few things from the trading system viewer. You can paper trade this trading system in the Genius, where if I click on paper trade in portfolios, it gives you 2 options. You can follow in the portfolio manager. So what that does is it takes all of the rules. Remember, we just went through the trading system rules, and it laid out the rules for the up situation. It laid out the rules for the down situation and the neutral situation. It converts all of those rules over to the Genius if I clicked on follow in portfolio manager now. So let's do that. Let's kind of show you what it looks like now in the Genius, where it's being managed in real time. So here are the 8 stocks that we just saw in the trading system viewer, right? Why are there 8 stocks and not 10? Well, if I go to details, it's trying to maintain 10 positions. And this is a rhetorical question. I want you guys, if you know the answer, just kind of yell it out. It's trying to maintain 10 positions on both sides, both long and short. Why does it only have 8 positions in the portfolio? Well, the answer is because we are currently now in a neutral situation. And remember what we are required to do in a neutral situation. We are required to do nothing. So we are maintaining the 8 stocks that are in the portfolio now. We are not replacing either of the 2 stocks that we just sold out of, because now we are in a neutral situation. Okay? So let me click on this. Let's see. Yeah, so if I go to details, there are all the details. So it's trying to maintain 10 positions. I want to automatically replace closed positions as long as we have a green light GLB RT kicker signal. So let's say you get a GLB RT kicker signal. You take on 10 positions, and along the way, you exit out of a position or 2 based on the stop criteria used here. When do we replace it? It says automatically replace. Well, the system is smart enough, it's called a genius for a reason. The system is smart enough, the genius is smart enough to know what the signal is, right? Are we in an up situation, a down situation, or a neutral situation? As long as we're still in an up situation, the portfolio will replace, the system will replace the stocks that you sold out of, okay? When entering this situation, close any open position that was opened in a different situation. So what is the different situation that we would encounter where we would open a new position? It would be a down situation, right? So basically what this is saying, close any short position that you took during a down situation anytime a GLB RT kicker up signal is given. Close any open position that was opened in a different situation. And just some basic kind of rules here. Invest the average portfolio value. We're going to buy odd lots. We're not going to repurchase the same stock for 31 days after sale. That accounts for the wash rule. Don't buy if a stock violates the stop criteria at purchase. This rarely comes into play. Maximum percent of a stock's average volume 10%, and we want to evaluate the stop criteria from the purchase date. Same thing on the downside. We're going to try to maintain 10 positions during confirmed down signals. And by the way, with the GLB RT kicker market timing signal, I believe Steve went into this earlier, the down signal is the confirmed down. So when entering this situation, close any open position. What does that mean? It means what it says. Close any open position anytime you get a confirmed down situation. Okay? What are we going to do at a confirmed down? Well, we're going to fill the portfolio with short positions from ballistic new highs. That ballistic new high short, that's a shorting search. Okay? And the same rules apply down the board here. Invest the average portfolio value, odd lots, same thing, don't repurchase the same stock for 31 days after sale, and so on. Neutral situations, we take no action. Okay? So where is my... So I'm going to go up to the top here, and we're going to create a new one. I'm going to go to My Portfolios, and I'm going to show you guys kind of how to create a new portfolio within the Genius, taking taking systems from the trading system viewer. So if I scroll over to the right here, you can just click on the trading system viewer here. It'll open it up. Chappell's Champs goes ballistic, and you can view all the trading systems here. Okay, where is my new button? There we go. My portfolio. So if I go to create a portfolio, I'm going to give this a name. I'm going to call it Chappell's Champs / ballistic short. Hope I spelled that right. I'll take a look at it. I did. Okay. The initial investment, you put in whatever you want to put in. You want to put in $50,000 to start, you can do that. Again, this is just a portfolio here, a paper trading portfolio that you are going to continue to track here moving forward. Commission type, just for the purposes here, I'm just going to select none. Click OK. Now what we have to do is we have to kind of create the trading system itself. So if I go to Edit, I'm going to select an existing trading system because I know the trading system that I want to use is in the trading system viewer. So when I click on Chappell's Champs goes ballistic, click select at the bottom right. Okay, it automatically, see what that did? It automatically loaded all the rules of the trading system. Market timing system used, and by the way guys, this feature here, this market timing box, let me click on customized trading system, you can see it here as well. In the market timing section, this section here is included if you have the auto timer module. Ray earlier talked about how if you guys are non-subscribers, you take out a trial, you get all the tools that we use here today, and which includes the auto timer as well, which adds or includes market timing signals to a portfolio or a back test. Why is that important? Because if you're trying to run a back test using, say, for example, the GLBRT kicker signal, if you didn't have the auto timer, that would have to be done manually, where you'd have to stop the portfolio at every green light or every down signal or every neutral signal. Take a look at the positions in the portfolio, reevaluate the positions, and then trade it and manage it accordingly. It's doable. It takes up just so much time. The auto timer tool includes those automated market timing signals into a portfolio or a back test. Okay? So automation rules for the confirmed up, we talked about that. Automation rules for the confirmed down, we talked about that as well. Okay? It's going to ask you, what do you want the genius to do when a position meets its stop criteria? You can choose to have it close the position or just send you an alert only. If you select close the position, it will do both. It will close the position and it will send you alert. By the way, guys, this is the genius, right? This is a native VectorVest tool. We are not yet linked up to a broker. I believe Steve, when he talks about the RoboTrader later, you have the ability to link up a few different brokerage accounts, a couple of partner brokerages that we are currently working with, to the VectorVest system, to RoboTrader, and it will allow you to trade directly through the VectorVest program. This is just paper trading. Okay, so when I say close the position, it's not really closing the position anywhere but the genius within the VectorVest program. Okay. How often do you want the genius to check your positions, either throughout market hours or just once per day after the market closes? I'm going to keep throughout market hours selected. Do you want the genius on or off? I'm going to say on. When it's on, it now becomes fully automated. So if I click on save here, what you're first going to see is the situation at the top. That's either going to be a green arrow that points up, a red arrow that points down, or a neutral symbol there. It's neutral. So what do we know about what to do in a neutral situation? We know not to do anything. Therefore, this portfolio will not populate today. When will it populate? It will populate, if I go to a market timing graph here, and put our GLB RT kicker signal on the chart, and I'm going to change our graph layout just quick to keep everything uniform to the GLB RT kicker layout. These green arrows are GLB RT kicker up signals. Yellow circles are neutral signals. Red arrows that point down are our confirmed down. So we're in a confirmed down now. We have not gotten a green arrow on this chart in a while. The next green arrow that appears on this chart, it will then fill the portfolio with 10 long positions from Chappell's Champs, and it will manage it based on the Profit Locker Pro ATR stop criteria. It will then continue to monitor the portfolio for you and alert you if any stocks in the portfolio meet that exit criteria. It will then take a look at the situation on that day, whether it's an up situation, a down situation, or a neutral situation, and then adjust the portfolio according to that situation. So let's say you buy 10 stocks at a GLB RT kicker up signal, you sell a stock because it meets your stop criteria, whether it's a gain or a loss. You now have 9 positions in the portfolio. You want to maintain 10. You want to fill that open position. But it's a neutral signal that day, so it's not going to do that. It's not going to fill the open position only if you have an up situation, an up signal with that particular market timing system. I'm going to go back let me create a new one, because let's see, we are currently in a confirmed down, primary wave is down. I'm going to go because I want to show you guys what it looks like when a portfolio actually fills and populates with stocks. I'm going to go back into I'm going to go back into portfolios. We're going to create a new one. I'm just going to call this my portfolio. Okay. Again, initial investment. You could put whatever you want. You could put whatever you want in there. Not 500,000. You could if you wanted to. Commission type none. That's kind of just creating the shell of it. Click OK. Portfolio already has a name. I'm going to call this, what's today's date? Today is the 9/30/22. Give it today's date. Click OK. Okay, now we got to create it, right? So we click on Edit at the upper right. Let's select an existing trading system, and I'm going to select one. we'll select the one at the top. Pirate short, 50% gain, 15% loss. We know it's aggressive. How has it been performing over the last 1 month, 3 months, 1 year? Very good. It uses the DEW DEW market timing signal. Okay, so if I select that, very easy, guys. I mean, again, we're saving a lot of time here just setting it up. I know I'm going through it a little bit methodically here, but I want to make sure you guys are kind of familiar with the process. Market timing signal is the DEW. When a DEW up situation is given, we're taking no action. We are currently in a DEW down situation. So what is it telling us to do? It's telling us to short stocks from pirate short, which is a shorting strategy in the VectorVest program, and it's going to use a 50% gain, 15% loss as its exit criteria. If I click on save, red arrow that points down tells us that we're in a short situation. And it's only short, let's see how many stocks it's going to short. NRBO is so far, there you go, there's your 10 stocks. There's your 10 stocks to go out and short because we are in a DEW down situation. Now this, what you can do, guys, is you can just track it. You can continue to monitor it moving forward, making sure that it's continuing to perform well if market conditions stay the same. If the market continues to fall and this continues to perform well, paper trading is a very important piece of then capital deployment, right? You want to paper trade first. The back testing part of it or the research part of it is the first step. So if I go back to our slides here real quick, the tools to get you started in building your own portfolio, and just to let you guys know what we did to create those automated systems. We start with what we call quick tests. We then can use the back tester and the quick folio. I would actually kind of flip, kind of interchange those. Once you create a quick test, once you perform a quick test, that's just simply a point-to-point test on a basket of stocks. The next step is to then put it into the back tester. So really quick, let me show you guys what I'm talking about there. All of these trading systems in the trading system viewer went through the same process that was just laid out on that slide and went through the same process that I'm about to show you. So for example, and this is not, guys, I'm not telling you exactly what to use. I'm showing you the process on how to create and build a trading system of your own. So let's say you wanted to use the confirm calls. What I would start with, I'd kind of go back a couple of years and take a look at all the confirmed up and down signals that we've gotten over the last couple of years. And I want to start with kind of the beginning of a run, right? If I'm going to back test, if I'm going to create a trading system, a rules-based trading system, I want to begin in a favorable market environment. So I would start here. May 18th of 2020, that was a confirmed up. And that lasted for a little while, and we got a confirmed down on September 11th of 2020. So here's my initial test bed, my quick test bed. I would say, okay, I'm going to use the confirm call. I'm going to try to manage a conservative portfolio. It's more of a retirement portfolio. I don't want to do a lot of trading, and I want to use a market signal that will kind of keep me in the longer trends, longer uptrends, and keep me out of the longer downtrends, right? The longer sustained down moves. So I'd say, okay, May 18th was a time to buy, and September 11th of 2020 was a time to sell. So there's my initial test bed. I go to Unisearch. The first thing you would do is to take the date at the top back to that confirmed up call on May 18th of 2020, and then you're going to choose the scan that you want to start with, the search that you want to start with. If this is a conservative portfolio, no better place to start than search is conservative. If this is a retirement portfolio, which is again very similar to a conservative portfolio, we have a whole folder in here called Search is Retirement. These are strategies that find stocks that are suitable for retirement conservative type portfolios. I like, one of my favorite conservative searches is pale blue chips, right? So if I go ahead and run that scan on May 18th of 2020, Here are the stocks that I would have bought. I'm just going to return the top 10 actually. United, D.R. Horton, NetEase, Intel, Lowe's, Apple, Microsoft, right? These are all stocks that you're familiar with. Look at the RV scores, look at the RS scores. These are stocks that are suitable for a conservative portfolio. How did this basket of stocks, which theoretically you should have bought on May 18th of 2020, right? That's what you're testing here. The performance of, let's say, okay, if I would have done this on this day, because it was a confirmed up, with these stocks, because it's a conservative type scan, how well would they have performed to the next confirmed down? So you click on quick test, you change the end date to the confirmed down, which was which was September 11th, and you run the test again. Okay, not bad, 19%. 8 winners and 2 losers. This is no money management, by the way. This is just point to point. Let me test this basket of stocks, this strategy, from an up signal to a down signal. So far, not bad, right? 19%. The overall market went up 13%. VVC went up 13%. So that's a nice start, isn't it? So you go back and say, okay, that's a pretty good start. I'm going to go back to the market timing graph and let me just quick test again from the next confirmed up, because what are you going to do during the confirmed down signal if you're conservative? Well, you're going to do nothing. You might even go to cash, okay? But you're not going to start buying stocks again to the next confirmed up, which was October 8th of 2020. Now, that didn't last very long, but you have to test it. You can't say, nah, I don't want to test that because it was only short-lived and I probably didn't make any money. You have to test it. So I'm going to go back into Unisearch. I'm going to change the date at the top to the next confirmed up, which was again October 8th. You got to run the search again. You can't just take the same list of stocks. You got to run the search again. A lot of times with these conservative searches, you're going to get most of the time the same list of stocks, very similar. You can see a couple of changes in here. Let's quick test those 10 stocks again. Take the end date to the confirmed down, which was again only 2 weeks later. October, still in October. Man, only 2 weeks there. Run it. All right, you lost 1.5%. You lost 1.5%. Not all that bad. The overall market went down 1%. So okay, so that was a losing run. You go back into the graphs and say, okay, that was a losing run, but here, I would have bought stocks back again on November 10th of 2020, and at the very least held them to March 4th of 2021. You do the same thing. Run a quick test and test it over that time period. That gives you a nice baseline to say, you know, using this market timing system in favorable market environments, using that stock selection search, I could see pretty good results. What you then want to do is then you want to throw this methodology, you want to test this methodology in the back tester, okay? So I'm going to come up to the top, click on back tester. We're going to create a new one. I'm going to use that same, I'll just give this a name, we'll call it PBC, Pale Blue Chips. You can edit the account settings where you cannot pay commission. You can change the commission type if you want to. If you use margin, you can also account for interest. We're just going to uncheck those 3. We're going to buy and sell positions at the next day's open. Click OK. We're going to build a custom trading system now. So the trading systems in the trading system viewer, if I select an existing trading system, are here. This is where you'll find the pre-built rules-based trading systems in this under this button here, select an existing trading system. I want to build a custom. I'm going to use the confirm calls because my objective is to hold positions longer, not do a lot of trading. I want to manage that retirement or conservative portfolio, so it makes sense to use, you know, a slower, more reliable signal as opposed to a faster signal like the primary wave maybe. Automation rules for the up situation. I will then go to this is basically the Unisearch directory. I'll go to search as candlesticks. I'm sorry, search as conservative. Click on Pale Blue Chips. That is the stock selection. That's the what to buy. When to buy, confirm calls. Confirmed up call. What to buy, stocks from pale blue chips. What's the third component? The third component is when to sell. So you select stop criteria and you begin to test different stop criteria. I'm only going to go through one or two. Steve's going to do a more kind of detailed explanation of these stops and really how you should go about things. But I'm going to use recommendation equals sell. Okay? This is our sell rating, VectorVest sell rating. So I'm buying stocks from pale blue chips on a confirmed up. I am selling them if any of those stocks receive a sell rating from VectorVest. Okay? If I go to more settings, I want to maintain 10 positions. We're kind of familiar with this screen already, right? We looked at this in the trading system rules when we were in the trading system viewer. Maintain 10 positions. I want to automatically replace closed positions as long as I'm in a confirmed up. I don't need to limit the number of positions open in a day. You could change that if you wanted to. You can say open a maximum of 2 stocks a day, 3 stocks a day if you want to step in once a confirmed call is given. How do you know which one to land on? You're gonna land on the one that works the best. So you're going to go through a lot of tests, right? This is where the work is done, guys. I said earlier, if you're a creative, analytical type investor, you don't mind doing this stuff. You don't mind putting in the work. You want to change some variables. Fantastic, guys. All the tools are here for you. So decide whether you want to jump in all at once with 10 stocks or step in with a few at a time. Again, the end result will be what you use moving forward. When entering this situation, okay, so let me jump to the confirmed down. Confirmed down signal, I want to go to cash. The options are buy long, which is what you would select if you wanted to buy inverse ETFs during a down signal. Sell short, we know what that means. No action. No action says leave existing positions open until their stop criteria is met, but don't replace any new positions. So if you have no action set, you have positions that you've acquired during a confirmed up, but when a confirmed down signal comes, you are not exiting those positions. You're keeping those positions in the portfolio, allowing their stops to do the job, but you're not replacing any closed positions as long as you stay in that confirmed down. Okay? We're going to go to cash for the purposes of my demonstration here. I'm just letting you guys know your other options. So we're going to go to cash at a confirmed down. So let me get back to the automation rules for the up. When entering an up situation, what are we going to do? Well, this is not going to come into play here because we are not going to have any positions to close because we went to cash at a confirmed down, right? So imagine this, you're in a confirmed down. I don't know how long it lasts, a month, 2 months, you're in cash, you're feeling great, you're not losing any money, right? The market's falling, but then it changes course. You get a confirmed up, you got a full portfolio of buying power left, and you're deploying that buying power to stocks from pale blue chips, okay? So this section here is not going to come into play because we're not going to have any positions in the portfolio once a confirmed up call comes, okay? And we'll just keep everything the same that we looked at down at the bottom, okay? Click on finish. I'm going to change my date. So what's my start date here? For this particular test, my start date is going to be that May 18th confirmed up. Okay, and my end date is going to be yesterday. If I click OK, click on finish and run, watch what it does. It automates and trades the system the way you just laid it out. It's going to buy and sell stocks based on the market timing system that we're using, based on the stock selection strategy that we're using, and the exit criteria. So it's doing all that work. It's providing you with a very systematic methodology on how to trade those 3 components. Those 3 components, again, are when to buy, what to buy, when to sell. It's all covered here with a few different other variables, right? How many stocks do I hold? Do I replace or not replace? How many stocks do I step in at one time? That's all part of an automated rules-based, there are a lot of rules there, rules-based trading system. Okay, so what do we have? We have 48% winners. We have an 18% gain We have a 7.5% annualized rate of return. We have about a 13% drawdown. Not bad. What's the one thing that jumps out to you guys here? How has our portfolio performed since the peak of the market? So let's go to our market timing graph. Peak of the market was here in November of 2021. I don't know, the market's down, what, 30% or so since? If I go back to the back tester, here is that November 22nd confirmed down. And on that day, the portfolio was up, see this percentage here, right? Keep your eye on that. Don't watch my cursor. Keep your eye on that, because if I hover my mouse over that confirmed down, you can see it was up 27% at the time. It's currently up 18%. So the portfolio has lost 9% in the last 10 months, while the overall market has gone down about 30%. So this kind of makes the argument on what to do during confirmed down situations, especially in the environment that we're in, geopolitical and macroeconomic environment that we find ourselves currently, okay? Now, you can continue to tweak this, okay? If I want to make a copy of it, let's say I don't want to use the recommendation equals sell. I want to change my stop. I like the market timing system. I like the stock selection system that I'm using, but I want to just change my stop. You create a copy, you go to customize trading system, you go to your automation rules for the up situation, you go to stop criteria, and you change it, okay? And let's say I want to use percent gain loss. Close a position if it makes 30%. If I make 30%, I want you to close the position. If I lose 10%, I want you to close the position. So it's a gain loss. This is a 3-to-1 ratio, which is generally pretty effective. So that's all I wanted to change. I'll click on finish. What you want to do is kind of just adjust the name of it, right? So I'll just put here 3010, knowing that that's the stop that I'm using. That's all I want to change. I click on finish and run, and it will run the test again using the same variables except for the change in stop criteria. So, boy, I remember 10 years ago maybe a little bit less, where we used to do this all the time. We used to backtest so much. We still do, but guys, the trading system viewer is the fruits of that labor, okay? We did the work, you reap the profits. You can take any of these trading systems here and use them, or you can do what I just kind of walked you through and what Steve will walk you through in a little bit on building your own. But how did the change in stop work out? Well, it didn't work out as well. 14% gain, only a 6% annualized rate of return, a little bit less drawdown. So apples to apples, which trading system are you going to use moving forward? You're going to use the one that performed better, right? A lot of times questions are asked, why use this? Why do that? Why not do this? Why not do that? And the answer that I have, I know Jim, kind of says the same thing, is because it worked the best. We did all that work. We tried all those things. And this is what we came up with. This is the rules-based automated trading system that worked the best. And that's why, guys, it's in the trading system viewer. Chappell's chance goes ballistic. What's the stop criteria used again? It's the Profit Locker Pro, I believe. Steve Chappell created this. He put this together. I'm sure he tried different stops, different positions to maintain, whether to replace or not replace, different market timing signals, and so on. All of these variables have been tested inside and out, and here's the end results. Okay? So let me go back to backtester real quick. Now the final step. If you want to do this yourself, if you want to backtest, then the next step is to kind of make a quick folio or a portfolio from this backtest and track it moving forward. Very similar to what I did in the Genius a few minutes ago with the ballistic new highs, Chappell's Champs and ballistic new highs trading system, right? Basically, guys, look, what we're looking at is a backtest. Chappell's Champs goes ballistic. This is a back test. Okay? The back test is then transferred over into the Genius so that you can start tracking it going forward. The same applies with if you want to create your own trading system using the back tester. So if I want to convert this is not the final product. You would probably trade test multiple stops and just change variables, right? But if let's say I like this, I want to move forward with it, I just click on convert. Convert. Do I want to start with an empty portfolio? That will do just that. It will start with an empty portfolio. It still transfers all the rules over that we just created, but it starts with an empty portfolio. Or do I want to paper trade this, continue to track it moving forward, and then I would say continue from the end of the back test. We started on 5/18 of 20 with 100 grand. The current value is 117.9. If I did that, well, zero holdings, right? Why zero holdings? Answer that. Why, why zero holdings? Because we're in a confirmed down, right? You can keep this on. You can keep the Genius on. You can keep this portfolio here, even though it hasn't populated with any stocks. Because when we get it confirmed up, you will then get alerts, and the portfolio will populate with 10 stocks from pale blue chips, and then it will manage it the way we had back tested it. Okay, so guys, we have the tools necessary for you to create automated rules-based trading systems. We went through the reasons why you'd want to do that. Saves you time, relieves stress and emotion, and performs better over time. When we get out of our own way, we tend to perform better. So I want to thank you guys. I hope you guys enjoyed that presentation. If you have any questions, you can always email me, jerryd@vectorvest.com. But I think we're going to take a quick break now, and I'll send it over to Ray before our break. Thank you guys. You guys have a great weekend.
Thank you, Jerry. That was Can you hear me now? Okay, we'll try this again. Sorry, my mic died on me for a moment. But thanks a lot, Jerry. Great presentation. There's two ways that you can go about doing this, and you can either just hit the button. You can have it automatically, start tracking and trading for you based off of the systems that we have. Super easy. Or you can start building and designing your own based on your own preferences. I saw there were a couple of comments that came in. People were asking, well, I can't short. My broker doesn't allow me to short these positions. Can I use contra ETFs? Yes, it's super easy. You could swap out the shorting to buy long with contras, and there's quite a bit you can do there. But you'll have these recordings. Just as a reminder, we're going to leave them up on YouTube for you to view until November 30th. During this coming week, we're going to break them up into their individual talks to make it a little bit easier for you to digest, and you can go to the segments that you want. But we should have those segmented and separated by this next coming Friday for you. Hopefully a little bit earlier, but by Friday for sure. And then just a reminder, if you want to download the slides, you can go to vectorvest.com/MC slides. And I had mentioned this earlier, I'll mention it again. I know product support's getting a lot of calls for the courses, the discounted courses that we had from our Labor Day sale. We did extend that, and if you want to take advantage of some of those courses, if you're relatively new and you just want to get a handle on your basic investing, you can take the Successful Investor, or if you're interested in swing trading, we have Precision Swing Trading in there, and you can see all the different courses, including the Options Jumpstarter. So if you're interested and you want to continue your education, take a look at those offers. It's vectorvest.com/MC courses. And for those of you who are brand new to the software, you can take that trial out, the 60-day trial, and that is vectorvest.com/MC bundle. So with that, we're going to take a couple of minute break, 15-minute break or so, and you're going to hear another message from our founder, Dr. Bart DiLiddo, about being an optimist. So we'll send you over there right now, and we'll see you back in a few.
The seventh secret, we're finally here, folks, is to be an optimist. I firmly believe that you must be an optimist if you're going to be a successful investor. In fact, I can't understand why you would even be an investor if you aren't an optimist and you believe you can make money in the stock market. Now, it's a great thing to be an optimist, but there's a very fine line between being an optimist and a fool. A fool is someone who thinks they're an optimist, but doesn't face up to reality and recognize when something has failed. They kid themselves in thinking they did okay, even though they didn't prepare themselves, they didn't do the work, put in the effort to ensure that the outcome was going to be favorable. No matter what happens, they think they got a favorable outcome. And there's no reason to fool yourself. And that's not being an optimist. But however, that may even be better than being a pessimist. A pessimist is a person that doesn't think anything's going to work anytime. And pessimists, generally speaking, are losers. They're the folks that don't want to put the time and effort to do anything, to improve themselves, to make themselves better, because they think they're not going to make it. They're not going to achieve. And one of the worst things I've seen as far as pessimism goes, I've met a lot of young people over the years. Some are nephews and nieces that had all the ability in the world to go to college. And they didn't go because they had to save money for a car, or they had to do this, or they had to do that before they went. And they always have an excuse for not doing something. If you see that in a person, you know they have a pessimistic attitude. That isn't good. Getting back to fools. Speculators are fools because they just like to shoot for the moon. They don't like to do a lot of work. They like to take chances. They risk themselves, they risk their money, they risk their portfolios, but they may get lucky and hit a big winner, so they think they're great. But pessimists are never going to hit that big winner because, you know, they don't even want to buy a ticket in the lottery, for goodness sakes. And I'm not sure whether that is a distinction between being a pessimist and a fool, because if you think you're going to win a lottery, you got one chance in 450 million, but you might, somebody's got to win it. So anyway, the thing that I suggest is you take an optimistic view at things. And when you do that, you got to be willing to justify your optimism. You got to be willing to do the work, put in the time, and learn the basics. You got to be willing to assess what the gains are versus what the risks are what the losses are going to be. And if you do put the work in and you try as hard as you can and it doesn't work, you can't let it stop you. What you do is you recognize the failure and you say to yourself, well, what caused me to fail there? Or what caused that event to fail? Because one of the greatest learning experiences is when things don't work out. I started my career in research, and one night I was driving home from work, and I said to myself, you know, just about everything I do, day after day, week after week, doesn't work. But that was my job, is to try things to see if they were going to work. And whether they worked or not, we had to document everything we did. We documented the results. And slowly but surely, you know, we took that information and we kept making changes for the better, hopefully, and we ended up producing a product. I got a patent for making anhydrous acrylic acid over an experiment that I thought was a total failure. I put the ingredients together and I cooked them, and I ended up with a mess. I sent it to the lab to get analyzed, and what they showed me is that the ingredients had combined to create an intermediate. And all I had to do is take that intermediate and throw it into a pot and heat it up, and the anhydrous acrylic acid came off the top of the distillation column, perfectly dry and perfectly pure. It's exactly what we were looking for. So you never know when a failure is going to turn into success. And that happens. You remember the guy that invented, created, or discovered penicillin. It was almost the same thing. Great discoveries are made only by try again. But at least they can recognize when something hasn't worked. They don't tell themselves, well, this is good. You got to be able to gain from your failures. You got to learn how to gain from adversity. That's the secret to success, really. When it comes to investing, I'm sure all of us had made trades that we hoped we would never made. But you got to say to yourself, well, what went wrong? Why did that happen? And you got to learn to avoid those. And you're going to get better and better. And so I'm very glad that you folks came here, and I'm actually especially glad that you stayed here for this very last session, because you're optimists. You have the self-esteem and the confidence in yourself to learn, to put in the time, put in the effort, and try to make it work, and work better and better all the time. So I congratulate you, and I thank you very much for listening to me, okay? Thank you so much, and best of luck to you.
Hello, everyone, and welcome back. We're turning the final third base around the corner for today's sessions. We're really excited that you're here. Please show your support. Hit the like button down below. I think we only have 400 and some likes, and there's over 1,000 people here. So smash that like button, and don't forget to subscribe to the channel where you're going to get notifications. You can ring the bell. We'll notify you as we put out our content every single day of the week. We're always flooding YouTube with information to keep you abreast of what's going on. So before we get to our final couple of talks here, I just want to make mention of something, and product support's been receiving some calls in regards to it. For those of you who are on, let's say, end of day or even intraday, and you do not have access to the auto timer or Pro Trader or some of those tools that we've been talking about, you can also take advantage of that trial. So if you go down to VectorVest.com/MC bundle, you could also take that trial for 60 days for free. And how it'll work is your current subscription, let's say you have end of day that is billing monthly in the background, that will continue, but all of a sudden for the next 60 days, you're going to have access to all of these powerful tools. We are leaving this up on today's sessions up on YouTube, so you can go back and watch them. You can rewind, fast forward, see exactly what Jerry showed you and what Steve and Todd are about to explain next. So take advantage of that. So we have almost 1,000 people in the room, so I would expect most of you, unless you're on real time and you already have access to those tools, give it a shot. Be an optimist. You can do it. It takes a little bit of playing with, but once you figure it out, boy, you can reduce a lot of stress, a lot of time, deploy a trading system, sit back, reap the rewards. We'll do all the back testing for you here at the office. We'll upload new trading systems into the trading system viewer that you can take advantage of as well. So I encourage you all to take advantage of that. And next, we're going to move over to Mr. Steve Chappell, once again, Director of Trading Systems Development. And he's going to show you how to test and build and deploy a dynamic trading system. So take it away, Steve.
All right, thanks again, Ray. And boy, Jerry's, I'm going to use a bowling analogy. Jerry set up all the pins, and now we're just going to do nothing but bowl a bunch of strikes. He made my job so much easier. And that was the plan all along, of course, but nicely done there, Jerry, as well. So as Ray just mentioned, we're going to talk about how to build, test, and deploy a dynamic trading system. So first things first, let me quickly lay out 3 main objectives that I'm going to have for this presentation. We're going to show you how to completely, from start to finish, design your own trading system. We're going to go into a little bit more depth than Jerry did, but having seen Jerry's presentation, it's going to make it seem a whole lot easier. And then number 2, we're going to actually make that Chappell's Champs Goes Ballistic strategy, that trading system, nearly 2 times better. So for the old veterans that are in the room, and I know there's many of them in the room right now that are actually using that trading system, you're going to be glad you came. And then number 3, I'm going to show you that there are in fact 2 new trading systems in the trading system viewer right now. So hopefully some of you have already spotted that and made note of it, but I will bring those to light in this presentation as well. So I've got my work cut out for me. Everybody give me a quick prayer and let's proceed. But a dynamic trading system starts by understanding that it's a complete system. The system includes a complete set of data, of rules for selecting, entering, and exiting positions, along with asset redeployment specifications. Okay. So I think the most difficult part of that for some folks to grapple with is the asset redeployment specification. So when we close a position, what are we going to do with the remainder? Are we just going to let that sit as a cash position until the next cycle in the market, or are we going to redeploy that into a new position, or are we going to redeploy that capital amongst the remaining positions that are in a portfolio, and all kinds of little variations thereof? Okay, but after you capitalize on a trade, what are you going to do with that money is essentially what that gets after. Your flow in developing a trading system must be comprised of 3 main cornerstones. There can be many, many layers of information hereafter, but these are the 3 elements that you cannot live without. So just imagine a three-legged stool and you're sitting on it, and if someone were to remove any one of those three legs, what's going to happen? You're going to go boom. You're going to fall down and there's going to be a disaster. So we need to account for these three things to be sure in every system that we design. That is going to be the when to buy, that is going to be the what to buy, and that is going to be the when to sell. Your system and how you do that and how you put it together is ultimately going to determine your success or lack thereof if we don't do a very good job. So this is where the rubber meets the road in putting things together. We need to address these three quadrants, and we need to do it well. So when we talk about when to buy, that's going to be reliant on the market timing signal that you select. And those signals range from very aggressive to more prudent to conservative in nature. And we're going to hopefully maybe even do a little better job of designating some of those for you along the way here. And number two, we're going to look for a unisearch strategy that is ideal, hopefully, for the market timing signal that we are selecting. We're going to give you some pointers on what we mean by that. But a lot of times, just high level here right out of the gate, if you have a very prudent to conservative timing model, then generally speaking, the stocks that are going to do the best, there's always exceptions to the rule. We're talking rules of thumb, folks, but they're going to be good, prudent to conservative type stocks, right? And if we're more aggressive with our timing, the more aggressive stocks are going to do better because the good, safe stocks take a little bit longer to get to grandma's house. They need that longer timing model, okay? So hopefully that makes sense even on the surface level. And I think what you're going to see is the benefits of doing it right and doing it all together here in a sec. And then when to sell. Dr. DiLiddo, coming from the tire business, would tell you this is where the rubber meets the road. This is where you either walk away from a trade that you put out into the open market, either a winner or a loser. And our job is to manage those closures effectively and efficiently. So we want certainly to, over the course of month after month, year after year, become more and more profitable because we're choosing the right stop loss that, again, should be congruent with the type of investor, the type of model, the type of stock that we're selecting. So what we don't want to do is get into a conservative or prudent type stock and put a 5% stop loss on there. Those great stocks, boy, they can use a little bit of room to get you again all the way to grandma's house. Okay, so here's some pointers as we go along. We're going to dial a little bit more into when to buy. So on the when to buy, good safe stocks work best with moderate to conservative market timing signals. Those signals being green light buyer, confirmed calls, and I would even throw DEW in there on the edges. I meant to do that in the slide actually, so you could pencil that in if you're keeping notes at home. But green light buyer, that would be either the green light buyer RT kicker or just the green light buyer. Confirmed calls and DEW. Aggressive stocks typically perform better with faster signals, primary wave or DEW. So this will be handy when you're putting systems together for yourself. One of the most difficult situations for people who don't have any experience doing this at all starts right out of the gate. You know, what market timing model should I start with, or which one should I look at first, and give me a better chance for success of putting a good system together. In terms of the what to buy, it's going to be our job again to get in and make sure that we're using searches that are consistent with either more prudent or more aggressive, what have you. So Jerry really already got into this, which is why I'm getting through these early slides a little bit more quickly than I envisioned. But I think it's a friendly reminder here on a couple of things. One, if I go to the timing, one of the things that you ought to do is study the market timing graph a bit and study it in terms of signal, and then think of it in terms of frequency and comfortability for you as a trader or investor. So there are people in this room that are going to be comfortable doing hundreds of trades a year, if it means more profit. There are also people in the room that have no interest in that whatsoever, as long as I can get reasonably good profit without doing all that work. And so signal is where that starts, right? So if I come in here and go to confirm calls, for example, in just the last 1 year, there has been 1, 2, 3, 4, 5, 6 signals. We've gone long, market went up, we went short, we're into cash, the market went down, we went long just for a few days, short. So that's not going to cause you a lot of trauma in terms of, hey, I just got a confirmed up call. I need to think about what stocks, what 10 stocks or 20 stocks I'm going to be buying today. You're not going to have to do that very often, right? So it makes things very livable for a vast preponderance of probably this audience. Same thing with the down. I know that at some point here, I'm either going to have to go to cash and close 10 or 20 trades down in a day, or even cycle that over and go short, so potentially adding 10 to 20 more trades that day. It's still not a whole lot of trading. Then comes the stops, though. So there's still going to be some activity between these dates as well. But the one thing we know by this timing model is we don't have a very fast frequency, which means that in and of itself isn't going to have a whole lot of activity tied to it, which is good, again, for a lot of folks. Now, if I could speed it up here just a bit to DEW, I talked earlier this morning that this is kind of middle of the road. Here we had 1, 2, 3, 4, 5 up signals, and 1, 2, 3, 4, 5 down signals. So frequency of 10. So you can see it's picking up the pace here a little bit. Now, there's advantages to that, and this is where you start studying the charts. So am I getting in earlier, closer to market bottoms, and out earlier, closer to market tops, consistently at least across the broad spectrum of the 10 signals? And the answer to that question is inevitably yes, particularly if you go back and you study, say, 10 years worth of data, not just the last year. So this signal is going to do a better job at getting you in a little bit more towards a market bottom and out a little bit quicker after a market top, which yields, as you might imagine, higher profit potential just by nature of signal itself. We'll get to the stock level in a minute. So hopefully that makes sense. And then, I mean, if you're a maniac, you can follow the primary wave. I actually happen to like it. I use it quite often, at least to initiate campaigns at market turning points more so than anything. But what you love here is how close to the market bottoms and how very close to the tops these signals come into play. The penalty therein, though, is look at the frequency. If we're trading 10 stocks a campaign up and down, that means we're going to be doing exponentially more trading just on signal alone. So some of you are saying, yeah, not for me. Others of you are saying, oh man, that thing's cool, because when it hits it, man, it gets it just a day or two off the bottom and that market rips. And I know that if I'm in really good, strong, aggressive stocks, boy, I can make a pile of cash when that happens. Sometimes I'm going to pay a little price for that, because I'm going to have to be nimble enough to go long and short consecutively from time to time when the market is searching for a direction. But boy, when it figures it out, I'm going to be on the right side of that market for almost the entire time. And that's where the money is, okay? So hopefully from what I just said there, you're starting to figure it out for yourself, sort of where you fit. And I would say, just from the experience of traveling across the globe, all the way from India to Australia, anywhere in the US, Canada, most of Europe, most of you guys fall more towards the moderate to prudent to conservative types of signals, because it's just not as much work and you can still do incredibly well. Okay? All right, so where we're going to land as I help you look at how to build one and let you into my trading room, if you will, on what are the steps Steve goes through when he puts these dynamic trading systems together, you're going to see that in action. Jerry started the process. I'm going to take you a little bit more in depth on that though. And we're going to go with the DEW in this case. All the new trading systems I've put out this year have been with the green light buyer. I really feel that that's been the most effective system this year. DEW may be a close second. Okay, and it's not so crazy that it's going to drive you nuts. And it's a little more effective at times at really getting you in at some good prices. And there's going to be reward for that. Okay, so from there, we've talked about what to buy. And so if in looking and studying this graph, I know that the average upturn is generally maybe a couple to a few weeks in length. Do I want to go out there buying high dividend paying stocks? I might do okay with those, but do you think we could do better, maybe giving up some of that safety and getting just a little bit more teetered toward the risk side of the scale? Sure. I mean, it stands to reason. Good, safe stocks, they just don't climb up the ladder as fast as the higher growth, higher reward type of stocks do, okay? All right, so over in Unisearch, as Jerry showed, one of the great things, the further up the learning curve in VectorVest you get, there's other choices here, but one of the great things when you start is just, it's laid out for you by investment temperament, which is huge, because you can't make very many mistakes if you know you're prudent. Hey, look, I want some safety, and I know I want some high RV because I want some potential in the stocks that I pick. This is a great category. So I'm just pigeonholing where I think most people in the room stand when I build this thing with you guys, okay? Now, what we're going to do as we get there is I'm going to tie this folder of searches to that signal. I'm going to show you my process for determining what I like to see in terms of the result, looking at a number of tests to get a better feel for that, okay? We're not quite there yet, so I'm going to go back to the slides. And then inevitably when to sell. So just some general tips here. Favor wider stop combinations on more conservative timing signals. Recommendation equals sell is a great place to start, and I was so glad to see Jerry do that in his presentation. That's typically where I would start. And then start looking at some of the other choices from there. Favor tighter stop combinations on more aggressive signals and stocks, okay? All right, so let's put one together, the whole process. My fear is, being sort of the trading system, I suppose, guru at this point, although Todd over here, boy, I tell you, he's the mad scientist to be sure. He loves doing this as well. So I'm not coming for your title, Todd, but, what we want to do is start matching this search selection to the timing model, getting some result, and then building from there. So here's how we're going to do it. Again, over on the timing tab, we go to market timing graph, and we've got our DEW signal. And so what I do typically, I still do this to this day. I guess I am slow to make the full transition over to being totally digital. I take a notepad and I write down a sequence of signals. For sake of simplicity, I'm only going to focus on one upturn and one downturn. But what I would do is go back to as many ups and downs as I feel comfortable putting in the work to do what I'm going to show next, to try to, as effectively as possible, pick the best prudent search, the most consistent performer for this signal over the recent past. I said something very important there, which is recent past. I have people, when I release trading systems that have performed really well over the last 3 years, then say to me, yeah, but when I go back 20 years and test it over that 3-year period, it doesn't do as well. It's not supposed to. Markets evolve, markets change. For example, just think about the dynamic in the stock market over the last 3 years. You went from sort of top line growth into panic, into frenzy over stocks that had sales growth, into those are the worst thing you could possibly think about right now, more of a value market, right? So we want to focus on what's working well now. The most recent year or two far outweighs anything that happened before. And what you'll find is this is something that you have to revisit going forward. Inevitably, trading systems start to slow down as market dynamics change, right? So the cool thing for you guys, again, is we're putting, and we'll continue to put, as many good trading systems into that trading system viewer. You'll see a lot more over the coming months, so that as the market transitions, all you got to do is sort that viewer, and you're going to have something in there for any kind of market dynamics. That's really cool stuff, and I hope that you feel pretty good about that. Okay, but that should make sense strategically in how you want to think about putting things together, and why I'm focusing on right the here and now. Okay, now there's going to be people out there that say that what I'm about to do doesn't mean anything. In other words, back testing is a bunch of hoopla on things that have happened in the past and are therefore not likely to happen again in the future. And that is a bunch of crap. I'm going to use the word, sorry. Hopefully that one's not too bad, because that's how I really feel about that. To explain that to you in the best terms I can in my head, that would be like walking into, oh, who's the best football coach out there right now, guys? Who's the Patriots coach? Belichick. That'd be like walking into Belichick's office and saying, I know you got this game this weekend, but the last thing that you should do is study the game film on the Dallas Cowboys. Because when they come to town, they're not going to run the same plays. Baloney. When it's 3rd and goal, there's only a few plays that those Dallas Cowboys are going to run ever over the course of a season. And so while it's not 100% corollary to future performance, it's as close as you can possibly get. And that's why football coaches look at game tape, because they know that that's as close as what they are possibly going to see in the future with what they have at their disposal. This is incredibly important stuff. Okay, let me get a sip here. Sorry, guys. Hopefully I'll make it through the presentation. Struggling a little bit. But so what we're going to do is study some game film. That's what we're going to do right here. So we're going to look at the prudent category of searches from July 19th of this current year, being long up until 8/29. Then we're going to look at the short strategies and look at being short from there to here. To speed things up, then I'm going to show you that, remarkably, without having done all of the testing, they do hold up over the course of this whole year. That's a bit lucky, but you know, if you do some more work, you can find some other gems. All right, now with that being said, let's get to it. So we're going to test the prudent folder long from 7/19 to 8/29. Now this can be done actually relatively efficiently, okay? And it's as simple as this. You just come into the search tool, go to the prudent category. Right here at the top, if you don't see the folders, just click the A to Z button until you see yellow folders. Then go to the search as prudent. It's alphabetized. Click on the top search, get the date. So the date's going to be 7/19. Oh, it's over here. Okay, so let's go back here. 2022, 7/19. Okay, and this is literally what I do, guys. Run the top search. Hey, all right, yeah, I like these kinds of stocks typically. Alphabet, Nvidia, United Health, Meta Platforms. All right, cool. How'd they do? So we'll quick test them. Now the quick test automatically comes all the way to current. So you can already start to see the benefits of market analysis, because at this point, if we just bought and held from July 19th to now, we're down. Okay, stock prices went lower. Now if we just go to where the signal came into play, and guys, on the quick dates over here, you can make your job a whole lot easier by selecting your timing model in the calendar. That'll identify the date for you visually. And I know 7/29 is the end, okay? So if I run my test, what was a 14% loser is only 2. So we minimize damage here. Not a great search so far. for the current situation, right? Let's go to best of the biggies and just rinse and repeat this process. Quick test, Chapel. All right, this one's a little better. 2%. Now, some of the things that I start to look at when I'm looking at this result is not just the percentages. That's the first thing that I'm going after here. Because at the end of the day, our job is to make money, right? So that's naturally where you start. But then what you want to look at are, all right, how many winners do I have? How many losers? How big are the winners? How big are the losers? Can money management, if I can find some gold, really improve things? And what I have here is, kind of a mixed result. So let's keep going. Watch this one. So this is best performers greater than $1. Not as familiar with the stocks. Watch what happens. This is what's great about VectorVest, okay? I love the sort on this one. We'll talk about it here in a second. But when we run the search, quick test them, these stocks went up how much? I can't read it, Todd.
21%.
21. Thank you, buddy. How many winners did we have? We had 9, right? 1 loser. Loser lost very little. Boy, look at that. 54%, 51%. Price points, I'm pretty comfortable with those. Nothing's like $1 or $2 or anything like that. So yeah, these are prudent style stocks. They got really good RV for the most part, decent to good, really good RS. Timings look great. It's all good. On top of that, the sort is an important part of a search. And listen, we'll create a workshop somewhere down the line where we talk about search design, because you could spend a whole afternoon or probably a whole day just talking about that. But the sort is like shuffling a deck of cards. This is for the benefit of the new folks, never seen VectorVest before, right? So you see that we're getting good prudent style stocks. The RV and the RS are acceptable. RVs are really good to excellent. Yeah? What becomes maybe the most important thing then is what 10, because there's going to be more than 10 stocks that this search returns. So what 10 am I going to buy? That's the sort. It's like shuffling a deck of cards. It's taking say there's 219 results. It's taking the 219 results and it's deciding what are the top 5 or 10 returned by the search. Okay? This one's great. It's more technical in nature, but the reason I love it, RT times CI. What might that mean? Well, we learned from Glenn that RT is a pretty cool indicator. It looks at a whole bunch of factors and determines the short-term price trend of the stock. Right? It looks at the dynamics and the magnitudes and everything. But that's really cool because I know that the graphs on the stocks, when I buy them, the stocks are pushing. The other thing, the CI, he talked about that as well. I've got good long-term performance. I've at least got the best combination of those two factors. Good short-term price performance and good longer-term price performance. I love that. That's the kind of stocks I love to buy. I love to buy stocks. Learned this from Doc 20 years ago, never going back, Stocks that just climb up that page, bottom left to top right, and that are still pushing strongly at the very end because they likely just stay on fire, guys. Was it Isaac Newton? What gets in motion stays in motion until a new outside force kills that motion, right? So, not the exact words, but paraphrased it. I like buying those stocks hitting new highs that are high momentum. When the market goes up, those stocks are on fire. That's what the market really likes. We like buying stocks that are doing what you want them to do, and that's go up in price. Not buying stocks on the way back when they're going the wrong direction, because when we get in those, they tend to go down more before they start going up again. We talked about that in buying low and selling high. So this is great. Happy with that. Can we do better? I don't know. Biggest bargains. Let's see. And so this is the process. I'm not going to belabor it on and on and on. Let's see how my search does here. Oh, that's not too bad, right? So Bill's best bets could be a choice. And I tend to carry about 5 searches onto the next. I'll jot those 5 down and carry them onto the testing. Because I might find when I start combining searches from long to short, that some of the combinations that I didn't think were the best end up being better. So I generally take about 5 from each category. Okay. So you just keep doing it. What's Chappell's chumps? Oh my gosh, that better do well or I'm going to run and hide. 16%. There you go. Good search. Okay? And that's in the Chappell's Champs Goes Ballistic, right? So we have a pretty good idea that that search does what we want it to do. And you just keep going down the list. Heavy hitters, test the whole thing. They're all prudent searches. And then what you would do again, if you are willing, is do even more testing over more time frames and walk away with that list of 5. All right, then you do the same thing on the short side. So let's go back to the graph here. And the short, remember, this is great because it's recent, I'm going to show you what the hottest short strategy is in the database right now, or at least as far as I got on my testing before I figured, well, we're showing them the process. So 729 to current. I'm going to come up here to the top. We're going to change that date when I can to 729. Give it a second here. Something must be hung up. Woo, market rolled over. Market's not closed yet, but it's lower on the day now. Goodness gracious. That's good for Steve, though. All right, let's see here. Let's go to 729. Or I'm sorry, 826, sorry, 826. I need DEW. 829, yeah. All right, let's see here. Quick test these. Yeah, so I might have cut that end date short on the last bit, but that's fine. You get the idea. We're running signal to signal. Now we're also going to need to go to the short searches here and start going through that same process. Just go one after the next after the next. I should not have run this strategy again. That was a mistake. This is a more rigorous search to find really good heavy hitting stocks. It's got some pretty hefty criteria in the search itself. All right, so hopefully it'll jostle back to life here pretty soon. Seems like we're getting about to the amount of time it was last time. Shouldn't have ended with that one. There we go. All right, so I'm going to go to search as short, right? And we'll go ballistic highs short. So this is, again, part of Chappell's Champs Goes Ballistic strategy. We'll see how that one's been doing here recently. Hey, pretty good. 11%. How about, now this is one that if you're new, may not make sense until I explain. So when you short a stock, what you're doing is borrowing the stock from another shareholder, right? And there's a cost to that. But when you redeliver the stock, you can keep the difference. So if the stock price falls, say $5, you're going to keep those 5 points, deliver the share back to the owner. He's happy. You're happy because you're getting $5 in the process. Okay, so when you short a stock, that's not the best description I've ever given, but when you short a stock, you're expecting the stock price to fall. There's actually an interesting documentary on the whole GameStop thing that just hit Netflix yesterday. That does a pretty good job of explaining short positions as well. But anyway, this is actually good. When we short something, we're expecting the underlying stock price to fall. And when it does, we keep the difference. Okay, so 19 down to 12 is actually a 34% gain in our pocket when we return that share. LQDA, 29% gain. These are actually the losses that would be incurred for being wrong, okay? All right, so not too shabby. That was about 11% net on the short side. So let's go to the next one here, crash landers. All right, 10% here. Boy, have some hefty losers. Have some better performance on a number of stocks, but so that's one that might get a lot better with good stop losses. See what I mean? So I'm looking at that and I'm saying, hey, there's something maybe to work with here on crash landers. All right, let's go to Doug's Downers. 16% here, and 8 out of 10 winners. And so this is the process, right? Where's Hindenburg? Hey, best yet, look at that sucker. Man, I can really not read that. You guys are having no trouble at home. Believe me when I say I can barely see it. But I think it says 25.91%, and if we're short, it's actually gain versus loss. And look at the massive amount of winners here and good percentages across the board. So I'm left with somewhat of a dilemma. Some might think crash landers, looks like with some good money management, might do a lot better than it's done. Or Hindenburg stocks, where with no management at all, I'm pretty happy with the result. I am a man of least resistance. I'm going Hindenburg stocks in this case. But if you had a couple of searches with very similar results, so more similar than this case, right, I might look at both of them extensively to see what could be done. So hopefully all that makes sense, right? And so I end up with two searches. I end up with Hindenburg stocks and prudent performers greater than $1, right? So we now leave those two tools. We leave the market. So the first tool was the market timing graph. That's where we got the signals. We jotted down some dates. Then we came into Unisearch, focused on the prudent folder because we're prudent, and said, all right, here's 5 searches long that we like and 5 searches short that we like over a number of signals. Then we head to the next place. And this is all in your PowerPoint. What we're going to do now is step 2, which is refine the baseline results using backtest. We're actually going to create a baseline, and then we're going to refine it. Okay? So what we do is we come over here into Backtester. This is generally where I have my whole game film football coach discussion, but I already beat myself to the punch. Backtesting is absolutely worth it, guys. I mean, it really is. I could not have done as well in the stock market as I've done without it. I can just tell you that flat out. Okay, I'm going to go to backtest an idea here. When I do that, we're going to call this baseline. You can also, if you prefer, just put the names of your strategies in there. And in fact, I'm going to go ahead and do that. Just make things real simple. So we're going to put prudent performers and, oops, money. Yeah, show me the money. Prudent performers and Hindenburg stocks. Oh boy, I don't know if I can spell Hindenburg. Hopefully that's close. When we talk about Hindenburg, you guys remember the giant air balloon? Yeah. So when we say Hindenburg stocks, we're expecting stocks that are catching fire and plummeting. All right, let's see here. So next thing we do is build it. Okay, and so you can select an existing system. So that's where you can pick them right out of that trading system viewer. You can pick Chappell's Champs Goes Ballistic. You can pick a couple of the new ones that I just put in there or any other one. And you can then even begin to refine it. Or we can build our own. So I'm going to click that one. Remember, we use DEW, right? So step 1 is done. Just come right out here, DEW. If you need to bone up on the reason the signals are generated, all the rules for the signals are listed here. So this is a great little resource. Some of you might even copy some of this, put it on a document so that you can refer to it later, maybe in your rules document for your trading system. Okay. I'm going to go to the next step, which is let's plug in the long search. So the long search was in the prudent folder, right? We just go down here to search as prudent. Click in best performers greater than $1. They're well greater than $1 if we remember. So don't let that scare you. Right? We don't need any stops yet. All that stuff, all the stuff on stop criteria and more settings comes next. We just want baseline. What if I bought and held prudent performers over all the upturns, or shorted and held Hindenburg stocks over all the downturns? So on the rules down, we're going to go to search as short, and we're going to go to Hindenburg stocks. Okay? And we can finish this up. So that's my system. That's the baseline. So with no money management, no rolling up of buying power, no fancy schmancy dancy, just bare bones. I get an up signal, I buy 10 stocks long, I close them out when I get a down. I also, when I get a down, not only just close those stocks out, I go short with 10 positions. Okay? How do we do? Let's see. We're going to go for the full year. We're going to wing it. Always start with the most recent signals as a tip. If you're going to do any of the quick testing at all, which you should. Otherwise, you're totally flying blind here and are going to get often very lackluster results for a long time until you stumble across something. Always focus on the most recent signals because you at least want your systems to be working now. So the more, start from the right and work back. Okay. All right, January. Let's see here. Come out to the right. DEW. When did we start? Oh, 22. That's why. We got to go to 22, man. January 5th. January 5th, 22 is when we're going to start. Okay. And let's run it. See what happens. This is the fun part. I used to love video games. I can't help it. It was a lifetime ago now. I don't want to liken this to a game, but this is a lot of fun for me, We'll see how this result comes in. This would be great for your kids if you can get them started on it now. Maybe fund them an account with a few $1,000s, and boy, I tell you, in about 30 or 40 years, they're going to be happy you did. And they're going to have a lot of fun along the way. Very educational set of tools. Okay. So this is looking at being long, being short off of that early signal in January. Then we went long, didn't do as well as we would have hoped, went short again, made a little bit of money, went long, made a little bit of money, went short, didn't do as well, and so on across. So can we make it better? Although, let's say we didn't do anything to this whatsoever. This is this year, I'm going to say this very clearly. This is this year's performance. How many people, this is with like no fancy schmancy stuff whatsoever. How many people are up 52% this year? And if you are, you're probably in most cases a VectorVest subscriber. This is the kind of thing that you're doing, right? It's pretty impressive, I would think. So going back to my early discussion on buy low, sell high, where the experts, I think, cause more confusion than they should is saying, you can't time the market. You absolutely can time the market. And I guarantee you, if they don't believe in it, which they probably really do, they're not making money this year at all. Right? Because they always have a long bias. Market has done nothing but go down. Here we are, we're up 50%. And it can get better. So let's work at it. Now, just like a scientist, what you don't want to do is say, all right, man, this is great. You get all fired up and you get in here and you say, I'm going to edit this thing. And you get into customized trading system and you say, all right, I'm going to modify all this stuff. I'm going to put a stop on this one. I'm going to put a stop on that one. I'm going to say no more than 2 per sector over here, 1 per industry over there. And I'm going to do all this stuff and run another test. No. You're going to have no idea what helped you, what hurt you, and everything in between. Remember back to grade school. There's a control. The control is your baseline. And when you adjust anything in that experiment, you do it incremental and you do it one thing at a time. Otherwise, you have no idea what helped and what didn't. Okay? So what we do is we come on the long side and we say, all right, I'm going to go to percent gain loss. I know you guys are getting tired, so I'm going to start skipping to answers. Anybody say amen? All right, there we go. 99 gain, 10 loss. Let's see how that does. Hallelujah. Right, Glenn? Amen. Amen. I meant to copy it, okay? But that's okay. So generally speaking, what I like to do is keep that baseline there so that I know if I've increased the bar or not. And I want to look at several factors. I want to look at winners. I want to look at percent gain loss. I want to look at commissions. I want to look at max drawdown. And on that subject, what I generally do, here's another tip. I set this is up in the account settings. I set this commission to 1. Most of us don't have commissions at all anymore anyway. The reason I set it to 1 is so I know how many trades are actually happening without having to calculate $4.95 a trade. Okay, so I'm going to finish and rerun this one. That way we get a total idea of how many trades so far this year. That's in and out, okay? So half the number is round trips. So we had 71 round trips. 71 buys and later sell or short and cover. 71 round trips, okay? Make sense? That's not that bad. It's like 10 a month, less, right? Acceptable. I can deal with that. Some of you are like, man, I made hundreds of trades this year already. Some of you are like, I only bought 3 stocks all year long. Well, this is the way to grandma's house. This is what's going to get you to the 50%, okay? All right, so let me copy this again. Now we work on the short side. We'll go over here, say, all right, Steve knows some of the answers, so he's going to skip saying, all right, I'm going to do a 10% trailing stop, then I'm going to do a 15% trailing stop, then I'm going to do a 20% trailing stop, and then I'm going to do a recommendation, not a sell, and then I'm going to do a RT goes back above 1, then I'm going to do there's all these fun things to play with, okay? I'm just going to start giving you answers. Hallelujah. Because I've already done a lot of that work, okay? Not all of it, enough. So I'm going to go to gain loss. In this case, we're going to use 99.20, I believe. Boy, I hope I wrote that down right. That seems a little high. But I think I'm thinking about one of my trading systems. All right, so this is 99% gain on the short side or a 20% loss. Now, one thing that you just figure out over time is sweet spots. And over the last 20 years, I've learned that if you go out there with tight stop losses on short positions, you're going to have a tremendous amount of turnover, and it's like a funny car trying to get off the starting line. And eventually that sucker goes, you know. But a lot of times, if you don't give it that much gas, or if you give it more room, in the case of the stop loss, you get off the ground a little bit more easily on the short side this way. Okay? So what we're going to do is finish and run it now and see how we do. Mama mia, what does that one say? 92, 92% this year. Yep, that's right. We told you when you came to this course, you could see systems that outperform the market by what, Ray? 20 times? The market hasn't even gone up this year. This thing's up 92%, man. Nobody's excited about that. I mean, I say that even if I'm at a show, because everybody's at this time of day is just like, and I can't believe it. You know, I'm sitting here saying, look, all you got to do is follow the plan. You know what gets in the way of making this kind of money? It's right between these two fingers. You either don't believe you can, right? Or you get in the way. The more you can remove this from what you're doing, the better off you're going to be. And I get it, guys. Listen, I started with VectorVest 20 years ago. And when I started looking at this thing, I said, oh my goodness. You know, there's a lot of stuff here, and I can already tell because I've looked at my stocks in the system, and boy, I should never have bought those. And the ones I should have bought, you know, they made a lot of money. But I'm not so sure. You know, maybe they just got lucky here over the last year. Guys, I've been doing the same thing week after week after week, year after year after year for the last 20 years, showing people this process. There are people in the room. I hope Kirby's in there. Maybe some others. Chime in. Let them know, man. When you start actually doing this, I've been so proud of Kirby recently, man. That guy is really, really doing it right. When you start believing and following, it's unbelievable what this means for you. Okay? 92% this year. How many people did that? Now, without options. Well, I made 200. Well, if you did, you probably did options or something. triple leveraged contra ETFs and whatever the case may be, right? This is just with stocks, man. This is just stocks. 168 trades. That's like 84, is it 84 round trips? I don't know, I suck at math. Ever since the advent of computers and calculators and everything, I don't have to do those math tables anymore, right? It's 84 round trips, right? It's nothing. Well, I don't want to do that much. Well, then what do we do? If we don't want to do this much activity, what do we need to do next? We need to go back to square one. We need to go back to market timing graph. What do we do there? We go to the confirm call, because that's going to cut that number probably in half just by itself. See what I mean? It's got nearly half as less signals, right? It's probably going to put a big dent in that, right? But I need to make sure that those strategies work well with the confirmed calls. We didn't test them on confirmed calls. May blow the whole thing up, right? So you start back with that prudent folder, confirmed calls, and work your way up from there. That's how you do it. That's how you put systems together. Then what you do from there, once you're happy with your result, is you convert that to a portfolio. People always ask me, there's two settings here. So you can start with an empty portfolio, or you can continue from the end of the test. Which one do I do, Steve? There are two really solid choices here. If you're in the middle of signals, like if you've just a couple of weeks ago had a down signal, right, and you want to get out there in what's probably the most effective way, I would suggest continuing from the end of the test with the mature trading system. What's usually best practice is to wait for the next signal and to start with an empty portfolio and buy the new ones on that new signal. Does that make sense? So like for confirmed calls, you can have year-long campaigns. Right? You're 3 months into a confirmed up call. The Fed is lowering interest rates like heck won't have it, sending a lot of money into the economy, right? And you know that sucker's just going to keep running. You want to continue from the end of the test, typically. Go with that hot trading system that's already going, okay? If you're at a fresh signal, start empty and go from there. Now, I'm going to start empty for one reason only, and that is so I can show you the next piece. So you like your plan. Now the question becomes how to implement, how to follow and implement the plan. The market's closed. I envisioned having this done before, but it's still populated. Good. So it sent me $10 stocks here for today, looks like. Yes. Okay. So not off to a great start because today was a mild up day. That's okay. I did this I would have started from the end of the test, and I think we'd be sitting on a little better result. Now, what I want to show is if you go to the top, click on Tools, and go to Application Settings. I should have done this first, but there's an Alerts tab. And on the Alerts tab, I can send Clay Royer all my alerts. That'll be awesome. Or I can send the alerts to myself, and Clay will be really happy that I did. So instead of that, we'll send them to SRC. This is not my real. So before you start jotting this down, this is not my real email address. It's stevec@VectorVest, okay? It's not real. If I go down here, though, I could send portfolio alerts. I could send summary alerts. I want the orders, you know? I want the orders. That's the most important thing. I want the orders. Now, when I click that, I got to know that if my system says, hey, today, one of your stocks hit your gain loss of 99.10 on your long campaign, you're going to get an email. It's going to say, ABC stock hit gain loss at X price. You need to go to your brokerage. You need to close that position out, and you need to open a new one. All right, and when you do that, it'll also automatically send you the replacement position, even if you don't do it. So you'll have both the one to exit and the one to open if that's what your plan calls for. So that's really cool. The alerts aren't going to show down here right now, but here's what an alert Here's what an alert looks like. Let's say we just had a DEW down today. All right, it says, all right, what we need to do is sell short 10 stocks of EVIL at or as close to $9.50 as we can get. Now look, you don't have to put it in at $9.50. Just take whatever a reasonable price is based on the current situation when you get to the alert. The goal here is not to be to the penny dialed into the exact numbers. This is like your coach, and your coach is saying, do what you can to short 10 shares of evil now. That's what your coach is telling you to do. See what I mean? The goal is not for your VectorVest 7 account to mimic to the exact penny your trading account. And what matters is your trading account. So just get that order in as quickly and effectively as you can so that you can try to stay on tap as quick as you can. Now we do have another application. It costs more money, which is why I'm not going to spend a lot of time showing it or talking about it here. That's all you need. What I showed right there is all you need to get going. But we do have one that links through an API to 3 brokers, which are TradeStation, Ally, and Interactive. And that tool will actually help get everything organized to where you accept the orders and send them back and forth. So if you're somebody that's in a position willing to spend another $2,500, right, and have that kind of hand holding, just clicking the OK button, we can do that. So that's an option for some of you. It is a more expensive tool than any of our other tools, okay? But it's there. You listen. When I started with VectorVest, remember AOL? I had to click a download button and it went brr, 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 like 15 minutes. And then it had to crunch the data, you know? And then about 37 minutes later, it wasn't that long, but I got my update. And then the next day, I went to my broker and did the order. And guess what? I'm still here today. That's okay. It's going to be fine. You don't have to get it to the penny, the second. You don't have to get to that level, guys. This is your coach. He's going to tell you what to do. Just follow what he says do. That's it. It's that simple. As quickly and effectively as you can. There's no rush. You don't need to barrage. I can't get the order across in 30 seconds. I used to do it the next day. Took forever to bring up the dang brokerage account, find the dang ticker I needed, put in the amount of shares, and do all of that work. This thing right here tells you price, shares, symbol, everything you need. Right there. Cool? Cool beans? I hope so. If it's not, tough tiddlywinks. Right, Glenn? All right. Rounded third coming home. Todd, you going to be awake? Yep. All right, here we go. I promised you we can make Chapel's Champs better. Contrary to the aforementioned Jerry D'Ambrosio in this case. In fairness, he didn't know that I spent the better part of a week really cracking down on that thing and spending a good amount of time with it and made a few very interesting discoveries. So this is going to be good for some of you, for sure. Pay attention. Don't fall asleep. Okay. All right, so what we're going to do is come over here to Backtester. Okay? And we are going to, in this case, create a new one. We're going to use an existing. We're going to refine an existing system. So some of you out there that like to tinker, this part of the presentation is for you. I want to start with a great, now listen, you can blow up a good system here if you're not careful. So, you know, don't be dismayed when you do something like that. But there's also reward to be found. If you want, look, you can just take the trading system and go. And honestly, what is it, Pareto's Law? 80% of the result with 20% of the effort? That's 80% of the result with 20% of the effort, okay? Just take the ones that are there. And it's a whole lot better quality of life for some of you. That's why they're there. But for the others, the people like me who like to get in here, see if they can discover something new, something that's going to change the world, you know, you can do it. So I'm going to come down here, I'm going to click select, And that puts my system in there. Now I can come in here, customize. We're gonna have some fun. I might just get to answers here, I don't know. Actually, let's not even modify it yet. What we're gonna do, we're gonna run it over the last 3 years, show you how good this system really is, okay? Then we'll modify it and show you how much better you can make it. All right, so here's the last 3 years. We're gonna start on the first signal. Now this is GLB RT kicker, different system. We talked about that one, Jerry showed it as well. So I'm just gonna let her fly. Watch this one, this one's gonna be fun. You ready? Here we go. I'm gonna blow it up. I'm gonna take off all those ugly markers. We're gonna watch this sucker go. Oh man, look at that, Todd. 27, 20. Oh my, it's coming back. Here we go. It's like an uptrending stock. It's got higher highs and higher lows. We like that. Oh, whoa, 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 whoa. There it goes. 52, 57. What do we got? Oh, came back to 42. You son of a gun. Oh, 80. There we go. 92, 97, 101, 108, 131. Holy moly. Where she stops, nobody knows. Right through the COVID collapse. What COVID collapse? Did anybody see the COVID collapse in there? Barely. It's not going to be the biggest drawdown in this portfolio, I promise you. I don't think. It's close. Oh man, what does that say now? A lot. Holy, is that for real, Glenn? That's 370%, 400%? Wow. Some of you saying you can't do it. You better believe you can. Chappell's Champ stocks, these stocks have incredible volume. Very reasonable price points. I don't care what size account you got, you can do this. Period. There are people doing it. 713%. There you go. This is the heavy drawdown this year. There was one stretch there, June, like right into June, where the market got a little squirrely enough to cause some signal issues. Okay? So again, that goes back to there ain't a thing on this planet that is going to be perfect 100% of the time. But I'll be darned if you're going to find anywhere else where you find automated systems picking this caliber of a stock. Picking this. What kind of stocks does Chappell's Champs pick, right? What's the whole, well, this is short right now. Okay, Jerry covered there's 8, you know. What caliber of stock does Chappell's Champs, he covered it, I'm sure. Cheniere Energy. New Fortress. I mean, we are borderline high quality retirement stocks. Energy Focus, to be sure. This little San Juan Basin is a little hidden gem. That little sucker right there. Okay? All right, anyway, that's the kind of stocks Chappell's Champs finds consistently. Look at the RVs and the RS numbers here, man. Look at how much money these companies are making. It is bananas. Look at the earnings growth rate on these guys. Look how quickly you got to the answers, right? Now, remember, we're in a down right now, so this is going to be great when markets get on a roll again. All right, anyway, enough of that. I think that needed to be done. I think I needed to bring you into reality, because some of you are thinking, you can't do that. You're probably not going to get 737%. What if you got 524? Hell, what if you got 162? You think you can get that much out of 700? I sure as heck hope so. The only way you can't is if you don't listen to anything the thing told you to do to begin with. Okay? That's real. I'm not kidding. All right. Let's get out of here. Let's make it better. You guys are like, man, this guy promised, he better show it. This guy promised me, he better show it, man. All right, let's have some fun. All right, I'm going to copy this, and we're going to make some changes. I'm going to get right to the answers. Watch this. Now, I did this over a sequence of like an experiment, one thing at a time. Okay? Watch this. Forget Profit Locker Pro. Watch this. We're going to go recommendation, not a buy. When we buy a Chappell's Champ stock, which are buy recommended when you buy them, I think at least typically, and they go to a hold or a sell, you get rid of it. So we're not even waiting for the sell recommendation. If it turns into anything but a buy, we're going to get rid of it. Now I got news for you on the short side. We don't have not a sell. So I might have to ask the programmers to look into that. But when you short ballistic new highs, they have buy recommendations. That's the nature of the search. So I can't do anything that cool on the short side. I wish I could. And I got to be honest with you. I don't think anybody's going to find any better way to manage ballistic new highs than that Profit Locker Pro Stop, because I have run hundreds of iterations and cannot find one that's better. Okay? Period. So there's probably one out there somewhere. You can't possibly test everything, and it's probably esoteric, and it probably doesn't make sense to begin with. The other thing that we're going to do is we're going to go to 5 stocks. We're going to go down to the shorts. We're going to go to 5 stocks. We're going to finish and run. Watch this baby go. So if you guys think the systems that we put out can't be improved upon, now I will be first to tell you here, the compounding effect from not having to buy 10 and reducing that number to 5 is almost like cheat mode, is what the kids would say on the video games. It's like stealing. But the trick is, you can't do this with like penny stocks, or you get into a situation where you're buying more shares of a company than you really can. You can do it with Chappell's Champs. The short side, that's a little sketchy over time, where we're going to be towards the end of this test anyway. But look, whether it's 10 stocks or 5, I think, what are we talking about, Ray? We're talking about going from 191% annualized with a 26 draw to 311 annualized with a 33 draw. Now, I got to be honest with you. I heard Jerry say something earlier in the first presentation, which was, that's a pretty high drawdown. You can't get to 300% annualized with a 10% drawdown. That's not going to happen. You can't get hardly to 200% annualized with less than 25, which is what that is. That's just the nature of the beast. You start getting down into 30 and 40% returns, which we have systems that do that. The drawdowns can come in a little bit, and they can get down there to where at any one time it's only 15, 16. Anything south of 10 is super hard to find. Let's talk money managers for a second. You ever heard of a Kalmar ratio? That's what money managers love. And they love for their Kalmar ratio to be round about a 2. And a Kalmar ratio is the compounded rate of return divided by the max drawdown. And they figure they got a pretty good system if you have a Kalmar ratio of 2. So what you have here with that 300% annualized rate of return trading system is a 3. What you had before the changes was a 3. I haven't been to school in a while, but I'm pretty sure that 3 is better than 2. The longer your test bed, so this is a 3-year test, the more realistic these numbers are actually going to be. Okay? Now, I don't ever think there's reason to go back more than maybe 5 years at the outermost. But the further you go back, the more detached the current situation often is from then, okay? And so these are actually incredible, stunning. If there are money managers out there, right now they're like, what? Okay? These are stunning. Can I do better? Can we make better systems than that? You bet. We will be. The answer to that question is yes, and we will. Right? I've just recently started to tackle this monster again, and I'm having a lot of fun doing it, and I'm stumbling across some things that down the road are going to blow your mind. That's what we do here at VectorVest. We don't rest on our laurels. We're always working hard for you, right? And we do it because we love it. I don't have to be here. I can promise you that. For those that are wondering, I don't have to be here. I don't. And I owe it all to Doc. I hope you're watching. because I owe it all to you, man. 100%. That's real. Okay? I get emotional when I start talking about that. But anyway, I'm going to have to get back. I'll collect myself here a second. Final guidance. Oh, 2 new systems. Viewers. Trading system viewer. There is a new one called the Comeback Kids and Ballistic New Highs Short. It's up 36% so far this year. If you go back, look at the trading system details here at the top, as Jerry showed you. This one is dynamite too. Very consistent, very steady, very little trauma in the COVID collapse. Again, it's like, what trauma? There's none, right? Drawdowns have not been near as prolific as even Chappell's Champs. Very solid system. Currently it's short. Here are the positions that are in there. So it uses Comeback Kids on the long side, and it uses Ballistic New Highs short on the short side. It does not use Profit Locker Pro. Some of the people in the chat right now better be saying hallelujah. For those that don't want to up to that product, which, by the way, I still think has a lot more value than people realize. But this is just bare bones VectorVest, man. Search, general stop criteria. And 65, that's going to be a hard number to beat, based on the testing that I did anyway. Okay? It's optimized. It's good. All right, let me get out of this one. Get out of this one. Another one. I love this one. Biggest bargains. No-Mo Mojo. Any of y'all watch Kramer? I think we got No-Mo Mojo from Kramer. I think. He was talking about Mojo at some point. Or maybe it was Austin Powers movie. I don't know. We do so many funny things around here. But these are stocks that they don't have earnings no-mo. They got no-mo mojo. Okay? And they're parabolic, and when the stock market goes down, boy, they go down with it. And so if we look at trading system details here, again, you're going to find a very, very nice curve. Wheels came off a little bit here. In 2000, this was the growth transition. Even some of these very resilient biggest bargain stocks got hit there a little bit, I believe. But boy, this thing's back and moving again. So that's the best 2 I can get in there for now. My goal is going to be to put another couple in there as often as I can for the remainder of this year and into next. And just keep putting more and more new blood in here so that no matter what the market throws at us, man, we're going to have things when we come in here and we say, all right, what do I pick now? Hey, man, I want ones like this one, you know, that are making money over the 1 month, the 3 month, the 1 year. Look at that sucker. I want to be short. That's what it's telling me. I want to take advantage of market downside is what that's telling me, right? But you want good numbers all the way across. You want these snap charts out here to the right to be as smooth and steady as you can find them. And you want to go with those kind of strategies. I generally like to start with the 1 year, backfill the others, right? And you're going to be in good water up here. All these make sense. Each and every single one of them, okay? And that's all I got to say about that. That's what Forrest Gump said when he got the box of chocolates, I think. So I'm going to wrap it up. And I hope you enjoyed this, guys. I'm going to give you some final pointers here. Favor smooth. This is what I was just showing you. You want to favor smooth, steady metrics. You want to favor smooth, steady spark charts, smooth, steady back tests. The smoother, the steadier, the better. You want Kalmar ratios greater than 2. You can do it. You can pick the ones we got. You can make your own. But you want to you not only want to outperform the market, you want to outperform those money managers even. It's not that hard, okay, with VectorVest. It really isn't. Is the system making money year over year? Once it starts to break down, you go back to square one, make another one, or find another one that's working well now. Focus on the annualized rates of return that make sense for you and your capital. Another thing I would say is I often, at this point, certainly begin to break my capital up into different buckets. You can have a Chappell's Champs Goes Ballistic, along with a high relative safety, along with an options portfolio, and everything in between. So you don't have to lump all your money into any one thing once you start to get larger and larger accounts, and where some of those drawdowns might. That means, Steve, that at one point I was down about $2.4 million before I went higher again. I get that. Just start breaking it out. High relative safety stocks, Chappell's Champs goes ballistic, options portfolio, whatever your case is, okay? And then maximum drawdowns are always something to look at. Jerry went through that. Guys, before I send it to Ray, VectorVest is all you need to deploy, monitor, and manage a dynamic, rules-based trading system that can beat the pants off the pros in the stock market. You heard it here first. Over to you, Ray.
Thanks, Steve. What a great presentation. Those numbers are outstanding. It's hard to believe that, something so simple can yield those kind of results. And for those of you at home, some of you I know personally are trading systems. They're following them. They're using them for their guidance day in and day out. For the rest of you, I think that you should just give it a try. I think you should track it. You can watch these replays. We're going to have these replays up on YouTube until November 30th at least, where you can go back, you can watch Jerry's presentation, you can watch Steve's presentation, put a toe in the water and paper trade one of these trading systems. You don't have to go all the way to build your own. I know some of you will want to do that, and you'll have the instructions on how to do that. But some of you just take a look at the trading system, see what's working, and go ahead and deploy a paper traded system just to see how it works. I think you'll be pretty amazed at how this can change the future of investing and reduce your time and stress during this entire endeavor. So next we're going to move into the last talk of the day. Before we do that, just a reminder, you can download the slides, vectorvest.com/MC slides. Take advantage of the trial. This trial applies to everybody. If you already have real time, then you already have a lot of these tools that we've demoed today. But if you don't have real time, if you're on intraday or end of day, it's a no-brainer. Take the 60-day trial because you're going to get access to the auto timer, Pro Trader. You're going to actually get access for the 60 days to Profit Locker Pro. And you're also going to be invited to the Successful Investing coaching group that Mr. Todd Schaefer, who's coming up next, teaches. That's week in, week out. That'll help you navigate the current markets, see how they're managing their portfolio. So I would take advantage of that trial. Just remember, in the conclusion of that trial, it will automatically switch to an intraday account billing. And you will be currently billed with the normal billing that you have right now during that trial, but you will have access to all of these tools. And then at the conclusion of that trial, you'll turn into an intraday customer unless you call and let us know. So with that, one more thing. If you want to take advantage of those course prices, today is the last chance for that, the last day you can take advantage of it. So just go to vectorvest.com/MC courses, and we'll have a list of our discounted courses that you can take advantage of right now. So without further ado, we're going to move to Mr. Todd Schaefer as he gives you the daily drill.
All right, thanks, Ray. So now I have the enviable position of trying to put a bow on this day's events. And I'll put on my empathy hat here because I'm guessing that there are some of you out there who feel like you're drinking through the fire hose, right? We've given you a lot of information today, and it may feel a little bit overwhelming. There are some of you out there, though, who are also excited and ready to move ahead, right? And I'm going to guess a big determinant in the difference is whether or not this is your first exposure to the VectorVest system or whether you're already experienced. Right, so I made some feverish notes while Steve was making his presentation because he was generating a bunch of ideas for me to share. So as Ray mentioned, I'm one of the coaches for the Successful Investing Group. Brian D'Amico and I run that coaching service, or that coaching group. One of my promotional presentations, introductory presentations for that group is called the 10-Minute Investor. And the whole deliverable is that you can manage a portfolio in a 10-minute-a-night routine. It doesn't have to be complicated, and it doesn't have to be a major lift. That's true whether you're doing something very simple as we do in successful investing, or whether you're doing something a little more complicated like we do in our automated portfolios. They can both be run in a 10-minute a night routine. Of course, it's going to take me 30 minutes to talk about a 10-minute routine, but bear with me here, and I'll try to make this as low impact as I can. But the idea here is we want to establish a daily drill, a daily routine. Why? Well, first of all, if I can make that daily routine be at least not arduous, if not, dare I say, even fun, then I'm more likely to do it. Particularly do it with persistence and consistency over time, which obviously is what we need to do to be successful investing. So I need something that's sustainable. The second piece of that is we have busy lives, right? Some of us are still working. Maybe you work third shift. So in the daily drill, if we're doing aftermarket portfolio maintenance, executing our drill while the market's closed, I can do it any time from 4 o'clock in the afternoon Eastern until 8 o'clock in the morning the next day. I can fit that into my schedule, whether that's when I get home from work before everybody kind of settles down, or maybe it's after everybody goes to bed and I can take an extra 10 minutes before I go to bed to run my routine and manage my portfolio. So it's very flexible. I can fit that in anywhere that is conducive to my lifestyle, and again, that I'll do consistently. I like to share this story. I have a friend whose wife used to manage their portfolio, but she was a technical chartist. So every night, he'd come home from work, she'd hand off the baby. Her job, was to manage the portfolio. She'd go in the den, shut the door, she'd run her scans, she'd come up with 200 charts and go through 200 charts every night, looking for candidates. Have you ever looked through 200 charts a night? Don't try if you haven't, right? First of all, I wouldn't even get through 200 charts. It takes too much time. But secondly, I'm looking at 200 charts and I'm making stuff up, right? You get that glazed look in your eye. It's like watching the white lines or driving in a snowstorm, right? You just get the deer in the headlights thing and you stop seeing anything. So by keeping this a manageable endeavor and in a routine where I can build some muscle memory, the system serves itself and it serves me, keeping it simple. So let's talk about kind of the architecture of the system. And I like to break it down into two modalities. The first modality is just assessing what's going on in the marketplace. The second is, okay, what actions do I need to take? So we've been talking all day long about how we want to buy rising stocks in rising markets. So the first thing I want to know is what's going on in the market. Now on our slide, we have 5 bullet points here. But I want you to notice that the second bullet point, didn't mean to click, sorry. Watch the Daily Color Guard Report video. That Daily Color Guard Report, we walk you through the other 3 pieces of the market review on a daily basis. So particularly if you're new to our system, simply go into the program, if I can find it. Do I have that open? Oh, the peanut gallery. I passed it. So either from the home page, if you have the strategy gadget here, once we have updated it, you can link to it here, or if you go to the timing tab, you have the Daily Color Guard Report on this tab. Just simply click the link, it opens and plays the video, and lo and behold, we start off with the home page of the software and we walk through all of the bullet points we're about to cover. So you have us taking you by the hand and guiding you through that analysis. Plus there's a couple extra bonuses in there in that we look at some hot stocks for the night. We look at our gold timing study. We look at news for the next day. So it's a nice endeavor. That being said, it's typically about a 10 to 15 minute long video, unless Glenn does it. So my 10 minute a night promise to you is going to be longer if you use the color guard video. All right, so I hope you can accommodate me for that idea. But certainly if you're new, it's a nice way to kind of get acquainted while that video is playing. If you have two screens, you can put the video on one screen and click along on the home page and in the market timing graph in particular to kind of get familiar with the tools and practice making the kinds of assessments that we're making. Because we look for some of those divergences, some of those reading the tea leaves kinds of analysis that you might miss as a novice. Eventually, you'll get to the point where you can do that for yourself. That being said, let's back up now and go through the checklist for ourselves. And again, I want to build the pieces before I demonstrate how the process can work. So typically we'll open first to the home page of VectorVest. The home page is a very powerful tool. It kind of gives you the headlines of what's going in the market that day. So the first thing we notice is in the upper left corner, we have the performance of all the major indices today. Everybody's in the red, sharply so, more than 1% in the red. The VectorVest composite, the broad market, actually is down 0.64%, where the major indices are down well over a point. One of the questions we often get is, well, why do we use the VectorVest composite, a broad market index, instead of just using the S&P 500? And the answer is, well, because there's 9,000 stocks in our database, not 500. So when you see the S&P 500 and these other indices as a smaller slice of the larger whole, now I can start saying, well, small cap stocks, large cap industrial stocks, right, are performing differently and maybe differently from the broad market. So the VectorVest composite is our broad market index. So I know the broad market, or another way of saying that is the stocks that are outside the major indices actually didn't fare as poorly as did the major indices. Coming to the right, we have our market timing gauge, which is giving us, we call it our stoplight on the market, right? Currently the gauge is in one tick in the red. Color guard is mildly bearish. We give you guidance, and we don't advocate buying any stocks at this time. What does that mean? Well, how about we don't advocate buying any stocks at this time? Well, what do you mean? Well, I mean, I don't buy any stocks right now. The market's down. We're getting red lights in the color guard. The primary wave is down. The underlying trend is down. The confirmed call is down. There's nothing up. We don't buy stocks when the market's down. So the guidance is pretty straightforward. The color guard square below is giving us now 6 days history of that market timing gauge action. So generally, I don't see any green on the color guard, so not much bullishness going on. Majority yellow lights perhaps, so neutral to bearish conditions currently in the market. So as I'm talking you through the analysis, right, once you have that, you can get through this pretty quick. I have a down market today in bearish market conditions. The market timing signals are all aligned to the downside. The MTI has fallen below that level of 0.50, and the buy-sell ratio is well below that level of 0.20. And I did that in about, I had to talk through it, so that's 15 seconds. It's giving you a snapshot on the market. This little mini graph shows the MTI in downtrend. A nice visual representation of how the MTI is performing. What are the best performing stocks? Well, we have this little gadget. It can be VST stocks or Midas Touch stocks. Here are the best performing stocks. Here are the best performing industries. Here are the best performing sectors. I'm getting a lot of information about what's going on in the market right from the home page, and you can arrange this home page to include all of these gadgets and bring to your attention the information that's most important to you. Maybe it's advanced declines, right? Maybe it's a quick list of stocks that you hold in your portfolio, right? Lots of flexibility here. And I don't want to burden you with too much detail, but lots of flexibility. You can put these gadgets wherever you want them, arrange them so they make sense to you. And we also have a little dashboard at the bottom that goes with you wherever you are in the program. So I can always, in this case, I can always get a mini graph of the VVC no matter which tab I'm on within the program. So, heed the color guard. The color guard right now is telling me I'm bearish. So I'm not buying stocks. So when we think about this 10-minute routine, how much more do I need to do? Log off. Take a walk. Go hug your spouse. Pet the dog. Right? Do things that add to your experience on this planet. Maybe, if this is fun for you, go take a look at a little deeper and see what else is going on in the investing world. All right, so that's the home page, and that's how we heed the color guard. We've done a quick snapshot assessment of what's going on in the marketplace. And we've already got some pretty good usable information, which has been a theme for today, about what is going on. And, by extension, what do I want to do? So, by the way, downtrend in market, shorting might be appropriate. The next piece is typically we'll go to the market timing graph. The market timing graph, I just go to a 1-year time frame. I'm going to go to the MTI layout. It's kind of our default layout because this graph now includes the price action of the VectorVest composite, subgraphs for the MTI, the buy-sell ratio, and the RT. Here I can now see visually represented the trends of those indicators we saw on the home page. So instead of looking at their data points, it's pretty easy for me to see that, wow, this price action is trending lower. I'm hitting lower highs and lower lows, right? I'm in downtrend. The MTI, since the market put in its high here, is in downtrend. Wow, we put in a lower low on the price, but we didn't put in a lower low on the MTI or the RT. Am I developing a bullish divergence? Well, the jury's still out. We haven't finished this formation, but maybe, right? And that would be a bullish indication if we are dissipating that downtrend. So we'll keep an eye on that. So that's some of the analysis that we can do by looking at our market timing chart. The next thing we want to do from there is take a look at the VectorVest views. Not from 3/10 of 09. Let's bring this current. Remember, Monday through Thursday, we have the abbreviated version published. But read it, right? We have, first of all, we explain how the colors are assigned within the color guard. We go through that in the daily color guard report as well. But we summarize the day's action. We display for you 3 weeks history of that color guard information. And what does that tell you? Just look at the colors. If red means stuff is trending lower, green means stuff is trending higher, and yellow means it's kind of in between, we can easily see that we transitioned out of neutral to bullish into more bearish conditions. Moderated a little bit, and today's market action pushed us lower, back lower again, more strengthening to the downside. I can see that without looking at any numbers. Right? So you have 3 weeks history of the color guard there. If I scroll lower, I come to the strategy guidance. You get this every night. Recession fears sparked a broad-based sell-off, and Wall Street closed sharply lower today with 3 red lights and a down-down situation. Prudent investors should not buy stocks at this time. Are you prudent? Log off. Are you aggressive or a trader? Well, then you should play with a bias to the downside. Well, why? Well, because the color guard's all red and all the market timing signals are aligned to the downside. So our bias is to the downside. Which searches are performing the best in this current market condition? Well, on a one-day basis, our Derby tool is telling us they're all bearish. So those are the best performing searches, but the fact they're all bearish kind of confirms the trend, the bearish trend of today's market action. Over the last 5 days, they've been bearish. So not only are we identifying the best performing searches, they're all bearish, confirming the trend in that time frame. Mini Rocket Short is the best performing 5-day strategy. It put up another 8% today. So it's continuing to perform to the downside. I'm starting to kind of, I'm not building a narrative, but I'm building background understanding of what's performing in the market and how I want to align myself with that market condition. From this point, then, I'm able to really determine my outlook on the market. And so this is an action point. I have a bearish outlook. If I don't trade the downside of the market, I'm not worried about taking on new positions. But what do I need to do? I need to check any of my current holdings to update my management of those holdings. Right? So I need to look at the portfolio. So there are two ways that I can do this. I can look, if I'm tracking my portfolio in the portfolio tool, right, with a Portfolio Genius, I can match this list of stocks to my real portfolio. So if I took those positions, I can come into the report section and update with the transaction log, there it is. I can go in and adjust the filled price or the number of shares. I can adjust the details of that transaction so it matches my account. If you wanted to have that level of detail in the portfolio. The beauty of doing that is then the Portfolio Genius, when it applies your stop criteria, will calculate for you the stop values that you can actually place with the brokerage. The other methodology that I can use is just using the watch list. As we saw Glenn do this morning, all I have to do is find the Viewers tab, there it is, and go to the watch list viewer. Thank you. What, am I getting tired? Here's Glenn's watch list. So here's my list of stocks. Supposedly or presumably these are my holdings currently. So if this was my portfolio, and obviously I'm holding through down signals, and I was managing these positions, what would I need to do today? Well, if my stop loss was a sell recommendation in the VectorVest system, I've got 3 stocks. I'm holding the control key so I can tag them. Those 3 stocks, I need to consider selling. So I can look at their charts if I like to, or if I want to. Notice that if I sell these stocks out of my portfolio, then I'll affect the average value for all the stocks in my portfolio. Right? So this is the average line of average of all the data points for all the stocks that are currently in this portfolio. So by pulling out these values, I'll make incremental improvements to the watch list average. As an example, I'm going to delete those selected stocks, and right now notice I have an RV RSRT combination of 146, 110, and 117. 146, 110, and 117. They all improved by eliminating or culling that weakness out of my portfolio. We call that weeding the garden. All of that activity can be done at night. I don't have to do it at 12 o'clock in noon or when I get the alert. I can enter those orders with the brokerage when I get to my regular routine at 10 o'clock at night if I want to. So we're setting up the tools to help us effectively manage the portfolio on a systematic, rules-driven basis. So obviously that process began by having a trading system in place that tells me when to buy, what to buy, and when to sell. I can do that on a manual basis, or I can do it on an automated basis, as Steve and Jerry had just demonstrated. So what does the manual process look like? Well, to keep it kind of right side up, let's just pretend, for the sake of argument, that we actually had a green light in the color guard, that we had our upward signal, whatever it is you're using, and I need to go find a candidate. Well, where's the first place I would probably go looking? Well, in manual mode, the first place I would certainly go looking is top VST stocks. We've been talking about them all day. So I'm going to go to the Viewers tab. I'm going to go to the Stock Viewer. And what would I normally prefer? Well, how about top VST stocks that have a price pattern? Remember VectorVest Simple from earlier today? Price pattern is just going bottom left to upper right, smoother the better, driven by an earnings pattern doing the same thing. So here are my top RS stocks. Let's go there because the market conditions are kind of ugly right now. Let's just graph these guys. Oh, too many in there. We'll just do the top 20. Let's try that. So in successful investing, right, we can confirm these patterns visually. We don't need all the power tools. So if that's kind of where you are, that's a great place to start. Build the skills of reading a chart, populating the portfolio, managing the trade on a manual basis. So let's change our layout to VectorVest Simple. Same name, right? So I'm looking for stocks whose price is going bottom left, upper right, smoother the better, driven by earnings rising. Right? We talked about that combination this morning. And I'm going to cherry pick from the list those that have the prettiest graph. That's kind of pretty. Ooh, that wasn't bad. Right? So I go through this process and I find my best candidates. And of course, right now, all these graphs are ugly. But I'd like to see them going bottom left, upper right, and continuing to rise here on the right-hand side, because we buy rising stocks in rising markets. So all I'm doing is applying the rules. So instead of me going to the stock viewer, if I instead went to the Portfolio Genius and it said, hey, buy this stock today, I might look at the graph, confirm that I like the graph, and then go place that order with the brokerage. Done. So what's this process look like? Run through it. Reality would be, I look at that screen, I go, wow, I'm not buying any stocks today, log off. And of course, I've been in that situation for some time now, so I'm not terribly surprised. And I'm happy that I'm missing all the carnage, sitting nicely in cash, or with a couple of positions that I've protected, right, against a downdraft. If I was buying stocks, I'd have to go to the additional step now of either going to the stock viewer, cherry picking my favorite stocks, or my Portfolio Genius, or my favorite Unisearch, and choose my favorite stocks. I like to put them in a watch list. So we'll pretend that this is my watch list again. So these are my candidates for purchase. The next day I make sure the market follows through. The stocks that follow through the best, I buy a couple. Using the things that we learned from Jim to make sure that I am managing my risk. Position sizing, number of positions, applying the stop loss, protecting my 1 to 2% risk threshold. Place those orders with the brokerage. Done. Rinse and repeat. So remember I said at the beginning of today that it's all about having actionable information. Information that helps you make better, faster decisions. Have we not just done that? I'm leaning on the power of the VST system to find great candidates. I'm leaning on the power of the market timing system to find rising markets, or at least market conditions that are conducive to what I'm trying to accomplish. I'm using tested stop methodologies to manage my risk and to exit trades when they break down and fail, because I know I'm not going to win all the trades. It's all about putting the probabilities of success in my favor. Doing this daily drill and having that muscle memory makes this a doable thing, and doable for the rest of your life, right? Because ultimately, that's what we're trying to do. So let me look at my notes real quick, because I think I've covered it all. Yes, we're good. All right, so big piece, I just want to make sure that we all knew that when we get those alerts, we can update the trading history or the trading account in the portfolio to reflect reality. All right, but with that, hopefully that eases your anxiety, maybe, if that's what you're feeling, right? That this does not have to be complicated, and with VectorVest, it really isn't. Even if there's a little bit of a learning curve, you can do this. We have a lot of people who do, and you met some of them today. So, our mission has always been to provide the best stock market guidance available anywhere at any price. Hopefully, we have demonstrated to you that we do that, and we've been doing that for over 30 years. So, we'd love to have you be part of the club. All right? Thanks again for your attendance today. Thanks to all of our presenters. And let me kick it back over to Ray to say our final goodbyes.
Thank you, Todd, and thank you everybody for joining us today and taking the time to further your education in the stock market investing. We appreciate having you here. A lot of the support and friendly names that we consistently see over and over again. It was great to have you here again. I also want to say thank you to all the instructors who did an amazing job presenting today and sharing their knowledge and guidance of the VectorVest system with you. A very special thank you to Mr. Steve Chappell, who spent countless hours putting this together for us. And a very, very special thank you to Dr. Bart DiLiddo for creating the VectorVest system and having that vision and allowing all of us to retire with the peace of mind, with having the knowledge we need to make investing a lot easier, simpler, and more profitable for us. So thank you again. We're going to send over to Glenn Tompkins really quick. He's going to do the final drawing for us. And once again, thank you, everybody. Take it away, Glenn.
All right, everybody. I know it's been a long day. Hopefully it's been well worth it. We're going to go out on a big note. First off, at the end of this time, right now, I need to flood the chats with ooh-wees. That's the call that we use in the Jockey Club when I'm on the Jockey Club. But right now is the time. Show some appreciation if you can. Type the ooh-wees. I don't care how you spell it. Just put it in there, all right? Type the ooh-wees in there, because today was like, could be for a lot of people, a day of ooh-wees. A day of opening you up to the better possibilities to making money in the market. That's what this is all about. And you know what I love with everybody that came up here? It wasn't about any flashy stuff. It was rooted in what the software, what the system has to be able to provide for you. That's it. No smoke and mirrors. No, it's there. It's there. We're showing it, and the ability for you to be able to duplicate that and do the same thing, folks. So hopefully the ooh-wees are coming in. Are they? There we go. That's what I'm talking about. All right, that's VV Nation out there, folks. And if you're brand new to the channel and you appreciate what we did today, hit the like button. And if you're not a subscriber to the channel, hit the subscribe button. If you like today, think about, we put great content on this channel every single day. We have live streams, we have recorded videos. Folks, we're here for you. This should be a channel that you tune into every day to see what's going on and how you can make better decisions in the market. All of the conversations, all of the topics that were covered were real world topics that you guys go through every single day. I don't think there was anything off the wall here. This is all real life stuff to affect your real life portfolio. And it's something that I'm still going to say that was given to me by our CEO yesterday. We've got to take you off the path of recovery and put you back on the path of growing. And that's what you've learned today. These videos will be up on the YouTube channel till November 30th. Folks, if you weren't able to watch it here live today, you now have an opportunity to go back and watch it and record it, or slow it down, speed it up, whatever you need to do to take better notes if that's what you need to do. But it's there for you. You have access. We've typed in the room the link to get the slides. We've typed in the room the link to get the special pricing. I don't know what else we can do for you. We can only take you to the path. It's up to you whether or not you decide to walk the path. All right, so as Steve was talking about, he's been here for 20 years. I've been here for 18 years. Everything that I know about the stock market, I know from VectorVest. Everything. Does that make me a wizard or pro or whatever? No, it makes me a realist. Makes me a realist to be able to make real decisions without being caught up in the quagmire of the noise. And a lot of us out there are still caught up in the quagmire of the noise. Get out of the noise. Get set and just go. Is that like running? It's like running a race. It could be. All right, so at the end of the day, I'm giving away, again, here we go. I'm giving away, this is my other bear. This is Smokey the Bear. All right, I'm giving away 2 bears, VectorVest bears. I'm giving away 2 mugs. The winners are, for the mugs, Neil Sullivan and Reginald Bessemer. Congratulations. You need to send an email to connect@vectorvest.com. Send an email so you can claim your gifts. And then for the bears, we have Brian Hunt and Bob Ortlieb. Congratulations, you both won bears. All right, again, you need to send an email to connect@vectorvest.com. And I, like Ray, want to thank all of the presenters that were up here. Ray did an excellent job hosting for today. I'm glad that I had an opportunity to give you guys a talk. Steve Chappell put a lot of work into putting this all together. Todd Schaefer is still here. Jim Penna, Jerry D'Ambrosio, were great talks that, could have gone for thousands of dollars as a seminar. It was free, and that's how much we appreciate you. All right. I want to thank our product support team. Boston was in the background. A lot of you know her. She was answering a lot of questions. Someone said that I was at the bottom of the totem pole because I was answering questions. No, it wasn't. I love interacting with you guys. So I did the best that I could to answer as many questions as I could. Ray is looking at me. That's my boss. He's like just smiling. He said I wasn't at the bottom of the totem pole. I'm just here to support you guys. I can talk to you, but I can support you as well. I want to thank our CEO, Linda Royer. She puts a lot of great information, especially in my own head, when it comes down to helping you guys out as well as far as information to relay to you guys. Most of all, we wouldn't be here if it wasn't for Dr. Bart DiLiddo, the founder of this company. I love the beginning presentation that gave an idea of why we are who we are. And it was born during a snowstorm and wanted to be able to make money. And once he came up with the algorithms and things like that, the mathematics behind it, he wanted to say, hey, let's go give this out to other people. And that's exactly what we've been doing for over 30 years, folks. We got to be doing something right. Think about that. We're not a fly-by-night company. For those of you who are sitting on the fence, we've got some longevity. And you listen to the people in the room, they'll tell you. I love that VV Nation talks to you guys out there because I'm a company guy. I'm going to tote the company line. But when you hear actual subscribers tell you what they're doing and that they are making money, folks, that holds a lot more water than any of us speakers up here. It really does. So I want to say thank you to Dr. DiLiddo, big time, because again, if it wasn't for him, we wouldn't all be here. And I'm with Steve, I don't have to be here, but I still love doing this. I still love being able to, my personality is I love to relay information to people. So I think that's it. I think I'm going to sign off. That's it, yes? So I'm going to sign off the Glenn Tompkins way, all right? Adios, arrivederci, ciao, au revoir, sayonara, aloha to all my peeps in Hawaii. Bom dia, salam, shalom, namaste, yasu. Until then, next time, folks, see ya.